A'udhu billahi minash shaitanir rajim. Bismillahir rahmanir rahim. Greetings, traders. It's I, Abdul Shabazz. This is Some Real Change Stock Options Trading Journey. And today, the last day of the month, March 31st. Beautiful work. Called out yesterday. Still kind of like it for today too. Come right back to that area. Yes, sir. Come on in here, team. Come on in here, kick. Do I like that 642 if we continue down? Alrighty, team, let's get started for today. See what the market is doing. The market is green for today. I'm still liking a call with a continuation move at the 642. Still definitely liking that. And liking a put below the 647. 637. 640 strike, 642 entry. 645 first profit target, 648.5 second profit target. And if the market decides to go down, 638 put, 637 entry, 632.4 first profit target, 630 second profit target. See how this lines up on the charts. Here's my energy drink. Should be around there somewhere.
Not here.
Now I got one open already. You'll find it.
Blah, blah. I don't see any energy drink anywhere.
It might be in the car. Big sweep area at the 634 yesterday. That took place pre-market, I see. Sir Night, good morning. Feels like the market's singing a Nelly song after this war. Still on the downtrend. Which song is that? Still on a downtrend. We had a nice little gap up pre-market. The question is, will that be sustainable? I have no idea. Will it be sustainable? A lot of overhead resistance at the 640. 640 in itself is going to be a telltale sign. Okay. Coming into today, I'm still interested in a call above the 642. I have my alarm there. Looking for a clear sign, a clear setup. Times like these, we want obvious trades. You don't want to force anything. You want the trade to be obvious. And here we are getting closer to yesterday's high here at the 640. This was a beautiful sweep area that we weren't able to participate in as we broke through last week's low. $633. Put me at. Yeah, that's about right. You can see it right here on the weekly chart. Show this to you, Big Ben. I'm going down, down. Country grammar. I'm going down, down. One thing about me, I always like to mark off last week's high and last week's low. You can see us clearly in this downtrend control selling algo that we've been in ever since we topped off at that 697.8 for the high. After we've done that, we have done nothing but come down, putting in a double top and then a lower high, and then we have been coming down with red weeks consistently. Always like to point out the high and the low of the previous week, because at that low you can find bull sweep, okay, to the upside, and there was a nice little sweep from the 633 area all the way back up right now to the 640. The problem was we weren't allowed to participate in that sweep because that sweep took place pre-market. So we're definitely upset about that. Yes, it was definitely some BS that took place without us. Right now, the market is battling for the week, control of the week. Above this 640, the bulls will now have control of the week. So let us pay attention to that, which is why we look at the larger time frames first. There's a lot that's going on at the 640, which is why if we're able to get over it and establish some support there, then I'm interested in a call at the 642 area. 640 strike, 642 entry. Why? Because this will mean that the bulls have now taken control of the week. If the bulls can take control of the week, okay, then that will be a good sign, especially with today being the last trading day of the month and a Tuesday. So that could be the pep that the market does need to see. Additionally, we're at the bottom of that larger control selling algo. So for us to come back up is a natural reaction of just staying within the algo itself. Let me show you here by pulling it up here on the daily chart. This is the daily chart, and I want you to look at it through Heikin-Ashi eyes just so you can get a better feel of it. Okay, let me go ahead and back it up just a little bit. This is that, okay? And so because we've been at the bottom of this controlled selling algo, it is very natural for us to now bounce back up towards the top of it, towards the 650, the 652 area. This is what typically happens whenever you hit the bottom of the algo. You then bounce back up to the top of it. So this is what we're experiencing right now with this attempted bullish run. If it does happen, it is a natural bounce. It does not mean that the bulls have now regained control. The bulls will not have control of the market until or if we get above 653. That is then in the only spot where this control selling algo can be broken and turning back to more of a bullish sentiment. Not until then. But that is what's going on right now with this attempted move back over the 640 and what it represents. Down here at the bottom right next to me is the weekly chart. For those of you who are new joining us on Kick, shout out to you. To those of you who are new joining us on Some Real Change on YouTube, shout out to you as well. So what we have going on is the top right corner is the daily chart. The bottom right corner is the weekly chart. And yes, we do a top-down analysis on this channel, beginning with the much larger time frames. We look at who's in overall control of the year, who's in control of the month, who's in control of the week, who's in control of the day. And then we keep on going from there. Above this 640, the bulls have control of the week, so we can expect some bear resistance here. And if it does happen, it might not happen on the very first attempt because of what it represents. In the bottom middle is a 30-minute chart. You can also see it here on the 30-minute chart. Who the bulls have to go up against, I will highlight it for you. Whenever you get ready to take a position, the first thing you want to know is who has got your money. Who got your money? Well, in order for this to get above the 640, these big bears from Monday morning would have to begin to cover. Until then, they can just average in, average down, which is what they've done, which is why we see rejection here right now at the 640. Okay, now if they're unsuccessful and these bears get squeezed, then we can expect a measured move, and that measured move will bring us to 645 area, which is also what I have on my plans here for a call. Get in at 642, take first profit targets at the 645 area. Second profit target would be 648 area. Why is that possible? It can only be possible if these Monday morning bears get put in a position where they will have to cover and then potentially get squeezed. So first, I would love to see a break above this area, okay? A break above it, and then a close above it, a retestment of it, and after that retestment of it, turn that to an area of support, then I would like to get involved with a call in this area per se, Your Honor. So in other words, what that needs to look like is this. I'll do it with the chart, with the candles as I do. A little illustration. So that's what I'm looking for at 14. Looking for a break above this area, then a retest to it, then a continuation candle. And it is here on this continuation candle that I will choose to get involved. Okay, that is what I'm looking for on that 30-minute. On that 15-minute, getting right to the point where the bulls are starting to put pressure on early bears here. Again, knowing what this area represents, I don't want to be fooled. I don't want you guys to be fooled because the bears are going to step back in before they give this up. A lot is at stake as we're getting that retracement back right now as we speak. Sorry about that, guys. That's the 15-minute chart. And again, this is why we look at multiples. Top left is the 2-minute chart. And in the middle is the 5-minute chart. Now here on the 5-minute, as I blow that up for the team, you can see that we did not close above that 640 yet. We got above it, right? But we didn't close above it. And as our teammate Dan the Man says, we are looking for the candle close. We want to let the candle close before we go so we don't get fooled and tricked. Imagine if you'd have hopped in this at 640 and then on a wick down it fell all the way back down to 639.2. So again, we want to let the candle close and then look for that continuation candle. With less than 1 minute left, this could potentially be it. Potentially. Getting close to my entry area. Ten seconds left on this candle. Looking for continuation. I've got confirmation. I'm looking for continuation now. Nice little healthy pullback to be expected. No need to show pre-market because we have such a huge gap up. We just deal with what the market is giving us right now. And we are green for the week. We're finally green for the week. Let's see if this holds. Kosie's in the building. Jared Lewis is in the building. Big Ben is in the building. Sir Night Night is in the building. Shout out to the Kick family as well. And this is exactly why we look for continuation after confirmation. Knowing what this area represents, knowing the bulls, knowing the bears are not going to give it up easy. 640 would have been a nice one. I'm not in yet. I would have liked a deeper pullback, and it's 9:54, only 6 minutes until 10 o'clock. So I'm going to be patient and look to see if we get a continuation on the 30-minute candle. That'll be a lot stronger. I may be making a mistake, but I'm still going to hold it. I'm looking at the time. Because this still could turn around, because this very well could turn into a hangman. And if it turns into a hangman, then this could be a beautiful 3-candle reversal if the price drops back below 641.2. This candle is getting ready to close here in the next 5 seconds. So additionally, that's why I had to wait. Now let us see. I'm trading safely by referring to the larger time frame charts. There was a continuation on the 15-minute chart, and it was very beautiful, right above that 640 area. I wanted a break above it and then a retest towards it before I got involved. I didn't get that, so I didn't get involved. Stock is now pulling back some, and I'm glad I did not chase. Having the discipline to see the stock come to your area, but looking at the overall bigger picture, saying now is not the time. Looking at the larger time frames, looking at how we only had 1 minute left in that current 5-minute candle. Looking at how we had 6 minutes left in that current 30-minute candle, looking for the continuation in the larger time frame, telling you that this could possibly turn into a hangman, which it did. And if price gets below 641, it's coming back down. Avoiding any pain right now simply by exercising patience. Even when the market is at my desired area, looking at all the variables, deciding, is this a good time to strike or not? Get your cat off my couch. Thank you. Knowing that this area is critical, knowing that the bears are not going to just let it go that easy, is going to be a conversation. The bulls, however, seem very determined. As I look at level 2 to look at live price action to see who really has the bigger balls. There's a line in the sand by the bears at 91. The bulls have just blown past that, and they're trying to establish the 642 with a little less than a minute and a half on this current 5-minute candle and current 30-minute candle Looking to go into a new 5-minute, a new 15-minute, and a new 30-minute candle. Very important area here. Very important. Everything in the market is green today, guys. Everybody's green. Here we go. Is this move going to be sustainable? Let us find out. Big orders on the bid size, huge orders on the bid. It's not giving me what I want to see yet to get in. Tell me what you're thinking, team. Tell me what you're thinking. If I'd have got in at the 640, I would have been good dealing with this. But still looking for that break and retest. It didn't quite retest as much as I wanted it to. Still refusing to chase it. But level 2 is telling me that the bears are not giving up without a fight. We've already identified who's in trouble, where this money is coming from. We've highlighted them. Monday, 9:30 morning, early morning bears will be the ones that have to cover. They aren't scared yet. When the covering happens, it will be no doubt about it. However, everything is green, but we are stalling right now.
Really is it, and it softens the blow a bit to the lighter number under 6.9 million for February. We see interest rates are to the downside, and even though, of course, oil's over 100.
Not appear that we will get the. Not appear that we will get the.
Am I still on air?
Case today, so we'll continue to be on
Huh?
watch for that next time we get a decision out of the Supreme Court, but no decision on Fed Governor Lisa Cook. I'll pick up where Rick left off on the consumer, better consumer confidence, because gas prices, this is a big headline, they did surpass $4 a gallon in a national, across the national average. And that, is a milestone. It's about $1 more than we were last month. You feel this when you're at the pumps, higher prices, of course, in California. Now, a few
Team,
silver
we had a
linings.
little
Number
technical
one,
difficulty.
we've
We
been here
lost
before
internet.
very
I
recently,
want to make
4
sure I'm
years
still
ago,
with
we
you guys.
were
You guys still on here?
$4 a gallon. Now, it didn't happen this quickly.
Seems
that
like we're
time,
back.
So this can probably lead to some sticker shock, and Americans are feeling it intensely and acutely. But during that inflation spike in 22 and 23, we were looking at these levels. And then the other chart, and we've looked at versions of this before, but I do think it's worth mentioning, comes from Bank of America, which shows the percentage share of energy spending, basically, of consumers, and how that has just come down to below 4% of our wallet share. You know, it used to just make up a lot more. Energy was more expensive.
And again, team,
better. You know,
we're looking for obvious trades.
Consumer discretionary spending.
Even
Doesn't mean
though
it's
that
not
was
gonna
my
hurt,
area,
but and not psychological.
it was just too
because
much
we
at
watch
stake.
it and we watch the tick higher, so people are acutely aware of what the price of gas is and when they're filling up their tanks. But lower share of wallet. And I'll just end with, David, you know, this good consumer sentiment read from Morgan Stanley about the top concerns for consumers. No surprise, it's inflation. That's the top concern. There's the inflation read. But if you look, it was actually at higher levels about a year ago when we were going through Liberation Day and tariffs, and there was a lot of hand-wringing about inflation then too. So the worries about inflation have ticked up. We're higher than we were last month and the month before, but we're not as high as we were a year ago when about 60% of the consumers were worried about inflation. But no question that's the top concern. It's not surprising because we've had this cumulative impact of inflation over the last few years, and people feel that.
And they continue to, and as you said, an important point, as a percentage of the overall budget for the consumer, it's less than it was certainly 20 or 30 years ago. That said, $4 a gallon at the pump still has an impact.
Oh, for sure. It matters. And by the way, it's not just oil. I think we should also mention aluminum prices because they had their best month here in years, spike up. Alcoa's up again. You know, I got this chart from Coors, the beer maker, because this is going to impact their earnings. It's what they pay for cans, and it shows you the Midwest premium on aluminum. And that's essentially a gauge for, you know, what they pay in this country. And you can see just how much it's outperformed and how much the price has risen compared to some of the other metals like copper and gold. And that's why it's going to be painful if that's one of your main input costs, like a beer maker.
Yeah, we're starting to look at surcharges. I know Maersk introduced a temporary surcharge today, the big shipper. JetBlue, the first major airline to charge extra for bags. So the gasoline component does bleed into other areas that aren't actually about purchasing gas.
Sure.
Meantime, Warren Buffett joined Becky Quick on Squawk this morning, gave his take on some of the recent market weakness we've seen.
3 times since I've taken over Berkshire, it's gone down more than 50%. I mean, if you look at the markets of, the worst probably was the 2007-8 period, although there was that one Monday when you had 21% in a day. I mean, this is nothing.
Joining us this morning to talk about all of that and more, Ed Yardeni, the president of Yardeni Research. Ed, welcome back. Good to have you.
Thank you. Thank you.
And now you're seeing it right now, team. It took an extra candle, but I said this is setting up for a beautiful 3-candle reversal with the hangman in the middle. We got a small hangman, then a big hangman, then a doji, and now she's coming down. And again, like I said, if she starts trading below 641.2, she's out of here. We're at 641.5 right now. If she gets below 641.2, she's out of here. So I did the right thing, hesitating and not getting in or chasing that move. Looking for the larger confirmation.
Setting up for a ground offensive expedition, if you will. Not permanent occupation, but it could be a move to free up the straits and free up Carg Island. So I kind of find it hard to believe he's just going to pick up.
There's a 641.2. The mark is out of here.
In the current mess.
Ed, we're just in the early innings.
1 minute left before she closes. If she closes below the 641.2, she's out of here. Even more.
Job openings, which are
Bears have moved the line down to 641.2. Bulls are trying to get it off from that area.
But what's your sense of the impact of
The 950 and the 955 candle, both these two candles will have to cover
been,
that could create a domino effect right into the 945 bullish candle if she closes in less than 1 minute underneath 641.2.
territory. And I think it kind of reflects the consumer as well. I think consumers have also been remarkably resilient.
The bears know it. They're making an effort. They're pushing. 30 seconds left.
Since the beginning of the decade, we had the pandemic and we had lockdowns. We had inflation. The Fed.
This is reading real, true price action.
I think
Live as it happens. Understanding the bulls, understanding the bears.
That survey is very sensitive.
Being able to look at the size that's being put into this.
It shows that the
10 seconds left.
on the labor market that we got when
Last minute effort by the bulls.
were weak. I think on balance, you kind of average them together.
Bulls got in line at 23. Is it going to be enough? No, it's not.
It's okay, and we may actually be creating.
It's not enough.
Back to kind of normal.
So glad we did not get in that call, team. So glad we did not get in that call.
Everyone's expecting Friday's number.
And as for Q1 earnings, Ed, looking at another quarter of double digit, we've seen some strategists bring in their year-end target. Today it's Wells. They go 7,800 to back to 7,300. But I have to imagine you remain pretty optimistic about corporate earnings.
Yeah, I mean, basically we've had a PE correction here. The forward PE of the S&P 500 is down 16%. So it's been a correction in the valuation.
Did you bring in my energy drink?
On the other hand, the market's down 8%. So that forward earnings are
Not even in the car?
8%. Earnings have been remarkably strong. Analysts did not get the memo about the war in Iran possibly causing a recession, and so far I think the economy's resilience is being demonstrated in the resilience of earnings forecasts.
You think finally that the 10-year at 4.4 is a short-term top?
It might be. It's so much is so dependent on headlines, and the headlines mostly about what Trump is saying. And as I said, a lot of this could be head fakes. But I'm thinking the 10-year bond yield is going to be somewhere between 4.25, 4.5, 4 3/4 for the year, kind of in a range. I think bond yields are back to normal, where they were before the great financial crisis.
And good stuff, as always. We'll talk to you more as we get further into earnings season. And Yardeni.
Here's our roadmap for you for the rest of the hour. After the break, what Jensen Huang just told us about NVIDIA's $2 billion investment in Marvell and what he says the street is missing this year in the NVIDIA story.
Plus 3 sectors to buy in the second quarter. Trivariate's Adam Parker is going to give us his picks. This as we wrap up what's been a rough first quarter, at least for the Bulls.
And Hershey's
Dr. JB, good morning, buddy.
17% for the year so far. We'll talk.
Yes, sir. You haven't missed anything at all, Dr. JB. You haven't missed anything at all. Nice little run from the 640 to the 643. Topped out at the 643 and came on back down. I'm more so now looking towards the half and whole dollar amounts, Dr. JB. Looking at 10.15, 10.30, 10.45. Thanks. What was it?
I didn't see it. I didn't see it.
Huh? Jared, you still on here, buddy?
Shares of Marvell Technology, you can see right there, rallying off the highs, but still up over 6%. This on news of a new partnership with NVIDIA. It does include an investment by NVIDIA.
Jared Lewis, you still on here, buddy?
Marvell. NVIDIA CEO Jensen Huang joined us earlier on Squawk on the Street. He discussed the company's push to expand these kinds of partnerships.
Every one of these announcements, as you see, is an expansion of our ecosystem. Our partnership with CoreWeave is obviously
Jesse said he's looking for the market to go lower. Going to use smaller risk. I can understand that as well. Still in a little bit of state of uncertainty. Had a big move pre-market. Since then, out of the gate, we've gone from the 639 to the 643. Right back now to the 641.7. Still nothing clear or concrete as of yet. Continuing to be patient.
Missing, of course, NVIDIA stock down about 9% so far this year, rebounding ever so slightly today, but certainly confounding many investors given its low multiple versus a growth rate that many still applaud. Take a listen.
the market misses several things about NVIDIA. I think of course, because we are such a large company and we have such a large position of AI computing and all the AI infrastructure, a lot of people might think that all of our growth is all priced in. However, what is very clear is several things happened this last several months, in fact, maybe the last 6 months. We gained share. How is it possible that we're gaining share at a position that we're so large? We didn't have Anthropic exposure previously to this year, and now we're scaling with Anthropic. Our growth in AWS is accelerating. We just announced they're going to buy 1 million GPUs from NVIDIA in just about a year and a half or so. And so that's an enormous number of new GPUs. The number of customers outside of the clouds, the top 5 cloud service providers, has now grown to 40% of our company's business. Most people think that most of our business is in the cloud, but in fact, one of the fastest growing segments is outside of the enterprise, the industrial.
He went on, Carl, obviously we conducted the interview to talk about the total addressable market and enterprise software in particular. Said a lot of, I thought, interesting things in terms of how he sees that evolving and trillions in TAM, but the fact that margins for some of these enterprise software companies may come down as they really rely on AI for almost everything. So their cost of compute, in other words, for tokens, will comprise a lot of the value proposition for them. So he was talking about 50% margins versus higher margins now, but a much larger potential market for all of these kinds of companies.
Right. And of course, at 170, that's a price we first crossed last July. Jim this morning mentioned
we testing that 5-day moving average right now.
That doesn't start for a while. Yes. Not the current one at around 20.
Around 20 times right now, but that is still confounding to many out there who's sort of wondering. You heard Jensen address the question. Say, how can NVIDIA, one of the greatest companies of all time, given its growth rate, given its margin profile, be trading in only 20 years worth of earnings?
Down 9% this year.
Yeah.
It has really been a down year. I think also just the partnerships are so interesting because the companies that you would have typically thought as competitors. Yes. Maybe it's not head to head with the products, but just the fact that the ecosystem is becoming so intertwined and NVIDIA is just spreading its bets across friends and foes alike.
So many. You almost lose track. I was, quoting to him some of the public company. They file a 13F. They own, of Synopsys and Nokia, obviously.
All right, and Kosi with the 641.50 entry. Set a trail and stop on that. Said he'll be back tomorrow. Good trading, everyone. Thank you, Kosi, for stopping by and sharing that trade with us.
But he did mention that as a catalyst for the business, the fact that they started working with Anthropic this year.
The positions are large in the sense of they're many billions, but for the company, obviously, that has a market cap of some $4.1 trillion, they're not that large.
Right, but it just gets to this whole circular question as well. If there is a rethink of the bubble and just how much is being spent, just how interconnected and concentrated this trade has become, with another $2 billion deal here.
Yep.
Both stocks working well today. Still ahead, the CEO of Hershey is here at Post 9 to break down the company's new strategy for growth. Shares are already up double digits this year. It's been a big winner. Plus, as a rough Q1 closes, Trivariate's Adam Parker here with his top picks for the second quarter. But first, Mercedes is looking to accelerate in America in a big way. The company's U.S. CEO joins us to break down those ambitions next.
Mercedes unveiling 2 refreshed models at its plant in Alabama today. The luxury automaker plans to invest more than $7 billion into its U.S. footprint, all in an effort to reach 400,000 annual car sales in the U.S. by the end of the decade. CEO of Mercedes-Benz USA joins us this morning alongside our Phil LeBeau. Morning, Phil.
Good morning, Carl. Adam Chamberlain.
Good morning.
We're on the line, literally on the line with the GLEs rolling off.
Feel the energy in here.
And we're going to talk about the new GLE and GLS in just a little bit. But first, I want to talk about the goal of increasing sales basically by about 30% by the end of this decade. How do you do that?
Yes, sir. Well, first of all, you have a really great product portfolio. And if I look at our product portfolio and think about our core cars, GLC, GLE, GLS, we see significant opportunity to grow the sales of these cars. We then work in lockstep with our dealer partners. One of the things I've been really keen on trying to do, Phil, is simplify our approach with our dealers to keep them focused on selling cars, parts, and looking after customers and delivering a great client experience. So that's at the fundamental principle of our plans.
About 60% of what you sell in this country is imported and are subject to tariffs. So we're coming up on the 1-year anniversary of Liberation Day when the tariffs were put in place. And that's cutting into your margins. Are you worried that that is going to be tough? It's going to be tough to increase sales given that tariff headwind that's there?
Great question, Phil. I think one of the things we've really consciously tried to do is look at our competitive position. So, for example, since tariffs have been launched, we've only increased our prices by 1.3%, significantly less than inflation. We've been laser focused on growing our overall volume towards that plan of 400,000. And to do that, you have to be super competitive at the point of sale.
But that comes at the expense of margins, which are going to be under pressure.
So it takes a hit on us as a company, but I believe the bigger goal is to grow our volume and recover that margin through volume.
You take over Mercedes USA after a stint running Lithia, the auto dealership group. So you know what the dealers are going through, and you know what your dealers are hearing from the consumer. Are you sensing any kind of a slowdown in consumer demand, any hesitancy with the consumer?
I think if you look at the market in the first couple of months of the year, the market environment is definitely a little tougher than we'd anticipated. I think there's lots of distractions out there, whether it's geopolitics and everything else. I think what we have to do is be laser focused on ensuring we have super competitive positions for our products. And right now, if you look at our lease and finance office, we've never been more competitive, and make sure we declutter the space for our dealers to focus on giving a great customer experience.
But to get back to my question, are your dealers saying to you, look, people are getting a little more hesitant out here, or are they not seeing that right now?
I think they're seeing a little bit more confusion, and I think there's a little bit more hesitancy, but I think overall, we saw this morning, the consumer confidence remains relatively robust, and energy, whilst important, is still a relatively small share of the wallet. So I think our job is to declutter the environment and help our dealers have a great kind of experience.
You've been in this business a long time. You've seen gas prices go up and down.
Yes.
$4 a gallon, is that much of a headwind to make people think twice about buying a car, or does it have to get up closer to $5 for an extended period of time?
I think in the short term it's manageable. And we've seen before at $4 a barrel we can sustain that. But I think over a 90, 120 day period at closer to $5, it starts to become a bigger distraction. I think the other thing though we have to focus on is actually we've now got super efficient engines, whether that's our combustion engines with 48 volt technology, we've got plug-in hybrids, and we've also got new generation electric cars. So to a certain extent we can offer alternatives for the consumer that are less impacted by gas prices.
Quickly want to ask you about the new GLS and GLE. They're refreshed models, but this is critical for your growth, correct?
Absolutely. Absolutely. The GLE and GLS are core. The GLE was our biggest selling car last year, and it actually had its best year ever last year, and so far this year, sales of GLE and GLS are up over 30%. So we're super excited about these new cars, which have great levels of refinement, next level advanced driver assistance systems, and great technology in the vehicles.
Adam Chamberlain, CEO of Mercedes USA. I'm glad we're on the line.
Phil, thank you.
It's good to be here. Guys, we're going to send it back to you from Vance, Alabama.
Okay, thank you very much, Bill LeBeau. Also, Mercedes is crushing F1 season this year so far with the new rules. Maybe that'll help with the brand image. Speaking of American investment, do not miss CNBC's Invest in America Forum. Just a little over 2 weeks away, Washington, D.C., April 15th. We've got a blockbuster lineup of high-profile CEOs, companies like ARM, FedEx, U.S. Steel, Apollo, Hyundai. You can go to cnbcevents.com to learn more and request an invitation. But it really is all about what Phil was talking about there, and how foreign and U.S. companies alike are doubling down on some of the opportunities and some of the challenges that they are facing right now in this country when it comes to manufacturing, sales, AI, and everything else.
When we come back, CEO of Hershey's with us exclusively at Post 9, talk about the company's new strategy, their reiterated guide, and yes, the Kit Kat heist, plus details on the Unilever McCormick tie-up making headlines today. Dow's up 540. Don't go anywhere.
Another attempt. However, the reason I will not take a call here, because I'm not going to go against the 30-minute chart. The 30-minute chart is already showing us that the bears are in control overall in the last 30 minutes, even though the bulls have regained control of the week, even though the bulls have control of the day. This is now, as you look at the 2-minute chart, coming into a double top area, which really moves the point of entry now to the 643, getting above the 643. But also, even in looking and attempting to get in that, you have to reference the larger chart, because even this could possibly turn into a beautiful 3-candle reversal, because this is now a hangman on the 30-minute chart. And this is why we look and refer to the larger time frames. That's not to say that it won't turn around or it can't go up, but it's not an obvious trade. Going against the 30-minute, seeing that this now has turned into a hangman, that's not an obvious call. Getting above the 643, that would turn into a potential call.
Welcome back. Hershey holding its investor day here at the New York Stock Exchange today. The category facing mixed demand as volumes come down from COVID-era peaks. Cocoa prices remain volatile, and a push in Washington to make America healthy again. CEO Kirk Tanner joins us now to discuss all of it. Welcome. Good to see you.
Thanks for having me on.
It's great to have you on. Actually, Hershey has been an outlier, I think, in the consumer packaged goods and food category, growing nicely, stock up double digits. Why is that?
Yeah, we're going to talk a lot about that today with our investors. For us, it's all about leading the next generation of growth. The confection category is resilient and growing, and we're growing with it. And it's a combination of our core brands growing. Hershey and Reese's are doing exceptional, but innovation is also important. And so we're sprinting into some of those spaces that give us higher growth. In addition, our salty snack business is doing exceptionally well because it's positioned in permissible snacking, and that's what consumers are looking for. So we have a very unique, relevant portfolio today. That's driving the growth.
Do you think that the confection category is different than other packaged food companies when it comes to being in the crosshairs of, concerns about artificial ingredients and high sugar and all the health push that's been around for a while, but is also being more formalized now by this administration?
Yeah, I think that the category is incredibly permissible because it's used as a treat. It's that emotional reward that we have. The average American eats 40 calories a day of the category, so it's not a huge amount. It is definitely a treat. That's made it resilient through time. Other things that we're looking at the portfolio, like artificial colors, we were the first to lean in on that, so we will remove artificial colors, and we continue to look to deliver across our portfolio for what consumers are looking for.
Artificial colors, but what about artificial ingredients? How critical are they in the supply chain?
I think making your ingredients as transparent as possible. Every ingredient in your product has to earn a place on the ingredient panel, and that's how we look at it. We look at what consumers believe and how we deliver against that.
What are consumers telling you right now, especially in recent weeks with the rise in gas prices? Have you seen any change in behavior?
Yeah, well, a couple of things we think about. First, I think about our supply chain, so how well are we protected? And we're covered well through 26, so I feel good about that. Then we look at the consumer, and I look at the convenience channel and how our immediate consumption products are selling, and they're holding up well. So they're in the mid-single digits. So right now, this impact has been pretty modest, and we feel good about how we're covered from a commodity standpoint.
No cutback, I guess, in spending at convenience stores.
No, that's right. No.
Do you think because of the category, or generally consumers in good shape as you assess them?
I'm speaking about the category, and our business in that category is doing well. So we'll continue to keep an eye on that. There's so many things that drive consumer sentiment and consumer behavior. We're obsessed with the consumer, and staying close to that is important to us.
We've been talking about GLP-1s and the potential impact on companies like yours for quite some time already, but they aren't going anywhere. In fact, the oral formulation probably means they're going to be more widely used. How are you structuring the portfolio to sort of meet what may be those changes in consumer demand?
Yeah, I think that's a great question. How do we play offense? We know that GLP-1 consumers are still enjoying the category, but we're driving portion control. We're also leaning into some of our other portfolio like Skinny Pop and Lesser Evil. GLP-1 users love popcorn. It's not filling, it's not satiating. You can still have that snack. Our refreshment portfolio around icebreakers is also a product that GLP-1 users are looking for, that refreshment in our gum and mints. So we're playing into those spaces. We're also innovating in that space. So we've put a lot of innovation resource against building our protein portfolio, our functional portfolio. Those are going to be important aspects to the lives of those consumers on GLP-1.
Do you feel like you've answered investors' concerns then? Obviously, it's a number of years ago that we started to see the decreases in some of the stock prices initially.
Yeah.
And I'm sure you've gotten endless questions on it. You've obviously started to answer it with decisions, but do you feel like you've sort of dealt with it, so to speak, or is it going to be something that always you're kind of dealing with?
Yeah, I think you have to look at the facts. Look at the category growth in the last 3 quarters. It's been really good, exceptional, compared to other categories across retail. And then you see the innovation that's happening and the offerings that consumers have available to them. I'm bullish on where we can go by meeting the needs of the consumer and still growing this category. But the growth is the growth is there.
Is the backdrop constructive to take some price?
Well, we took a huge impact in 25 and 24 with the price of cocoa. We were very patient with the pricing that we passed on to consumers. In fact, we didn't pass all that pricing on. We wanted to protect consumers while we invested in the business so that we could come out of this even stronger. So we invested in brand building, we invested in innovation, so that when we come through this, as cocoa comes down, it takes pressure off pricing, but we've also invested in our capabilities for future growth, and I think that's really important.
Is the business getting less or more seasonal by holidays, Valentine's, Halloween, and all of that?
Well, seasons are critically important. We're executing what we call these tent poles. There's other moments during the year, like NCAA that we're doing right now. Hopefully you got to really steal it with your bracket. I don't know, that game.
That was tough.
The Connecticut Duke game.
Yes.
I chose all of the Final 4.
Did you?
Just
Are you
to tell
kidding me?
Why
wasn't that the lead of our show today?
Oh my gosh, you should be doing a segment on that.
I'm at number 1 in my group, just to tell you, though I need Arizona to win.
So we got distracted, but that's a tent pole moment where we activate that in store with Dots and Reese's.
Now you guys can see clearly
your birthday with our brands. We're going to
what I meant. If you're looking at your 30-minute chart, setting up as a beautiful 3-candle reversal with the hangman in the middle on the 30-minute. This is even larger. A put below the 640.7 would be ideal, especially if we get a close below here and then a continuation candle breaking the 640. That will put us back red for the week. That would also put pressure on all of this morning's bulls. Very critical position to be in right now. Glad the rest of us are on the sidelines watching this mayhem unfold. The double top held up. We did not break that 633, that 643, which is what we would have needed for a continuation on that 643. We did not get it. Looking at the larger time frame, she is now coming into a 3-candle reversal straight out the playbook with a hangman in the middle. Could get real ugly, real fast, breaking below the 640.3 area.
Complement our portfolio. I think that has been our focus. We've got a recent, really good track record with the acquisition of Lesser Evil, most recently, Dots, Skinny Pop. Those have proven to be real winners financially and have the right returns for us.
Somebody just stole a lot of Kit Kats.
Yes.
Do we know why? Do we know where? Do we know what they're planning to do with them?
No, that's unfortunate that happened, but that's a high value item. It's like a little bit of gold. Kit Kat is a great brand for us here in the U.S. Yeah, I'll have to say that's unfortunate that happened.
Is it your most global brand?
Well, inside the U.S., it's a Hershey brand. Outside the U.S., it's a Nestle brand.
Right.
Yeah.
But is there a supply shortage of Kit Kats now?
No, we manufacture Kit Kats right here in the U.S.
Okay,
And
thank
Kit
God.
Kat is going to be one of our next billion-dollar brands. It's a real treasure that we love, that's growing, that consumers love.
12 tons of Kit Kat.
Yeah, that's
I mean,
about
that's
a
like
trailer.
crazy.
That's a semi-truck full.
Between Central Italy and Poland.
Yeah, the Italian job.
All right. Well, Kirk, thank you for joining us.
Is that going to be the Hershey movie, or you combine the two?
We're not going to put that in the Hershey movie.
Okay.
Thanks, but
Next advertising campaign?
They say it's in the can. That means it's done.
Oh, it's done. Okay. All right. We look forward to that.
Kirk, good luck today. Thank you for joining us
very
ahead of
much.
the Investor Day.
Yeah,
We appreciate it.
All right.
Kirk Tanner from Hershey.
We mentioned it earlier, a multi-billion-dollar tie-up in the grocery aisle today. We'll talk about McCormick's plans to combine with Unilever's foods business in a moment. Busy day for M&A overall. Got some of these biotech takeouts involving Lilly, buying Centessa in a $6.3 billion deal, and Biogen buying Apellis for $5.6. Stay with us.
All right, got a big deal today involving Unilever and McCormick. Unilever spinning off its food business, which includes names such as Hellmann's mayonnaise, into McCormick. It's what we call a reverse Morris trust, meaning it won't be taxable to Unilever shareholders. Unilever then becomes a much purer play in HPC, sort of that in the healthcare area. Dove soap, for example, one of their key products, and many others as well. And it's a huge deal in terms of where the companies are being valued for the purposes of the transaction, some 13.8 times each of their 2025 EBITDA. So that has the effect of saying, okay, Unilever's business is valued at $44.8 billion, and McCormick, we're valuing you for the purposes of the transaction at $21 billion, even though the market was not valuing McCormick there, but it's on its way. given where the stock price has fallen to. As for the consideration of the deal itself, McCormick pays $15.7 million in cash. That's part of it. So they're going to borrow that. Their leverage ratio goes up. And then there's a lot of stock changing hands. So if you're a Unilever shareholder, you end up owning 55.1% of this combined company. And then Unilever itself will own 9.9%. It will be selling that down over time as well. Expected close in 2027. And with that leverage ratio, Sarah, 4 times, you better get some cost synergies. And they're talking about as much as $600 million a year after they reinvest in terms of growth initiatives. But the market just doesn't love these kinds of transactions.
Well, I think the whole packaged food space is troubled, which is why you see deals like this to begin with, aside from the conversation we just had with Hershey. But I just wanted to take a moment and sort of zoom out on Unilever and give some credit here where credit's due. So activist investor Nelson Peltz took a stake in Unilever in 2022, joined the board. Remember, he used to be on P&G, helped turn around that company, and then went to their big competitor, Unilever. And since then, I mean, there have been a number of moves. This company is completely different. They've been through 2 CEOs. Peltz, helped have a hand in the new CEO. And then in December, they spun off the ice cream business. And now here, spinning off the food business. So it's a completely changed portfolio and company. And actually the underlying growth, David, for Unilever now is outpacing that of one of its biggest rivals, Procter & Gamble, something that I think a few years ago a lot of people did not think was possible. And Unilever it looks different. It's beauty brands, it's a lot of the health brands.
Right.
Dove, obviously, and some new marketing campaigns behind that is helping the growth there. But just the complete remake of the portfolio, I think, and the leadership after Peltz has gotten in here, I think is something worth mentioning in one of the stories.
Yeah, it's part of it. Now, that said, I'm sure Nelson's not particularly happy with an 11% return over the number of years that he's been on the board at this point.
No, and
that's not exactly
it was all about speed
a reason
for
you
a
get
while.
involved. So I would assume the hope is that all the different moves that have been made will now, not today, of course, but over time,
help the
result
company
in a
grow
far
faster.
higher
More focused
growth rate and the performance of the stock, which again, I haven't looked at it versus the group, Sarah, so I can't put it in perspective. And as of course we know, they have different.
Been great.
They had different businesses, now much more pure play. So I'm not even sure what you compare it to.
I mean, you can compare it to Procter & Gamble, and you can see that it has outperformed over the last year, as it has its underlying growth is around 3.5%. P&G's is around 2% right now. So that's the hope, right? That and I think that's why maybe it took a few leaders in there, that there's been a lot of change in terms of the CEO. But now, about a year ago, they brought in another CEO and started really making some of these portfolio changes. And yes, the idea would be, like what we saw at P&G, a more slimmed down playbook on key brands will help.
I do wonder whether, do they ever get in the acquisition game? Their name was around, I remember even like Kenvue a little bit. There ain't been any, by the way, don't know.
Remember the failed Glaxo?
Yeah, so it is interesting to see whether they also choose to go on offense in any way in terms of doing deals.
Big questions,
buying instead of divesting.
Still to come this morning, the Q2 playbook and the sectors you might be looking at. Trivariate's Adam Parker is with us with some contrarian calls. World Bank's out with its first read on the global impact of the Iran war. The group's managing director will join us with those findings as we are off the session highs, 64.22. Be right back.
Welcome back. Stocks, you can see, rallying this on the final day of what's been a downbeat quarter, at least if you're bullish. The major averages still pacing for what would be the worst quarterly performance we've seen in years. Let's bring in Trivariate Research founder and CEO Adam Parker, get his second quarter playbook. All right, so what do you make of this quarter, and what does it mean for the next one?
Hey, David, how are you? Look, we came into the year with a view that the market multiple was much more likely to contract than expand. And that was because we just didn't think that the Fed would be as accommodative as consensus. We didn't like that every single buy side and sell side year outlook was bullish. And we just felt like gross margins for the average company were not going to go up. Obviously, I guess we'll give ourselves right for the wrong reasons. I didn't know, obviously, there was going to be a war, and that would cause pretty negative contagion. But the median company's gross margins are down meaningfully, and likely going to be impaired somewhat by higher commodity prices. So right now, sentiment, of course, is much more negative. Which always happens, right? Trailing 2 or 3 week price momentum impacts people's moods. I actually think the earnings season is going to be okay, and I wouldn't be surprised if we got some stabilization. The risk, I think, is more in the second half of the year to the numbers, where there was a hockey stick in expectations even before February 27th. And one of the behaviors I'm really concerned about, David, is that the penalty for missing estimates has been way harsher than the reward for beating. And we've even seen big beats like Micron and NVIDIA not be rewarded. So I'd be a lot more bullish if I could get somebody guiding flat or just in line, or somebody missing and the stock acted well. But I think we could be, have a better earnings season than the current negative mood.
Yeah, well, one of the features of this last quarter certainly has been the performance of software companies, software as a service. I mean, we were just showing some of the names. Right. It's astounding in terms of the loss of overall value as a result of concerns that AI is basically going to completely destabilize their business models. I'm curious, do you see an opportunity there? And by the way, I would add Microsoft stock down 25% in a quarter, Adam, a staple for so many portfolios.
Yeah, I'm pretty negative on software, David. Look, we've had a good market call, but my own self-assessment is we had pretty crap sector calls this first quarter. One thing we've gotten right has been to be negative on software. Our logic is that if you're going to own software, it probably should be the expensive ones that are growing faster. We just published a pretty deep dive showing that cheap software stocks that have low forecasted growth expectations really underperform. So if you're going to sort of hunt in software because you think there's some good assets that are oversold, I think you want to buy the expensive ones because the market average is right to keep them expensive. That leads you to more like security, Palo Alto, et cetera, than it does maybe Salesforce. So I don't really like software. I feel like what I know, David, is when multiples come down like this, eventually the earnings miss, and then way down the line the sales missed. And the analysts are anchored to saying, oh, I called the CTO of a big company and they think the sales are good. That's not the point. You need accelerating sales, and that's really unlikely. So I'm really cautious on software, and I think it'll underperform over the next couple of years.
Adam, I feel like one of the keys to shaping your Q2 portfolio or your outlook from here has to be whether you think we're going to have sustained period of inflation or not. I mean, that feels like the debate in the market, in the economy, that'll affect the Fed and it'll affect the multiples and just how and margins and earnings growth, right? I mean, that's the question that people. I don't feel like there's any sort of consensus on. Yeah, maybe that the oil spike won't last, but how much underlying inflation will it spread?
Yeah, I mean, I always view it like two-sided, and nice to see you, Sarah. So one is the multiple action from the Fed. We came into the year, I think, thinking that the multiple would contract because even if the Fed was accommodative and they cut a couple more times, it's the opposite of 3 years ago. Everyone said, oh, they're only going to hike 1 or 2 more times. The multiple started expanding because you saw accommodation coming. Well, no matter what, we're all like, toward the end of the accommodation cycle, I think. So I don't think the Fed can help the multiple at this point very much. And I think you're just down to the earnings. The current bottom-up sell-side expectations are actually for 17% earnings growth right now for 2026. Let's say the earnings are 12. Let's say they disappoint. 12% earnings, a market down, 6 at the current moment, plus or minus. That's a decent amount of multiple contraction. So I think for the market to end up flat or up this year, all you need to do is deliver kind of double-digit earnings with the belief that 27 earnings are above 26. That doesn't seem crazy to me, but you probably need to get people calm down a little on the consumer impact, as you point out, from rising oil and inflation.
Adam, I'm going to leave it there for today. I always appreciate it.
Yeah, good to see you guys as always. Take care.
Meantime, one Wall Street firm cutting its Tesla price target by triple digits. The analyst is behind that call, is going to join us when Money Movers begins as we continue to lose a little of the gains here. Once again, bulls trying to hold 6,400 by a few points. Back in a moment.
Good Tuesday morning. Welcome to Money Movers. I'm Sarah Eisen with Carl Quintanilla live from Post 9 of the New York Stock Exchange. Today, as the Iran war lingers on, so do the potential for negative economic impacts. The World Bank calling it a serious multi-front challenge. We'll discuss with the bank's new managing director.
Tesla shares on the move today. A big price target cut over at Canaccord as the rest of the Mag 7 pulls back this month. We'll discuss with the analyst behind that call this hour.
And big moves in the pharma sector. Both Eli Lilly and Biogen announcing deals to boost their product pipelines. We'll explain.
We wrap up the month and the quarter today, one of the worst in several years, although trying to put a nice finish on it at least. Dow off the session highs. S&P once again trying to defend 6,400. 10-year has gone up a bit or so in the last couple of hours to 432. And consumer staples have joined utilities in the red.
So ending tough quarter on a high note, at least for now, up 1%. We'll start with the latest in Iran. Both the president and the defense secretary with new comments this morning. Megan Casella is with us from Washington and has more. Megan, welcome back.
Hey, Sarah, thank you. Happy to be back and good morning. But that's right, the Trump administration today forcefully pressuring NATO allies to get involved in the military action against Iran. As you said, both the president and the defense secretary, Pete Hegseth, this morning are suggesting that NATO countries should be taking action to secure the Strait of Hormuz.
there are countries around the world who ought to be prepared to step up on this critical waterway as well. It's not just the United States Navy. Last time I checked, there was supposed to be a big bad Royal Navy that could be prepared to do things like that as well.
Now, Hegseth went on to say that since the U.S. uses the strait dramatically less than most countries, the world ought to be, as he put it, prepared to stand up. Those comments coming just after the president posted on Truth Social earlier in the day that countries that can't get jet fuel because of the strait should, 1, buy it from the U.S., and 2, build up some delayed courage, go to the strait, and just take it. He added, quote, "You'll have to start learning how to fight for yourself. The USA won't be there to help you anymore." And guys, all of these comments appearing to confirm some news we got last night from the Wall Street Journal, which is reporting that the president has told aides he's willing to end the U.S.'s military campaign against Iran, even if the strait remains largely closed. The Journal says Trump had decided in recent days that a mission to reopen the strait would push this conflict past his desired 4 to 6 week timeline, so he could instead begin to pressure allies to take the lead on reopening it. That appears to be what we're seeing play out publicly this morning. Guys.
So when do we expect some sort of official word on that, or is it just as these updates come?
As these updates come, at this point, they say they're continuing to work towards a deal. They want to work diplomatically, work on negotiations, but that they are, of course, as they have been saying, preserving their options for further military operations if they need, including boots on the ground. For now, they're still working on it. You know, Hegseth, I will say, also sort of downplayed the 4 to 6 week timeline, not wanting to put as fine a point on it, saying he didn't want to telegraph too much to the Iranians on what was coming next. So we continue to take this as it comes, but I do think as we see them publicly pressure allies to get more involved, it's clear that that's sort of the direction that at this point the administration is leaning.
Still waiting for any kind of clarification from the Iranian side that any discussions or back channel chats are happening. Meantime, the Pakistanis are in Beijing today, Megan, and there's some game theory about whether or not the Chinese and the Pakistanis might be some kind of guarantor of a deal.
Absolutely. We're seeing different sorts of sort of alliances emerge on this. The Pakistanis and the Chinese urging more peace in the region. The Iranians, as you say, continuing to deny that there are any negotiations at all. The administration has been asked about that repeatedly. They emphasize that, you know, the Iranians are just speaking to a domestic base, and that they say, of course, there are real negotiations happening. We don't know exactly where or when those have been taking place, who exactly is involved, especially on the Iranian side. So waiting for more details on that, but the administration downplays that. They say just because the Iranians are denying that anything is happening doesn't mean there aren't real talks taking place. We're, of course, though, waiting to see more details on if that's true.
Megan Casella, thanks so much. For more on the war in Iran and the impact on your portfolio, let's bring in Phil Camparelli, portfolio manager at JP Morgan Asset Management, here with us at Post 9 Philly. It's good to see you. Good to see you. I guess short term, why are stocks behaving well today with oil about as high as it's been since the war began?
Yeah, so first off, I think there's been a lot of positioning capitulation. So a lot of people have kind of, I think Goldman reported that hedge funds have sold the most U.S. equity in the past decade, a short of only 2 times. Yep. One was Liberation Day and one was COVID. Listen, Carl, there's a ton of noise out there right now. There's a couple of small victory signals that we're taking. The first is a globally diversified portfolio, which I stand by. Through yesterday, down about 3.5 versus the S&P down 7. So diversification is still working. And Jerome Powell really made my day yesterday because he said that, you know, beyond the near term, inflation expectations are well anchored. I mean, that was like music to my ears as an asset allocator because oil took the bond market hostage in March and there was nowhere to hide behind buying oil or energy stocks or buying the US dollar. So I think that the right way correlation between stocks and bonds has its chance because the Fed doesn't make decisions based on today's inflation. They're looking at longer-term inflation expectations to make decisions. And I think he threw cold water on any notion that they would have to hike policy in the near term. Now, they're not going to ease rates. There's no reason for them to ease rates. Every meeting is a cost-benefit analysis. Does the benefit of a cut in rates outweigh the cost of potential policy error? I don't think they ease
Stephen
rates.
Myron thinks that there's lots of reasons to cut rates right now, and the main one is the labor market, which is part of their mandate.
Yeah, Sarah, my favorite piece of data, 8:30 every Thursday, initial jobless claims, is still showing strength, and that unemployment rate is close to 4%. We also think, we haven't reduced any U.S. equity this month. We've reduced EM because there's some uncertainty around global growth. We've reduced a little Europe because Europe is energy dependent when it comes to natural gas. We believe that this U.S. economy, this version in 2026, can be as insulated to oil price spikes as it's been in recent history because the top 20% of earners only spend about 2.5% of their income on energy. And that top 20% of earners determines success or failure on the U.S. economy. They do 60% of the consumption. So for right now, the combination of the Big Beautiful Bill Act, $150 billion of stimulus, offsetting, moves in energy prices, and the top 20% being less vulnerable to moves in oil prices, we have about a 2% GDP forecast. Before the crisis, it was 2.4. We're still above trend, and we're still expecting double-digit earnings growth. We don't want to be cavalier about this, which is why we've reduced non-U.S. equities. But as far as the U.S. economy goes, still very low probability of recession.
Right. Although the bottom 80% of earners might say, hey, what about us? I mean, you would expect the K to get broader, yes?
K to get broader. The bottom 20%, Carl, conversely, about 17% of their income is spent on energy, right? So they are definitely being adversely affected. Maybe the Big Beautiful Bill Act helps them on the margin a little bit, but back to the labor market. That's the most important thing for the top 20%, and they're still spending it.
Yeah, JOLTS data today, the layoff rate's 1-1. I mean, AI fears, margin fears out of the war. Would you expect that number to go higher?
No, I think this labor market is really insulated. We really do. And again, I think it has part to do with immigration and the labor force being a lot smaller. So if you let people go, it's hard to find people to come back in. But, this is not yet an economy that we think is at risk of recession. Recession is 2 consecutive quarters of negative GDP growth and 2 consecutive quarters of negative job creation, which I don't think we're close to.
So if you look at the worst performing sectors, quarter to date, year to date, same thing. It's information technology, financials, consumer discretionary, cyclical, sort of high beta. So are those the sectors that you feel best about in terms of leading us up?
Yeah, particularly in the U.S., Sarah. So we would expect that kind of pro-cyclicality to return. You got to make a big bet that the oil price at the end of this year is going to look like today's oil price. The forward market says about $75. We're expecting an average oil price in 2026 of about $85. So we're trying to be conservative here, and we still believe that that's going to be an above-trend growth forecast. Again, about 2.2%. So our real GDP forecast, inflation up higher, maybe a little bit above 3, but nominal GDP drives earnings, and 2 plus 3 equals 5. 5% nominal growth is still a pretty good environment.
You think we get a 2 on real GDP?
We do. We think real GDP in 2026 at about 2.2%. Down 20 basis points from where we were in February.
Right.
Yeah. So but Europe we've taken down by a third. Right? Yeah. So we've taken that down a lot more than the U.S. And again, that just goes to show the pecking order, the winners and losers. Like U.S., China, they could be relative winners here, whereas Japan, relative winner because they're throwing fiscal policy at their price caps on energy. So there are places that we think you can invest in, but the relative loser is probably Europe here with the information that we have.
Yeah, total reversal of fortune with Europe and EM.
Yes.
No doubt. Phil, thanks. Good to see you as always.
Let's get to our Julia Borston with the news alert here on Snap. Julia.
Hey, Sarah, Snap shares are higher, now up about 8.5% on a Bloomberg report that activist Irenic Capital is building a stake in Snap and sent CEO Evan Spiegel a letter outlining views it hopes could help boost the stock. Now, Snap board chair Michael Linton responding, telling us, quote, Snap welcomes input from all shareholders and regularly engages with investors on strategy, capital allocation, and governance. The board and management team are focused on building a more efficient, profitable business while investing with discipline in our long-term roadmap, saying we've taken steps to improve performance, strengthen free cash flow, and offset dilution, and will continue to evaluate actions that drive long-term value for all stockholders. See shares of about 8.5%. Sarah, back over to you.
Okay, Julia, thank you. We'll watch that one. Still to come, the World Bank laying out how it views the impact of the Iran war for the very first time. We are joined by the managing director, Pascal Donahue, with what he's hearing directly from the countries that are most impacted.
We'll get a look at the IPO pipeline. SpaceX expected to file imminently for its public debut. Venture capitalist Derek Capot will help us look at that when Money Movers comes right back. Trying to bounce off some session lows here. Let's get to our Seema Modi with a news alert on Oracle. Hey, Seema.
Hey, Carl, I can confirm from two insiders that Oracle is laying off thousands of employees. Notifications were sent out today. It comes as the company continues to double down on its massive AI bet, developing and leasing data centers across the country. As we know, it's gone to the debt market to fund these bets. Now looking at another option by reducing its workforce as a way to drum up more cash. In fact, there was a TD Cowen report last month suggesting that 20 to 30,000 layoffs would free up about around $10 billion. We're looking at the stock up just about 3% here. More as we get it, guys.
Okay, thank you, Seema, for confirming that. Another news alert here out of Washington for that. Let's head back to Megan Casella. Megan.
Hey, Sarah. So both Iranian state media and Reuters are now reporting a statement attributed to Iran's Revolutionary Guard Corps. They're saying that the IRGC is threatening to target 18 U.S. companies, tech companies based in the region that have facilities in the region by 8 p.m. Tehran time on Wednesday, April 1st, in retaliation for this ongoing military conflict. So I'll say the 18 companies listed in this threat include Microsoft, Google, Apple, Intel, IBM, Tesla, and Boeing. And a quote, according to Reuters, from this IRGC statement here, quote, "These companies should expect the destruction of their respective units in exchange for each terror act in Iran, starting from 8 p.m. Tehran time on Wednesday, April 1st. So that's something to watch here. A dramatic escalation if we do see that come through. I'll say, guys, that we had seen some of these threats before, but now they are attaching a specific date to this possible, they say, destruction of tech companies with some headquarters in the region. Guys.
Yeah, hard to make sense of where the negotiation stands with the threats like this on both sides. Thank you very much, Megan. Megan Casella. Joining us now with the World Bank's first response to the war in Iran is Pascal Donahue. He is World Bank Group Managing Director, Chief Knowledge Officer, was the former Finance Minister for Ireland. It's nice to see you. Welcome.
Good morning, and thank you for having me on your program.
Thank you for coming on, and it's good to do it in person. So, at the World Bank, I think of the World Bank, and they, with a big poverty focus around the world and helping countries that need it most. How are you looking at the impact of this war?
So what we are doing is looking at the effect the war could have all over the world, but particularly in emerging and developing economies. We're looking at what it will mean as an income shock, and we're looking at what it will mean from a supply point of view within these economies. And critically, it's not just about analysis, it's now about engaging with countries to look at how we can be of support in the short term in dealing with the emergency, in the medium and long term in helping with a recovery.
So who is in emergency right now?
So at the moment, it's difficult to form an assessment in relation to this. We're clear that all countries are being affected by it. The scale of the effect that they will face will depend on the scale of the consequences that are emerging from the Middle East and from the duration. We already know that countries will be affected from an inflation, a jobs, a food security point of view. It's our role to advise on the best policies to respond back to that, and then to look at how we can use our financing ability to be upheld from a jobs and economic recovery point of view.
So you guys are gearing up, it sounds like.
We are doing an awful lot of work at the moment. That work has been underway now since developments in the Middle East began to intensify. And as you know, governments of the world will be coming to DC the week after next to engage with us and with the IMF. And at that point, our plans will only advance.
We are beginning to see some reports of fuel rationing in countries like Indonesia, some driving curbs in countries like Korea. But I think that the most dire scenarios involve food, right?
So we're looking at all the modelling regarding what this can mean from a food insecurity point of view. There are already 300 million people across the world that are affected by this. This is very likely to grow. So what we are already doing is looking at what policy advice that we can offer that can make a difference in this kind of situation. but looking at the balance sheet that we have as a bank, how we can use investments and how we can use loans to make a difference. And unfortunately, what is very obvious is we need to prepare for very difficult scenarios and look at how we can intervene both now and in the time after this moment of difficulty has peaked.
I wonder what you make of, I would argue our markets here are trying to take a more sanguine view than, say, Christine Lagarde, who thinks that this shock is going to bring us consequences that we really can't even understand yet. Do you agree with one side more than the other?
So the way we are managing that is looking at different scenarios. We've looked at 3 different scenarios that we think could occur that are based on what will be the duration of the shock, what will be the impact on supply chains, and what will be the impact on pricing on energy. At this moment in time, it's difficult to forecast with exact certainty what scenario we'll be in, but what we know is with our engagement with governments in emerging and developing economies, this has real consequences from an inflation, a jobs and food security point of view. And it's our role to engage upon this issue on behalf of our members to look at what difference can be made, and I believe we can make a difference.
Do you guys have a point of view on the war and whether the U.S. and Israel were right to go after Iran? Its nuclear stockpile, its missile stockpile.
So all the governments of the world, including those, are our shareholders. And the job they have given us is economic development and jobs. And that's where our focus is.
I figured you'd say something like that. Just had to ask. So how does this supply shock compare to some of the, I mean, we had COVID supply shock. We've had all sorts of bumpy times, I think, when it comes to shortages and inflation issues in the last few years.
So I think what is relevant from the COVID experience that we had is that the duration of the COVID shock can make a huge difference to what it means from supply chains and inflation point of view. And likewise, our thinking about where we are is a key issue that will influence the aftermath of where we are at the moment, is what will be the duration of the supply and energy shock. That is what we are working with countries on at the moment. And then what our job will then be is, with the money that we have on our balance sheet that's made available to us from the governments of the world, to look at what difference we can make and to advise on the policies that we believe are essential at the moment to mitigate the economic effects that will cause many, many difficulties.
Is there a level of duration that gets you into a so-called danger zone in your view?
So, I mean, the best we can do at the moment is look at where we are from a month's point of view in terms of how many months this difficulty could be at a heightened level for. I think where we are at the moment is we can already see in many of the countries that we engage with. For example, I was in Ghana and Liberia there only a week ago, that the effects are already present within economies like that.
What did you see?
Well, they're already thinking about what this can mean from an inflation point of view, what this can mean from a fuel point of view. And what our role is in working with those countries is to look at jobs, because we're all about jobs. It's our North Star in terms of the work that we do, to look at what measures can be put in place to protect jobs that are there and help with transitions that may occur within those economies. And it is now the case that governments like that are having to consider very seriously, depending on the duration of the difficulties in the Middle East, what it can mean for their economic future. And our message to them is that we are here to play a very active role in this, and we are here to work with the governments of the world to look at the difference that we can make from a policy and financing perspective.
I mean, Carl mentioned fuel subsidies. Is there a mistake that government, like what would be the mistake for government to make in terms of policy responding to an oil supply shock like this?
So I'd look at it from a positive point of view in this case. You know, what are the kind of well-designed policies that can make a difference? And those are policies that tend to be targeted. They're policies that tend to be based on cash transfers to those who are on lower incomes. And they're policies that tend to be calibrated, that can vary over time depending on the intensity of the difficulty that we're in.
Okay, Pascal, thank you for joining us, giving us a taste of how the World Bank looks at all of this. And
thanks for having me on.
Seems like you have your work cut out for you. Pascal Donahue, World Bank Group Chief Knowledge Officer and Managing Director.
Still to come this morning, how NVIDIA's investment in Marvell today may show the AI trade is not a winner-take-all scenario. We'll talk about that next.
Plus, one Wall Street firm cutting its Tesla price target by triple digits. We'll talk to the analyst behind that call when Money Movers comes right back. Welcome back. NVIDIA with yet another investment in a key industry player. Christina Partsinevelos has that for today's Tech Check segment. Christina, another big investment here for NVIDIA.
Very big. The list keeps growing. The checks keep growing. The chip maker is putting $2 billion into Marvell technology, and that's why you're seeing Marvell shares up over 8% on the news. The deal really centers on NVIDIA's platform and lets custom chips plug into its infrastructure. Marvell designs those custom AI chips for major companies like Amazon. They actually compete with NVIDIA's GPUs, graphic processing units, but this partnership kind of flips that dynamic, giving NVIDIA a shot at a much bigger market. As the CEO Jensen Huang told us exclusively this morning. Listen in.
Together, we'll be able to address the customers whether they would like to use all NVIDIA gear or they would like to augment our NVIDIA gear with their specialized processors. And together, we're going to be able to address a much, much larger TAM.
And 10 being total addressable market. Marvell is just the latest, though. This month alone, NVIDIA has committed $2 billion each to Nebius, Lumentum, Coherent. Before that, $2 billion into Synopsys, $1 billion into Nokia, stakes in xAI, OpenAI, and Intel. So why the massive spending spree? Well, NVIDIA isn't just selling chips anymore. The CEO often reminds investors at every event that it's not a chip company, but rather an AI infrastructure firm trying to own the entire AI factory. That means locking in the suppliers that build the optical networking, the custom silicon, and the interconnects means those companies are financially and strategically tied to NVIDIA's ecosystem. NVIDIA shares are, of course, higher this morning, though the broader market is up as well, so maybe not necessarily because of this deal. The takeaway, though, NVIDIA is spending aggressively to make sure the AI build-out runs through its ecosystem, no matter whose chips end up on their racks.
The other interesting thing, Christina, was his discussion about the percentage of their business that is cloud or hyperscaler. His general view is that this market is broadening quickly to all kinds of areas of industrial economies everywhere.
Yeah, and the other point, too, to your point about expanding, he made a comment about margins possibly coming down for enterprise software. That is the first time I'm hearing him actually say that out loud. That is a big comment. What we know with software names like Oracle, SAP, their margins are extremely high because they're an asset-light business that relies on reoccurring subscriptions or licenses. So you're seeing margins anywhere between 70 to 90%. What Jensen Huang, the CEO of NVIDIA, is now saying going forward, every time a company does anything, there's going to be some element of AI and large language models involved, and with that, you're going to need the hardware, the energy, etc., to run it, which means margins will come down for many of these big software enterprise names.
KP, thanks. Important interview this morning with Jensen and Matt. That's our Christina Partsinevelos. Other big tech story of the day is Buffett on our air this morning with our Becky Quick. Becky asked about Berkshire's Apple position. Take a listen to what Warren said.
You've sold a lot of a stock that's done very well for you, Apple.
Yeah, well, I sold it too soon.
Yeah.
But I bought it even sooner, so it worked out. Yeah, I think we've made over $100 billion in that pre-tax.
Yeah. But you're regretting it? You say you sold it too soon?
No. I don't have any ability to predict what stocks will do next week or next month. And I will buy them if they're cheap. I'll buy a whole lot of them if they're cheap and I think I really understand the business. And Apple is still our largest single investment.
And you like it that way?
Yeah, well, if I didn't like it, I could sell it. I can. And I think it's a remark. It's better than any business we own outright.
Buffett went on to say Berkshire currently owns a railroad that's worth more than the firm's Apple position, which he expects to be more predictable, but that it, quote, doesn't earn the rate remotely on capital that Apple does. Talked about buying some treasuries lately, said he didn't know if he would cut if he were at the Fed. Certainly said if there's a big equity decline that they will deploy some cash.
Yeah, and sort of put this one in context and said this is not, this is nothing. But didn't seem that impressed by the opportunity set, right, overall in the market. Talked a lot about how they get called and pitched on deals all the time and say no because of the price. That's ultimately what appeals on price. And then on Apple, I do think he went on to talk a little bit about Tim Cook and gave him major props, saying basically he's a good guy and he gets along with everyone in the world. So obviously the Buffett vote of confidence in Tim Cook and Apple.
Yeah. Good to hear from him. Certainly, he's on top of it all. Hour-long discussion with Becky. Let's get a news update this morning with our Dominic Chu. Hey, Dom.
Good morning, Carl. Good morning, Sarah. So the U.S. Embassy in Caracas, Venezuela, has formally reopened after a 7-year closure. The State Department announced that normal operations have resumed now that significant repairs to the building have been completed. The State Department saying in a statement that it is a key milestone in strengthening our ability to engage directly with Venezuela's interim government after the ouster of then-President Nicolas Maduro back in January. A new report says the Trump administration is organizing an international summit focused on countering the left-wing movement Antifa. Sources familiar with the matter told Reuters the conference planned for this summer will convene global officials to discuss strategies for battling the group and encourage intelligence sharing. And sneaker maker Allbirds announced American Exchange Group would buy the company in a $39 million deal. The brand, known for its eco-friendly wool sneakers, was popular among tech executives in Silicon Valley, but struggled following its 2021 IPO. It briefly commanded a valuation of more than $4 billion. $4 billion to $39 million, Sarah. I'll send things back around.
I know, it's shocking, actually, to see that decline in value. I think it speaks a lot to, the fad around ESG and sort of environmentally friendly everything, and that's kind of faded. But
just consumer trends,
changed.
right? I mean, just everything else there as well.
All right, Dom, thank you. When we come back, how geopolitics is driving interest in private defense companies. Venture capitalist Eric Hippow on more on where that money is going. Plus, SpaceX, Anthropic, and OpenAI, just some of the massive private companies that could go public this year. What insiders are hearing about a potential timeline for those IPOs after the break. Welcome back to Money Movers. The IPO market getting off to a slower start in the first quarter compared to last year, with the number of IPOs falling 36% from last year. Reports of an imminent SpaceX IPO, though, putting the pipeline into focus as a number of other private companies, giants Anthropic, Databricks, reportedly are also eyeing a public debut this year. Joining us now is managing partner at early-stage venture capital firm Lair Hippo, Eric Hippo. It's great to have you. So when do you think we'll start to see IPOs heat up again, Eric?
Thanks, Sarah. It's great to be back. Well, the expectation, of course, is SpaceX. And SpaceX would be the biggest IPO ever, potentially raising 40 to 80 billion dollars at a 1.5 trillion dollar valuation and higher. It would be a great IPO. It would also open up space as a huge commercial opportunity for suppliers and other people with all kinds of data centers up in the sky with potential manufacturing base on the moon. But it also has the potential of just sucking the air out of all the IPO potential for this year.
Yeah, I was going to say, does that open up the opportunity for others or squash it?
I don't know. We'll have to see. That's a lot of money. And in addition to that, if Anthropic or OpenAI goes public, also among the biggest IPOs, projected biggest IPOs ever, that's a lot of capital that's going to go to just one or two or three companies. And so the concern is, is there going to be enough money left for smaller opportunities?
What are you telling your portfolio companies about the opportunity, the timing, and just how you're preparing them differently right now for a debut?
Yeah. We're telling our companies that they should always be prepared, or should always be ready, that they should be using AI tremendously to lower their costs, to increase their business opportunities, improve margins. This is a great moment to improve your margins, your gross margins in particular, and just be ready to go, whether it's a sale through an M&A process or an IPO.
Yeah, we've been watching, certainly, Eric, the impact of technology on startup headcount. And I wonder whether or not, when you look at a deck these days, has your tolerance for headcount gotten lower? If someone comes in and says, we have 50 employees, or you'd rather see 10?
We would rather see 10. And we would particularly like to see fewer engineers. Vibe coding and the ability to basically write code on the fly is a tremendous asset to startup companies, because they can do more complicated systems, they can do faster, better, cheaper, and they can look much bigger in the marketplace compared to perhaps the incumbents.
Talk to us about defense tech. I know you're excited about that. I feel like it is a good time for defense tech companies. What's most interesting right now, and what kind of innovations and valuations are you seeing there?
So the Ukraine war, and of course the Iranian war to some degree as well, has shown that drones have fundamentally completely restructured the battlefield. You're talking about swarms of cheap one-way systems that have incredible kinetic power, and we because of this new reality, we are going to have to completely reindustrialize our defense base. We're going to have to build smaller systems, autonomous systems, not only in the air but also, with the Navy, with shipbuilding, autonomous ships. In fact, there's a company today backed by Kleiner Perkins that makes autonomous ships that just raised money at about a $12 billion valuation. So there's a tremendous amount of venture money that's going into this reindustrialization, and not only in terms of these autonomous systems, but we need to produce more of everything. We need to produce more munitions. We are very concerned that the war in Iran is depleting our munitions. That just shows you the amount of kinetic force that's being used in modern warfare, and all of that's going to have to be rethought and reindustrialized, and everything's going to have to be done, faster. Ukraine is building hundreds of thousands of drones every month, and whereby 2 years ago they were producing almost none. And that's the kind of speed, that's the kind of effect that we need to put on a bigger scale here in the United States.
Yeah, certainly the Iranian example regarding drones is perhaps a little more pernicious than the Ukrainian example. I do wonder, Eric, we turn to you a lot on tech in Europe, and I wonder whether or not that emphasis on defense or on supply constraints and energy are going to interrupt their attempts to remake themselves in sort of an American way when it comes to AI and tech?
Yeah, Europe is concerning. Europe is behind. Europe only has one large AI company in France called Mistral. They're behind in terms of their industrialization for defense, and they just need to move a lot faster. And we should be able to cooperate with Europe, but we don't really see eye to eye anymore. On warfare, particularly on warfare, we're just not as allied with them as we used to be, and it would be great to go back to the old ways.
Does that make the investing in Europe less attractive?
Investing in Europe is less attractive for that reason, but also because there are fewer exits in Europe, and the market is. Whereby we talk about Europe as a single market, it really isn't a single market. It's each country is its own market, so it's smaller. It's a lot easier to do business in the U.S.
Okay, well, thanks for joining us with the perspective. Europe,
My pleasure.
IPOs, defense. Eric Hippo, thank you. Good to see you from Laird Hippo.
When we come back, one Wall Street firm cutting its price target on Tesla by about $100 a share. We'll talk to the analyst behind that call. Will join us next to explain. Don't miss Entergy CEO Andrew Marsh this afternoon on Power Lunch. The utility partnering with Meta now to power that data center in Louisiana. Dow holding on to these gains pretty sturdily here, up 500 still. Stay with us. Welcome back. Take a look at shares of Tesla today, up in a pretty good tape, but down around 20% year to date as our next guest trims his target to 420 from 520, pointing to some depressed multiples across Mag 7, but leaving his estimates and his buy rating intact. Joining us this morning, Canaccord Genuity Senior Sustainability Research Analyst George Gianarikas. George, welcome back. Good to see you again.
Nice to see you, Carl. Thanks for having me.
You've been pretty constructive, I would argue, over time on the name. Why are you bringing the multiple in?
Well, we updated our estimates. We do a global trot every quarter to see exactly how we think the delivery estimate will pile up. And as a function of that, we looked at the multiples across the space. So we comped Tesla to the other Mag 7 stocks, and those multiples have compressed big time over the last couple of months, from around 21 times relative to our last update to 16. And so when we looked at Tesla, we compressed the multiple from somewhere in the mid 40s to now 37 times, and looked at our 2028 earnings and applied that multiple and got to a $420 price target.
All right. How much do deliveries matter right now? Can the street look past delivery misses?
That's a great question. You know, in the near term, we think no. I mean, the stock will trade up or down relative to what they print. But, you know, investors for Tesla are looking out into the 2028, 2030, 2035 timeframe and looking at robo-taxis, looking at robots, and looking at energy storage and really trying to look at the future growth prospects of the company. But our opinion is that EVs still matter big time to the P&L today. And we think that there's still a lot of room for growth in electric vehicles. If you look globally, we're at about 18% penetrated in terms of new car sales. And some markets are really good, like China or even Norway. But we think that over time, that electrification will continue to sustain itself, and eventually we'll get to very, very high penetration rates of EVs.
Yeah, I mean, Carl asked about deliveries, whether they matter. Do multiples ever? I mean, how long have you been covering this stock, Tesla, and how much have you been able to get the price correctly based on a multiple?
It's really hard. We take a different approach. We apply a PE to Tesla. Other analysts do different things, like some of the parts, but we're sort of meat and potatoes analysts. I like to look at price to earnings, and so we look out a couple of years, look at the sustainable growth rates over time, and so we think that Tesla deserves a premium to the Mag 7, because if you just look at consensus, they're growing somewhere in the mid-teens from a revenue perspective. We think Tesla has much better growth prospects than that, and so that's what we do. And so it's obviously, you always tweak it relative to what's happening with other stocks in the market, but that's our approach. PE, we don't like some of the parts, we don't like that other stuff, and so we try to take this traditional approach to valuing Tesla, and it's an art and a science at the same time.
Well, it's hard to know the earnings potential for these kind of futuristic products which they're totally transforming.
Without a doubt. I mean, so what we've done in our models, we've built a robo-taxi revenue line and get to about 6.5 billion miles driven by 2030. We assume Optimus sales into 2030. I mean, Elon Musk talks about millions of Optimus sales over the next several years. We have it at about 400,000 in 2030. And to your very point, though, these are very, very tough markets to model because they kind of don't exist today. And a lot of companies aren't selling humanoid robots today. A lot of companies aren't doing robo-taxis today. So it's, it takes difficulty, but we're big, big believers, particularly in autonomy. We think autonomy will transform ride sharing, will transform mobility. And we think Tesla will have a role to play in that. So we do our best and try to calibrate our earnings.
Yeah, I was going to ask you what kind of grade you'd give them, at least in Austin, and whether or not they're surpassing or missing your initial expectations, and where the white space is between them and Waymo right now.
That's a great question. So we think Tesla will have a role to play in robotaxi. We do take a little bit of issue with their approach. So they're famously using cameras only, and they're sticking to that approach. Others, like Waymo, are using technologies like LiDAR to enhance the product. NVIDIA, with their reference design, is also using LiDAR. We think they'll solve it over time. And the reason they're doing that is to scale quickly, right? Just through a software upgrade, a Tesla vehicle can upgrade to a robotaxi, assuming it has the right hardware. Waymo has to bespoke build vehicles, right? So do other companies that have aspirations to be robotaxi companies. But we think over the near to medium term, using a LiDAR will probably be the best approach, at least the safest in our opinion. That's a controversial opinion, but we think that those that use LiDAR will be able to more effectively scale, at least in the near to medium term.
Interesting call, George. We'll keep an eye on it over time with your help. It's good to see you again. George Enriquez talking some Tesla.
After this, a pair of deals to get to in the pharma sector today. Closer look at the M&A strategies here for Eli Lilly and Biogen. We'll be right back. Eli Lilly and Biogen both announcing new M&A deals this morning. Angelica Peebles has more on what they're buying and what the strategy is. Angelica.
Yes, Sarah. Well, Lilly, let's start there. They're going to spend up to $7.8 billion to acquire Centessa Pharmaceuticals. Now, that company is developing a drug for narcolepsy. Centessa is one of several companies working on this new class of drugs called orexin agonists that could transform the treatment of narcolepsy. Now, these drugs could also treat drowsiness more broadly and possibly other neurological diseases, so this could be a huge opportunity. I actually just spoke exclusively to CEO Dave Ricks moments ago about the market potential here.
We also see a broader potential for this pathway, maybe a little bit of an analogy to GLP-1 in a way that, sleep and wakefulness are like core to our functioning. And when your sleep is disturbed or your wakefulness is disturbed, it causes a lot of other problems. So I think you can count on Lilly exploring broad use for these medications and this new pathway, and we're pretty excited about it.
Oppenheimer estimates that this market could easily reach $15 billion to $20 billion in annual sales, with that number going even higher if these drugs could be used more broadly. Now, other names to watch in this space are Takeda and Alkermes, so that's a really interesting one. Now, on the other side, we have Biogen. They're buying Apellis Pharmaceuticals for about $5.6 billion. That acquisition's a little bit different because they have approved drugs, and this will give Biogen 2 drugs for immunology and rare disease. Now, that's important for Biogen because they've been trying to turn around their sales there. Remember, their Alzheimer's drug was supposed to be Biogen's next big thing, but that's been a disappointment, and that's forced the company to go out and do these deals to find some new sources of revenue. And clearly, investors not liking that deal. Stock's down about 5% today. And of course, guys, it's already been a really busy year for M&A with more expected. Some of the other names that we are watching, I talked to Mizuho analyst Jared Holtz, and he pointed out Insmed, United Therapeutics, Madrigal, Cytokinetics. So there's a lot to watch in this space, as always, guys.
I want to say, listening to Rick's talk to you about the promise of that market, given their credibility on GLP-1s, that's intriguing.
Yeah, it's really interesting. And, you know, even talking to analysts, they say, yes, there's an immediate need here for narcolepsy. So these are people who just really cannot stay awake. They're falling asleep all the time. And that's where you start. But then, you know, who doesn't want to stay awake more? You have other conditions like Alzheimer's and depression where people are experiencing abnormal drowsiness. And also, of course, you know, other people who just, you know, want to be more awake. Of course, these are expensive drugs. So hard to see, you know, if you and I will be able to take them. But there could be a really big opportunity here, not just for Lilly, but all of these companies.
Yeah, stocks come in obviously over time, as we know, but they do have a lot of discipline when it comes to thematic investing. Angelica, thank you. So we had Lilly and Biogen, and then we had, of course, McCormick Unilever too today.
Yeah, the M&A heating up. I mean, this was supposed to be the year that we would see more deals, potentially friendlier regulatory environment when it comes to approving deals, better stock market. Although, you know, we just did a segment saying that IPOs have been quiet because that was supposed to be a big thing this year as well because of some of the nervousness around the war. And as we do close out the quarter here, I mean, it was a down quarter. We're going to look like it's going to go out on an up note, but still pretty steep decline overall for stocks to start the year. Unexpected as we watch these oil prices and we watch what has been rising bond yields, and we'll see if that's been broken, the sort of higher oil, higher bond yields. We'll get more economic data tomorrow, retail sales, ADP private sector jobs. After today, I would say unexpected boost in consumer confidence and a little bit lower job openings.
Right. Jolts weren't too concerning, although the hiring rate came down, was revised a little bit better, but still very weak in the threes. You'll get Nike tonight.
Yes,
which we'll watch
Nike
tomorrow.
tonight will be obviously important for the consumer, but also they're in the middle of a turnaround story as well.
Let's get to the judge back at Post 9.
Carl, thank you very much. Welcome to the Halftime Report. I'm Scott Wapner, front and center this hour. Stocks are green today. The future of the war with Iran remains uncertain. Yields are down. Oil is steady. And, of course, we're trading all of it with the investment committee. Joining me for the hour, Joe Terranova, Stephanie Link, Brian Belsky, and Josh Brown. Check the markets here. Just give you the scorecard here as we begin this midday hour at noon. We are green, as I said, across the board. Look at the NASDAQ. Boy, it's needed that, hasn't it? 1 2/3% higher, and the headlines have been fast and furious this morning. It's really dragged the market around a little bit. We've always stayed green, but the market really got, I think, off to a good footing today with the Wall Street Journal reporting that the president has told his aides that he's willing to leave Iran without reopening the Strait of Hormuz. Then you had a headline, gosh, feels like a couple hours ago already, that Iran's Revolutionary Guard was threatening U.S. tech companies. You can almost look at an intraday of the Dow for a pretty good look at how the market's traded. And then another headline, there you go, right? And then another headline from the New York Post, Trump telling the New York Post, the president did, that the war won't last, quote, much longer, and that the strait will reopen, quote, automatically after the U.S. leaves. So I think therein lies the trading pattern today. Joe, the economic data was pretty good. I mean, consumer confidence beat expectations. Gas is above $4 on average now for the first time in a while. So where does all that leave us?
Well, first of all, last day of the quarter, I think that factors into the equation of what we're seeing today, along with the headlines that you mentioned. But, Scott, I also think the market was deeply oversold. Yesterday afternoon was incredibly punitive. The momentum factor was down 2.5%. We saw a lot of the names that had been working coming into the early part of 2026 saw a significant deleveraging in terms of positioning itself. So
Can I stop you for 2 seconds?
Yeah.
Momentum, okay. Momentum's having its worst month in nearly 4 years.
It is.
4 years.
Well, it feels like 22. So if you think about this quarterly performance will be negative. We haven't seen that since Q3 of 23. But really before that, the period where you saw that progression of consistent quarters of negative performance was back in 2022. And it was the unwind of the momentum factor that contributed significantly, along with the fundamental stuff with historic raising of interest rates as well. But what has happened here with momentum is it came into 26 with really strong performance, and we're seeing that the trends right now are just flattening out. If you talk to the systematic community, they'll tell you their bias right now is basically they're neutral. They're not sure which way to go right here, and I think that's the right way to look at this right now. I don't think you want to be short. I don't know that necessarily you're looking at being continue to be long, but that's really what's unfolded momentum, and the sectors that embodied the momentum funds were financials, were healthcare, which were semis, which had worked well. And there you're seeing a recalibration in terms of positioning and sentiment. It's warranted, and I think it just takes everything back to neutral.
All right, Steph, we set the table with the headlines. The quarter's going to end. Wolf today says we expect the near-term trend in markets to be biased to the downside. We just don't know really where this is all going. Is the president going to leave with the strait still closed and the region in some form of chaos? I mean, what does that mean for the global economy? What does it mean for anything else? So there are still many questions as we try and figure out as investors what to make of it all and how to position ourselves into now a new quarter.
Yeah, but if we wait for certainty, Scott, the market's going to run away from us on the upside. I actually do think that it all depends on the time. Well, hope is not a way to invest for sure, but I'm trying to think a little bit longer term. And I have been buying throughout this entire downdraft, and that is because I'm finding really great quality companies that are trading at discounts to their historical multiples or just downright cheap. What is very encouraging to me, I saw yesterday 3 different strategists raise their earnings estimates higher in the face of all of this. And that is because the economic momentum that we have pre-war, even during war, we're running above trend. And that is very positive. At the same time, the multiples for the S&P 500 is down 17% to 19 times. So it's not super duper cheap, but it's getting cheaper.
Yeah, multiples have compressed. I saw you post something yesterday on social media, and then we did it on the program, in fact, yesterday, because, the multiple has compressed a fair amount.
It has, and there are certain sectors that are even cheaper, though. Financials, some parts of industrials, for sure discretionary, and I get that. But I think that that's opportunity for the long term. In terms of earnings revisions, though, it's coming from 2 sectors, Scott, just technology and energy. That's, to me, if earnings are going higher for both these sectors, you still want to be involved. Technology, I've been adding to some new positions. We'll talk about them later and all that sort of stuff. But I think there's opportunity here. You just got to see through this. What I'm going to try and say, it is noise. It is big picture noise. It's serious, but I'm trying to think as an investor.
Okay, so the greatest point of contention is part of what Steph was talking about with earnings, okay? Estimates keep going up. Are they going to really be able to produce that? That's a question mark. You just don't really know. Wells Fargo today trims its target, by the way, to 7,300 from 78. They're tactically cautious, even though they're structurally bullish. I think Steph is structurally bullish also, right? I don't think you can be anything but tactically cautious, right? I mean, how could you be definitive in any real way? But as they point out, they think the oil shock is likely more mitigated. Valuations, as we're talking about with Steph, have reset. U.S. is greater than international on energy independence. That's an undoubted plus. And hyperscaler free cash flow is inflecting higher. Restocking is accelerating amid lower tariffs and supply disruption. So I got all of those things which are enabling people like Steph and some analysts to try and look through what's happening now and see to the other side, as opaque and foggy as the war has made the environment.
What's going on right now is exactly what happens in an earnings-driven market. We've been driven primarily by momentum and multiple expansion. 2026 is about earnings-driven markets. Historically, earnings-driven markets can still be positive, but their year-over-year rate of return is actually half of what momentum-driven markets are. Now, I love it when strategists say that they're bullish and drop their target. I mean, we used to have to do that on the sell side as well. But at the end of the day, this is about investing. This is about being tactically, I would say, convicted and structurally bullish longer term. The 25-year secular bull market, in our view, is still very much alive, Scott, but we've had these eras where we have this, right now, where we have sentiment at all-time lows in terms of bearishness. I mean, bearishness high, bullishness low. And then given that everybody hates tech stocks, we love oil, we love gold, I think this is a fantastic time to be convicted in your stock picks.
All right, Josh, what are your own thoughts here? Is it time to, remain cautious? Is it time to be opportunistic? What do we think?
I think, look, a lot of long-only managers point out all the opportunities here, but they were fully invested 9% higher in the S&P, 11% higher in the NASDAQ. So it's like, all right, so with new money, you like the same stocks that you liked 20% higher? Okay. I don't know how helpful that is. I think the best comment to make here, which Stephanie made, and I agree with this, they reset the table for us with a significantly lower starting valuation, not just across the board, but in some of the best stocks in the world. And I can't see how you could be negative on that. That's not the same thing as saying they can't go lower. But I do like the momentum washout that Joe pointed out. I do think that's helpful to the market. And if you think about, like, all right, so what's the most important thing going forward? Let's say hypothetically, Trump says, okay, we're tactically pulling back. We did all the damage that we wanted to do. They'll learn their lesson. Go get your own oil. I like it. It's like a buffet for oil now. Fine. Let's say the market digests that, accepts it. I think that's a really interesting situation to be in, because the number one thing that has not accompanied all of this trouble with high gas prices and inflation worries, you have not seen earnings revisions lower. You've seen earnings actually revised higher. So you're telling me basically, I have this valuation reset. I could buy the biggest, most liquid stocks in the world, half of which people are super bearish on. And so I think like the balance here is you want to be tactical, you want to be opportunistic, and you do want to be a buyer. I know we're going to get to something that I did last week shortly, but I think it's the right, look, it's consensus, but I also think it's right.
Well, the quarter's going to end with tech having some major questions being asked about it. And it, to me, is the epicenter of the valuation reset that everybody has just mentioned on the program. The forward PE of the spread between the Mag 7 and the S&P is nearing the lower end of its range going back to 2015, right? That's an important and identifying statistic of just how much the Mag 7, the biggest tech companies in the world, have reset their valuations more in line with where the overall S&P is trading. Talk about resets, okay?
Judge, can I add something to that? Yeah. I don't even think people understand. I don't even think people understand the extent to which this reset could play into our favor.
I'm going to hang on 2 seconds, because I'm going to give you a little more data, then I'll throw it right back to you, I promise. So let's just take Meta, for example, okay? Meta's high for 2026, its forward PE was 24 times. It's now 18, okay? You want more evidence? Alphabet was 30, it's 24. Microsoft was 27.5, now it's 20.5. Amazon from 31 to 26. NVIDIA, 25 to 20. I mean, NVIDIA is like the cheapest it's been to the S&P in like 10 years. Apple was 32, now it's 29. Josh.
Well, so the point that I wanted to make is, if you think the earnings power of these companies just vanishes or falls off a cliff, then these lower valuations aren't going to help you. They're not going to do much to protect you. I don't think that most people think that. So if you think this will be a decent year for overall earnings growth, and that these companies have preserved their earnings power through similar market moments, and they will again now, they're screaming buys. So NVIDIA at a 15 forward earnings, they're supposed to do 74% earnings growth in 2026, and then another 34% next year. Once again, 15 times. I understand all of the competitive threats and is the China business back? I get it. Still, you mentioned Meta, 27% earnings growth this year, 16 next year. Microsoft, 21% earnings growth, 15 next year. And by the way, all those next year numbers, the weird thing that's been going on over the last few years is we keep having to raise them as we get to the halfway point of the preceding year. So unless you think it's a complete mirage and the 75 sell-side analysts covering those three names have their heads in the sand, these stocks are probably buys, and they're way easier buys than sells. And there are more, we're just using those three. But it's not just the valuation reset. It's the valuation reset relative to the future earnings growth that the street is looking at.
When you get, Steph, the kind of valuation reset that you've had in these names, and the prices have come in the way that they have, you're going to have stats like Meta having its worst quarter since the third quarter of 22. Microsoft is set for its worst quarter since 2008. You got to go all the way back to 08 to see a period of time of 3 months that Microsoft had a worst quarter than it's having now, to Josh's point. You look at these and they've come way in. You've got Meta.
Yeah, we talked about it the other day in terms of it trading as, where it is, right? It's at 17 times forward estimates. And this is a company that last quarter, Scott, raised their revenues by $3 billion. And they're going to grow something like 26, 27% in total revenues. It's an acceleration story, a growth story. I'm really shocked that it has pulled back as much as it has. I do think that there's a lot on the table that they have in terms of AI options, in terms of new products and customer apps and tools, and they are seeing monetization. We talk about this a lot. I know that we're all waiting for it from a lot of these companies, but we are seeing monetization. This is a company that has pricing power of 10 to 12% in their ad business, and what they're doing in terms of AI, they're using it so that people are spending more time on the sites. And I just think this is an opportunity, certainly for the long term, but I don't know what the catalyst is other than maybe earnings. I hope that that's what's going to drive it. It didn't do it last quarter, though.
I love going back and looking at these types of companies in the past. Think about this. Meta wasn't even Meta in 2015. It was Facebook. They were in a completely different business. Google was talking about search. Microsoft was trying to put amalgamation of their business together. Amazon was more of a consumer company. Apple was focusing on their phones. So you think about the consistency of earnings. Look at the E. There's a valuation. There's a P and an E. Look where the E is going next year versus where the E was going to go in 2016. That's what everybody's missing on this, and I think these stocks are exemplary cheap.
So NVIDIA is a really great example of this. By the way, we're at 170, remember? Remember Christina Partsinevelos came on the other day and made the point that 170 was this line in the sand for the stock? It hadn't been able to see that for a minute, and here we are with this gain today. It's still around an 8-month low coming into today. It's down 9% year to date. Well, Jensen Huang was on CNBC earlier today. He said the market's been just getting it wrong. Listen.
The market misses several things about NVIDIA. I think of course, because we are such a large company and we have such a large position of AI computing and all the AI infrastructure, a lot of people might think that all of our growth is all priced in. However, what is very clear is several things happened this last several months, in fact, maybe the last 6 months. We gained share. How is it possible that we're gaining share at a position that we're so large? We didn't have Anthropic exposure previously to this year, and now we're scaling with Anthropic. Our growth in AWS is accelerating. We just announced they're going to buy 1 million GPUs from NVIDIA in just about a year and a half or so. And so that's an enormous number of new GPUs. The number of customers outside of the clouds, the top 5 cloud service providers, has now grown to 40% of our company's business. Most people think that most of our business is in the cloud, but in fact, one of the fastest growing segments is outside of the enterprise, the industrial.
I mean, Joe, by the way, that gentleman, they invested $2 billion in Marvell, and they launched an AI partnership. In case you're wondering, who's the other guy sitting there? Why is he just sitting there? That's what that was about. But nonetheless, Jensen has had an incredible ability to refocus people on what they do and what they do better than everybody else, right? He did it when he and I sat down ahead of the Super Bowl. Remember, the stock had been down like almost 10% in like a week to date. He came on, he sort of retold part of the story, refocused people, and the stock went up from there. And I feel like this is another one of those moments. Well, whether it's lasting, who knows, but it certainly calmed people and got people to refocus on what this company is doing and where they're investing and how they believe it's going to continue to pay off for the investors who continue to believe in it.
He has an ability to communicate very eloquently, very elegantly, and simplistically in a way that individuals are able to understand however they might be trained in the financial services industry. What he did with you was he defeated the premise that was out there that competition was coming. He assured everyone that, no, they still had the control of market share. Look, I've spoken about this all year, and people have kind of questioned me on it. I don't see what the issue is with NVIDIA. The stock is basically, from my perspective, running in place. It's outperforming the rest of its Mag 7 peers. It hasn't been below 160 since last July. And really all you're seeing is what you should have expected. Moderation in the triple-digit revenue growth. You can't expect that this company was going to continue to grow at that pace. So it's been a core holding. It ranked as #1 for the ETF strategy. We own that along with Alphabet. And I think if you're looking in the Mag 7 and you're saying to yourself, okay, where else do you go? We'll talk in a little bit, but I think it's about Apple. I also think the relationship today that was announced with NVIDIA and Marvell speaks very strongly about the AI data center testing equipment market. And that goes to Teradyne. I think Teradyne is in an excellent spot right here. Short interest is built up. If we could show Teradyne, it's pulled back. Short interest is built up to 3%. The company is growing its revenue at a pace that it has never seen. It's historic. And it's been part of this semi-pullback that we're seeing. I think it's a great entry point right here for a fundamental business that's accelerating, piggybacking on what we heard from NVIDIA and Marvell today.
You mentioned Apple. Tomorrow's the company's 50th. And the stock's held up reasonably well.
Very well.
I thought it was interesting that, Warren Buffett was on with Becky earlier today. And, anytime that he continues to speak publicly or do interviews, it's worth a listen. He lamented the fact that they sold Apple too soon, and they would consider buying more of it, not necessarily in this market, he said, but if it did get to more attractive levels, they would. Still was obviously a great investment for them. Josh, and you have told us, I don't know, maybe it was a month ago, to really keep your eye on this stock.
Yeah, this is the one. So if you just understand how important the iOS ecosystem is to the vast majority of people in the global middle, and upper class, the spending power of that cohort in this K-shaped economy that exists all over the world, these are people that will most likely spend the majority of their time experiencing AI, doing so within this ecosystem, and Apple will extract the tax. This is just the reality. I don't care if Claude wins. I don't care if ChatGPT wins. Perplexity, doesn't matter which image creation app, people editing films, whatever they want to do, they're giving Apple a third in year 1 and 15% thereafter. Everybody knows it, and Apple does not need to spend 110% of its free cash flow like its brethren in the Mag 7 in order to be there. All that they need to do is figure out agentic Siri, which I think will happen this year at one of 3 scheduled meetings that they have right now. And when they do that, people will understand, oh, I see. All of these AI bets in the venture-backed market, all these startups that we hear about, this one's worth $4 billion, this one's getting acquired by Meta just for the engineering talent, blah, 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 blah. They're all paying Apple. Oh, that's how this is going to go? I can't believe it. And once that becomes apparent, people will understand why this is the best acting stock in the entire Mag 7 world, and probably remain so between now and the end of the year. So this is the one to watch. This is the one that deviated when the rest of the hyperscalers were forced to do all this spending on data centers. Apple really just doesn't have to do that.
And you don't have it in the ETF because it lost the parameters to be in there, but you bought it recently personally,
so
right?
It lost the revenue growth. That was the reason for it. And I will tell you, at the upcoming rebalance, what we've seen now is a resurgence in the revenue growth. So you're looking at, in the most recent quarter, double-digit revenue growth. Go back and find when was the last time Apple did that. You're looking at Q1 of 2022. So we haven't seen since fiscal year 21 where Apple did double-digit revenue growth. They're on pace to do it this year. That's the reason that it was removed from the ETF. Personally, there are certain names you're comfortable trading. There are certain names you're not comfortable trading. Apple's one of the names I'm comfortable trading. I bought it at 252. I talked about it last week. You have a great point of reference, but I'm also buying it because I like what I see from the business. I like what Josh is describing. I like the fact that I think you're going to see a reacceleration in the business in China. And yes, I believe it's the most expensive Mag 7, but for my strategy, that's something that I actually am more inclined to allocate towards, is where I see the premium being paid in terms of valuation itself. So I do think Apple's probably, of the Mag 7, in the perfect spot right now to where you look over the next 12 to 18 months and you want the outperformance relative to others.
Hey, how about the NAS? NAS is better than 2% gainer right now. We've talked a lot about it, obviously, in the first 24 minutes of the program. Good for better than 400 points. It's a 2% gain. We're highs of the day, basically, for the NASDAQ. One of the key questions for tech, I think it's fair to say, is going to be in software in the new quarter. Cyber, SaaS, in general, there are so many questions. Microsoft just seems to be one of the poster stocks of the question marks, which leads me to a move that Josh made before we take our first break of the program today. You bought the IGV on Friday, which I find a pretty interesting move. I want you to tell our viewers more about.
So I just thought by Friday afternoon, what we were watching was just a wholesale vomit, and it really had nothing to do with the fundamentals. And maybe in the early days of the software sell-off, you said to yourself, all right, I get it. You have a couple things going on here. You have Anthropic launching into all these verticals, new products that are obviously going to at least start off be cheaper and lighter for both individuals and corporations to bring into the fold. But if you just continue to extrapolate that and watch these stocks fall between 30 and 50%, which is what the names in the CTF looked like circa Friday, you're acting as though the companies themselves are just going to sit there and not do anything about it, as if they don't have a CapEx budget where they're not working on AI solutions that will be better than whatever people vibe code on their own. And of course, that's not going to be the way this plays out. And I'm doing this almost 30 years. And they told me the credit cards were dead when blockchain came along. Credit card companies are bigger than ever. They told me the banks would never recover in the wake of Dodd-Frank and Basel III. The banks are bigger than they ever were, especially the big ones. I think they all tripled in size. So every time there's just this big obvious story that everybody seems to be able to recite on command, and it becomes that consensus, it's almost like a personality flaw I have. I have to lean the other way. And you guys know, I don't troll the 52-week low list. That's not my steez. But I'm looking at Palantir, Microsoft, CrowdStrike, Palo Alto Networks. These are some of the biggest, best growth stories in the country with the best unit economics, the most profitable companies. They're not sitting back and waiting for Claude to come along and just replicate what they've done. They will have their own versions that are better and that the user base and all these corporations are comfortable with. So that's the bet here. It's a trade. I don't know that I'll be in the IGV for the rest of my life, but I think I bought it right. And my plan is to trail it with stops. I might have several trading opportunities in this thing if the disruption freak out, comes back in a week or a month or 6 months. But I think at this point, it's gotten so absurd, you almost have to lean the other way.
Well, I mean, maybe Palo Alto's Nikesh Arora was one of those because he did that $10 million personal buy of Palo Alto in the midst of some of this carnage that we've seen in this space. And he obviously is going to talk more about that when he joins Kramer tonight exclusively on Mad Money at 6 o'clock Eastern. So he's going to give you a real world view of how he sees not only his company, but that critical space and why he decided to do that. And then you just heard what Josh had to say, too. So let's squeeze in a break. We got the NASDAQ at the highs of the session. We're good for about, well, we were just like 2.2%. The Dow's gotten a little bit of a lift, too. We'll take a break. We'll come back. We're going to talk about Netflix. Netflix wants more sports. Should you want more Netflix stock? We debate it next. All right, welcome back. Netflix reportedly wants more NFL. Julia Borston joins us now with those details. Hi, Julia.
Well, Scott, the NFL mini package of games that it's currently talking to the marketplace about is attracting a lot of interest from many companies, including Netflix, according to a source close to the situation. Now, this confirming the Wall Street Journal's report that Netflix is looking to expand from its current package of 2 Christmas Day games, that package ends this Christmas, to a package which includes a new Thanksgiving Eve game along with an international game, likely in the first week of the season. No comment from Netflix. Now, this comes as the NFL has reclaimed the right to sell these games as part of its deal with ESPN, and as Netflix has increased its investment in sports events, including its first MLB game last week. Now, other potential buyers for these NFL games include Google's YouTube, which of course has the rights to NFL Sunday Ticket package, and last season streamed an international game, along with Amazon, which has those NFL Thursday night games. Now, the NFL's broader rights deals can be renegotiated after the 2029-2030 season, but the NFL can renegotiate its deal with CBS sooner because of CBS's parent Paramount's sale to Skydance. Scott?
All right, Julia, thank you. It got us talking, obviously, because we have ownership on the desk. The NFL has been incredibly successful for Netflix. They just did their MLB opening night game, Belsky. Yep. They just raised their prices again. They're in such a unique position, and now they want more of a foothold into your living room with the greatest ratings grab that there is on television anywhere, the NFL.
This company is the king of content. They have been for a while. I think it was a very, very good thing they didn't get the Warner Brothers. We bought the stock in our value portfolio a couple weeks before that. We are long-term holders, as you know. And we really believe, and we've said this on air, that it's going to come down to Alphabet and Netflix with respect to sports. And so I assume in the next 4 or 5 years, they're going to be really aggressive. I think this is very good news for Netflix.
Josh?
Yeah, I agree. I don't understand why this stock is still below 100. Now that they called off this merger, we can focus on Netflix's growth opportunities. They are able to raise prices. They are solidifying the power of the tiers. And I think adding sports, adding live events, and adding the types of things that make everybody want to tune in all at once is the thing that they spent 15 years playing coy about. Maybe we'll do it, maybe we'll... Now they're saying, like, yeah, this is what we do. We're doing boxing, we're doing major professional sports, we're doing award shows, we're doing it all. And I think the stock deserves more of a premium multiple than what it's getting.
Steph?
I mean, I've never owned it until recently. It's
Yeah.
one of the names that I've recently bought because it is still down 32% from its high. I mean, these guys have 325 million subscribers. I mean, they are just the absolute ginormous company in this space, and they're going to spend $727 million in CapEx alone just this year. So I love this news about the NFL and adding on to their subscribers, adding on to market share so that they can continue to grow, a compounder at like 20% in terms of earnings, revenue growth 12 to 14%, and margin expansion. So yeah, I too don't know why the stock hasn't recovered, but I hope that it will, and I think it will given the strong fundamentals.
Yeah. You taking a look at this thing? You have to, right?
Of course. I'm always paying attention to it. Remember something. I bought this stock in May of 2024 at $66. I sold it out at $80 in February to protect the gain that I had. I didn't want to take a loss on it. But no, you're always paying attention to it. I think what they're doing with sports is really important when they're telling you that their content budget is going to expand 10% in 26 to $20 billion. Well, the offset to that is the ad revenue that we all know the NFL brings. And it's tremendous ad revenue. They did baseball last week. That speaks to their ability to gain international subscribers. They have a focus on that as well. So it's about engagement. It's about ad revenue. And it's, yes, at some point I will be back in this stock as I have been in the last several years.
Okay. Well, right now it's about the news update. We'll go to Christina Partsinevelos for that. Hi there.
Hi, Scott. Well, Defense Secretary Pete Hegseth said at a briefing that negotiations with the Iranian regime are ongoing and gaining momentum as the war enters its second month. Hegseth said the number of missiles and drones launched by Iran over the past 24 hours marks the lowest of the conflict. He actually declined to answer questions about the number of remaining weeks of war, saying they would never reveal it. Britain's King Charles is planning a state visit to the United States next month. According to a statement from Buckingham Palace, Charles and his wife, Queen Camilla, will visit to mark the 250th anniversary of American independence from Britain. It'll be Charles's first state visit to the U.S. since he was crowned king and in 2022. And Celine Dion announced her return to the stage. The music legend will headline 10 concerts in Paris later this year. In the announcement, the singer thanked her fans for their support as she managed her health. Dion took a break from performing after she revealed her diagnosis with stiff person syndrome back in 2022. As a deep Montrealer, I was disappointed there were no Montreal shows, given she is a Canadian, but oh well. Scott, back to you.
You sure going to be okay?
No, I was actually talking about this last night. I'm very disappointed.
It's carried over into day 2. We'll check in tomorrow. We'll see how you're doing.
Okay.
It's Christina Partsinevelos. Coming up, Josh Brown's best stocks in the market. The 2 names that just hit the list. We'll tell you what they are next. Welcome back. We're at the highs of the day for the session. There's the NASDAQ, which had been steadily moving higher over the last 40 minutes or so. Now good for nearly a 2.5% gain, better than 500 points. The Dow is now good for almost 640. So, the administration has tried to project this message today that maybe this is not going to last that much longer. It's been received well, obviously, by the market thus far. Yields had come down a bit. That helped. Oil stabilized. That helped. But there's your current market picture now, some 40 minutes after noon. All right, Josh Brown's best stocks in the market. The spotlight is on two stocks. They are?
Yeah, so today is a risk-on day in the market. So these stocks are not running because they're actually providing the opposite for investor portfolios. They are Verizon and AT&T. Go back 5 years ago, they would announce these M&A deals, and analysts on the street would refer to these two companies as, literally, this was their nicknames, Dumb and Dumber. Verizon bought AOL and Yahoo. Literally, I'm not even joking. And AT&T bought Time Warner for like $85 billion. It was just crazy. They've spent the last 5 years unwinding all of those deals, all of that debt, and now these stocks look really good. In the case of Verizon, see that big move? That's them shocking the street with a better than expected churn number on subscribers for mobile. The board authorized a $25 billion share repurchase over next 3 years, and they've raised their dividend for the 20th 20 consecutive year. It's now a 5.62% yield, which is one of the 20 highest yields in the S&P. This is a textbook earnings reset. It made the big move. Now it's digesting. I think your risk is the 200-day at 43. I think the stock continues to digest that move and then launches again. Let's do AT&T very quickly. All right, this is another turnaround story. You can see here we are looking at a potential breakout in progress. $30 is the trigger. This one is black and white, very simple. A clean break above 30 gives this stock room to move another 20%. There should be no sellers there. As far as
Josh,
risk management is concerned.
Josh.
Yeah.
Josh, forgive me. I'm going to interrupt you because I'm looking at it. First of all, look, there's the Dow, which is up now better than 1,000 points. Forgive me. But there's a headline that's moved, and we'll obviously try and get more detail around it. Apparently from Iran's president, who says we're ready to end the war but want guarantees. So as that has moved from another news organization, and we continue to, try and get you more information on it, it has undoubtedly factored into the trade at this moment. I'll send it. I'll send it back to you. Let's just move away from the best stocks and just focus on this, because if this conflict does wrap up
Put oil
quickly,
up. Put oil up.
Yeah, of course. We can throw that
Give
up
us
too.
crude. Come on.
If this conflict does,
because that's the whole ballgame.
Yeah, that's the story too. If the conflict wraps up rather quickly, are we just to assume that things go back to some degree of normal in the markets as fast?
Yes.
Well, I think it's as simple. It's oil versus stocks. So if you think that there's some legitimacy behind these comments from the regime, and now we're going to enter into a period of talks and headlines about, which points we can get along. Like, the market is going to start to ignore the noise of $100 plus crude and focus back on the fact that we have an earnings season coming up. And it might even benefit the consumer stocks more so than tech. So I know the first stocks to move are always going to be tech because that's where the active traders are. But focus on the XLY names. Focus on the retailers. Because to me, that's really where things could get exciting.
Well, I mean, throw up the NASDAQ, which, guys, Steph, as we were talking, Mike Santoli sat down here too. We'll bring him into the conversation momentarily. But, we were just 2 seconds ago saying, well, hey, NASDAQ's good for about 2%, like 500 points. Now it's 700 points and almost, 3 1/3 percent. So as to Josh's point, these stocks have been beaten up. This is where a lot of money is going into right now.
But a lot of the sectors have been beaten up, so I don't see why we can't see a melt up in all the sectors. Financials are horrible. They've been the worst performing sector year to date. They can certainly bounce. They're going to have really good earnings. Josh just mentioned discretionary. I think the consumer is much better off than people think that they are. The job market still is okay. The JOLTS revisions today actually proves that. And I think you also have some of these industrial companies, because the AI data center build out is not going away anytime soon. So I think you can see a lot of sectors participate.
Just to remind you, too, it's an unconfirmed headline that we have gotten that has moved the market, right? Market moves on anything like this, and then the chase begins to try and get more detail on it. But it's moved the oil market. Mike Santoli, our senior markets commentator, overtime co-anchor, has joined us, too. This will get you to a good place if this is legit.
Of course, yeah. I think it's in the category of don't jump to any conclusions. Nothing's been proven. It's a just don't stay too negative type of reaction is the way I would characterize it right now.
And a reminder, good point.
That we were,
I
yes,
agree.
absolutely primed. I mean, I think we were talking like 3 to 5% is the magnitude of what constitutes a dead cat bounce from where we closed yesterday. All right, we're down like 250 S&P points in 3 days. So just keep that in mind. We're getting back to levels not even to last week's highs. But I do think it is important that, and I agree with Josh, that the market will not get caught up in the nuance if it has convincing, tangible evidence that there is a process in train to actually de-escalate and reopen the strait. That's a lot of ifs. I do think it's helpful that oil has a response here, because all morning S&P was ripping and oil was not moving lower. And that was kind of like a what's going on. It was definitely shadowing this move. So I think that's how you keep it all in context. Everybody knows if this is a normal kind of corrective process, we did a lot of work. If it's something more, then maybe not.
I'll go back, Brian, to the question that I posed to Josh, which I'd like to discuss with everybody on the desk anyway. If this conflict does come to an end reasonably soon, do we just go back to the way it was, thinking that, hey, earnings are expected to be double digits and they haven't come down? Oh, by the way, the market's come in from a valuation standpoint, so now it's even perhaps more attractive in a still elevated earnings expectation environment. So we just sort of play that game?
I think that's 100% accurate. Plus, think about this. During this malaise in the market, the problems or issues that people had with the AI companies, we've answered a lot of those questions with respect to matching revenues and expenses, what's happening in private credit, the companies that have been more consistent in terms of earnings delivery, they've obviously shown themselves. And so we believe that this is the opportunity that we've been waiting for. Plus, the key thing on this news is that this is really the first thing, supposedly, hopefully, that we've heard out of Iran. And so that's a major, major difference, and that's probably why the market did what it did so quickly.
Again, it's an unconfirmed to this point report, but the market, Joe, is just.
But even the unconfirmed report says if conditions are met.
Yeah, of course.
They've had these conditions out there, including reparations and everything else. So who knows what really is behind it? I think we have to keep that in mind.
Well, there's always a healthy dose of skepticism, which is why what was 1,000 points right off the bat is now 750. As say, okay, now the work begins to not only get more information to find out if this in fact is a legit report, if it's a legit statement from somebody with that level of authority within Iran to even make that kind of a deal. Remember, that was one of the questions over the last 24 hours. Who exactly are we negotiating with over there, or who are we talking about having talks with, as we're not even sure, according to many reports, of who is even in a position within Iran to negotiate on that country's behalf and perhaps give what we want. It's a critical question that hangs in the fog of this whole conflict. But at least at this moment, you have had a market reaction of some now 700 and there about 50 points on this one headline that everybody is now going to be chasing for more details.
Yields lower, which is obviously something the administration would applaud. This rally today, the formation of it to me is Mag 7 oriented. The S&P equal weight is lagging the S&P overall, and you had wanted the Mag 7 to take control of the leadership. You're getting that today. So I think that's incredibly important. Also, as we speak, momentum is up well over 3%. So what we talked about at the top of the show, the washout from yesterday down greater than 2.5%, it reverses it all in a 24-hour period, which kind of speaks to what Josh is saying, where the market's looking past a lot of all the nuances of this and just kind of reacting positively.
Yeah, I mean, this is a look, this is a hope. And hopefully not a prayer that it's going to, wrap up sometime soon. And then we're going to have to pick up the pieces and figure out what's what.
But that's why we've been talking about the length of the war. That's what matters. If it is really 4 to 6 weeks, which is what the Trump administration has been saying all along, then we can resume the momentum that the economy has been seeing. We're running about 2.5% GDP growth without the one big beautiful bill. We have a consumer, as I mentioned, that has jobs and they're spending. They are consuming. We see that in retail sales. We see that in credit card data. You have the AI tailwinds. That's what we're going to get back to focusing on if we can get away from this war. And yeah, sure, there's going to be a lot of details we don't know that we have to iron out. But if it's over, it's over. And that is a very big deal, especially since we are so oversold.
I don't know, Mike, I mean, from 50 minutes ago as we came on the air, we were reciting an alleged report from state media within Iran that the Revolutionary Guard was threatening to attack major American tech companies based in the region as of tomorrow evening. Right. And here we are 50 minutes later with another headline talking about the apparent openness to ending the conflict, which has moved the market.
Yeah, and that's why I think the market isn't telling you a tremendous amount unless we get above certain thresholds. All right, I mean, let's get back to last week's high before we start talking about whether the overall story has changed. And so because the market has been straight down and so oversold, I think you have to raise the bar for what is a material move or what has a lot of information content in it, as opposed to just sloshing around and moving quickly in response to hoped-for headlines that have to move far in price to find somebody with conviction to sell it in this moment. That's all I think is happening right here. Look, I agree that things are lining up, including the biggest company in the world deciding they wanted to come on and goose the stock back to 170, NVIDIA, with some news today, and it's actually getting traction. So that's
it is.
That's important when the market actually responds to it.
I was going to go there next, and I'm glad you did. Let's look at NVIDIA on an intraday basis. It's at the highs of the session, so they make this $2 billion investment today into Marvell. They have an AI partnership, and then Jensen Huang comes on the network this morning and essentially says the market's been getting it wrong. And what happens? Well, you see right from this morning's appearance, the stock has steadily moved higher. This is an area that just so desperately needs some level of stability.
Sure, and look, I think, Joe, coming into this week, what was the textbook play? It was the trends have been damaged, the burden of proof on rallies is high, and we might be in a sell rallies mode, right? And so it isn't just Iran and oil, because it seems like the market has been consumed with other issues for 6 months. Now, sometimes when the market has been struggling with these underlying issues, and then you have this kind of focal point crisis, I think of Brexit in 2016, that came after almost a year of Chinese devaluation, of energy credit concerns, of an industrial recession. Earnings took a hit. And then by the end of it, it was actually Brexit, which was kind of a bad news thing, kind of released the market higher. And then, of course, you had the election after that. My point is, sometimes it can be that, the clearing event, and sometimes it can be actually the problem was actually a festering rolling over of the leading group in the market, which is AI.
Yeah, and I also think it speaks to positioning, and that we were oversold coming into today. We worked off a lot of extreme positioning in different areas of the market where people perceived the safety ultimately to be. If I could point one thing out that I think is really interesting, and if we have the ability to show it, if you go out on the curve in crude oil, can we show, let's call it September or October crude oil? And if we can, I'll just speak to it. The spot month is actually down the least of the first 12 months. So if you go out 5 or 6 months in crude oil, you're looking at losses of about $2.50 to $3. You're looking at being down 3%. So that's telling you that the market does not perceive this to be a long duration event. That ultimately, if it can be resolved, the way to hedge against it is in the spot month, but going out longer in the curve, you're seeing significant selling pressure and bigger losses there.
And Pippa Stevens is with us, I believe now too, who watches this area of the market so closely. If you want to react or build on what Joe has said, as we're anxiously watching that chart as much as we are the stock charts these days, Pippa.
That's right, Scott. So we haven't seen the same type of response in those longer dated curves as Joe was talking about, but they still have come up. And it's notable that even with today's decline, WTI is at 101. Before the war started, we were around 65, 67. So we're still up more than $30 since then. And also, today's movement is fundamentally different from what we saw at the beginning of the war, when there were big swings in either direction based on the latest headlines. The fact that we're not down more right now does speak to the fact that there is some skepticism about the extent to which traffic can resume in the Strait of Hormuz. We have seen more ships getting through, but it's still about 95% below pre-war levels. And also, there is now growing concern in the market that we might not ever be able to get back to the pre-war production levels thanks to some reservoir damage, especially in countries like Iraq and Kuwait. And so the consensus is that while we probably might not have 101 going out further down the curve, this is not going to be, the strait is open and everything is back to normal. It's going to take a while for ships to be repositioned, for product flows to get back to usual. And so this is by no means a kind of, once the strait is open, things get back to normal type market for right now.
Sure, we can at least start to, game out when some degree of whatever the new normal is going to be can actually be more firmly in place. Josh, if you played this conflict, for a lack of a better wording, in terms of buying energy stocks that you thought were going to be lifting off as a result of this, and it's no shock to anybody that over the last month, energy, I think, is the best performing group. What do you do now? Because there are many people within our orbit who do own a fair amount of these names.
Yeah, and I'm in that camp, and we've been talking about a lot of energy stocks this year as part of best stocks in the market. I'm personally long ExxonMobil. I think what's interesting is how small energy still is in the context of S&P 500 weighting. Like, nobody really has so much energy that they would look at a headline like this and say, oh, cool, let me get rid of all my exposure. Because the reality is, let's say crude does fall back a bit and truce negotiations start, which, by the way, who literally knows how long that'll go on for, whether it'll be successful. We might be bombing something tomorrow. But let's say that was your intention, is to say, all right, made a lot of money. These stocks are up 39% as a sector year to date. Let me take some off. Does anyone really own these in size where it would even matter? So I actually don't think you're going to get a huge sell-off in the energy stocks. And I think, if anything, this episode that we're living through now is a reminder, something that my friend Nick Colas has been saying for a very long time. You never sell your energy stocks. Because in an equity portfolio, they are your only hedge against unforeseen things like this conflict. And so I think it's a better reminder than it is a sign to take profits.
Hey, Pips, I heard you got something you want to get in on?
Yeah, Scott, just talking about the record run we've seen for the energy sector. When you look under the hood, the divergence between the subsector is interesting over the past month here, because it is the services names. They've lagged names like Kinder Morgan, SLB, really only up 1%. And the gains are heavily concentrated in those upstream players that do have that direct exposure to oil prices, as well as the refiners. Of course, they've been benefiting from the surge we've seen in the crack spreads, names like Valero, Phillips 66, Marathon Petroleum. So when we do talk about this winning streak for energy, it is kind of important to look under the hood to see which names are really outperforming and which are just kind of, at the middle of the road.
Yeah, that's great insight, Steph.
I've been selling energy, to be honest with you. SLB is up 34%, and it went from 11 times forward estimates to now it's at 18 times, and I think they're going to have some issues with infrastructure in the Middle East. Chevron, I'm actually also thinking about pulling back. Yeah, it's only 3% of the benchmark weighting, but it has created alpha for me, being double weight the sector into this move. But I just think the time has come. You take your profits and you go elsewhere.
Fertilizer names. I mean, it's almost the final trade.
Oh yeah, let's approach the end of the show. CF must be down.
CF's down
a bunch,
5%,
right?
5% right now. So that is a position that I established on the very first day of this conflict on March 2nd. I've identified an area. It's 119 to 120 where I think you want to put in a stop loss. You're certainly going to need it if this news builds momentum.
I mean, there are that is one of many idiosyncratic stories that.
Yeah, I wouldn't own this stock if it weren't
Yeah, well,
for
of
this.
course. I mean, you bought it during the early stages of this conflict, really anticipating that it would be one of the areas within the market that would get a bump. Michael, thank you for being here. I'll see you later this afternoon, and then of course everybody will see Mike on Overtime with Melissa at 4 o'clock, and we'll discuss what you guys have coming up there a little bit later today. Josh, you have a final trade?
Oh man, let's reiterate Netflix. I bought more recently, and I like it.
Okay, good stuff. Belsky?
Berkshire Hathaway, BRKB.
And stock hasn't traded all that well lately either, so we'll see what it does from here. All right, Stephanie Link.
ServiceNow, fairly new position for me, down 32%, 25 times earnings for 27% RPO growth.
All right, is software going to have a better quarter? We shall see. Joe T.
Apple. Mentioned already what I would do in CF Industries, but I'll go back to Apple. This is a Mag 7 driven rally today.
Okay, so we're hanging on every market move, as I know all of you are as well. Right now, the Dow's up 850 points. It's come back off. Remember, right off the unconfirmed headline, it was up better than 1,000, but we shall continue to follow it on the exchange now.
All right, thank you, Scott. Welcome to the exchange. I'm Dominic Hsu in for Kelly Evans today. Stocks are sharply higher, as you can see this hour, on an unconfirmed headline that Iran is ready to end the war if there are certain guarantees made. That's sending the Dow up more than 1,100 points at the highs of the session so far. Technology is leading with the NASDAQ up about 3%. Meta Platforms, Microsoft, Tesla shares, NVIDIA, some of the real standouts in trading so far. That Mag 7 trade adding roughly $450 billion in market cap just today alone. That's about the size of Costco. Again, just for context and size. But Goldman's pointing out they collectively lost more than $3 trillion coming into today's session. Now, most of the memory trade is also bouncing back in this session as well. Check out names like SanDisk, Western Digital, Seagate, all higher. Micron is trailing a bit and still lower for the week so far. And of course, we're watching oil prices coming off earlier multi-week highs on some of those reports out of Iran. Brent crude up again, up $118. Crude for U.S. futures, roughly $102 per barrel. So let's get straight to Washington, D.C. and Megan Casella for the latest on the Iran situation. Megan.
Hey, Dom, so that's right. That really is that headline that's lifting markets today that clearly are eager for any sign of optimism that an end to this conflict could be close. So this headline is coming from Iran's Press TV, which is state-affiliated media. And the report is that the Iranian president spoke today with the president of the European Council. And in part, the readout that's being reported here is, quote, the solution is an end to aggression. Iran seeks no war, but is prepared to end it, with guarantees against further attacks. So the Iranian president appearing there to lay out some conditions upon which Iran would be willing to end this conflict. Now, two things I want to add to this. One is that the European Council president who spoke with the Iranian president posted on social media earlier today confirming the call, saying that he did speak with the Iranian president. The EU Council president said he urged for de-escalation and restraint, as well as the protection of civilians and civilian infrastructure during that call. So confirming that it did take place earlier today between those two parties. The other thing I would note is that this is not the first time that Iran's president appeared to lay out some conditions for ending the conflict. Just yesterday it was reported he said that any decision to end the war must guarantee people's security and interest. But of course, markets moving on this now as they appear to be very eager, as I said, for any sign that we could be close to an end here, Dom.
Hey, Megan, so can you reconcile for us the rhetoric that we are hearing from this unconfirmed report out of state-affiliated media, again, unconfirmed report, against what President Trump has publicly said via Truth Social, other social media platforms, with regard to just what the U.S. would need to see in order for us to seek some kind of a resolution to the Iran conflict right now? The 15-point plan versus kind of what we're seeing right now in piecemeal coming from state, affiliated press in this unconfirmed report. How is this the beginning of a negotiation, I guess is my question?
That's the biggest question, of course, Dom, is what sort of negotiations have been ongoing, because we've heard mixed things on that. The Iranians so far had been denying any sort of negotiations have been taking place. The Trump administration has been emphasizing that, of course, there are real talks ongoing. What we've heard, the latest we've heard from the White House, from the Defense Department today, is that talks are ongoing. They want to work towards some sort of negotiated diplomatic solution, but they are prepared to keep going militarily as long as they need to. So this latest thing maybe is the Iranians saying there are talks ongoing. We just don't know quite yet. So much more to come. We will see if the White House responds to this directly. As far as we know, though, their posturing is more or less where it has been, which is that they're ongoing militarily as long as they can. But the president would like to make his way out of this within that 4 to 6 week timeline. We're on week 5 now.
All right, Megan Cassella with the latest in Washington, D.C. on the Iran situation. Thank you very much. So I guess the question now is, can we trust the bounce we're seeing in the markets? Joining me now for more on that question is Matt Miskin, co-chief investment and strategist over at Manulife, John Hancock Investments. Matt, you heard Megan's report on these, again, unconfirmed reports coming from what we think is state-affiliated media in Iran. What exactly do you read about the market reaction here? And is the investor community on Wall Street looking for just anything to say that this is over and that we can get back to business as usual?
Well, regardless, it's a great tell. It tells you exactly what has been punished the most here and has upside resolution or decline in oil prices. So quality tech stocks have been beaten up the most. Actually haven't really been driven from the war at all. Most of the selling pressure you've seen in the U.S. equity market has been driven from AI concerns or regulatory concerns on communication services or private credit in financial services. In our view, a lot of this selling pressure has nothing to do with the war, and it really hasn't been fundamental in nature. But this kind of day will show you exactly what has the upside. In our view, high quality stocks with earnings season around the corner represent an opportunity here to take a look for some good value.
Okay, so Matt, let's put this in, again, I guess, relativity with regard to other market downturns and market kind of sell-offs that we've seen, especially since, say, post-Liberation Day, so-called Liberation Day with the tariffs back in April of last year. Has it been surprising to you in some ways, maybe how orderly, and again, I say that relatively. Obviously, we've seen a huge amount of value wiped off the stock market, but it hasn't been as volatile, either by the VIX or in daily price movements that we saw during the few days, the week right after those so-called Liberation Day tariffs were announced. What exactly does that tell you about how the positioning is in the market right now, Matt?
Yeah, the last year, Dominic, has really been a momentum-driven year. So it's been these stocks that have seen massive flows, really kind of trend-following type investment strategies. And really that had to unwind. That really saw selling pressure, and it's actually somewhat healthy. You know, some of this stuff had just rallied way too much year to date. In the first couple months of the year, just way too much kind of a run. In our view, you needed some corrective price action. You needed a resetting of sentiment because it was just getting a little too frothy. And now this, you know, in terms of how we're going to work our way out of this, you know, I think the U.S. is going to be relatively insulated. You got the U.S. as a net oil exporter. We've got a natural gas reserve of the best in the world. We can export energy resources. And then we have technology in other industries that are not as reliant on energy. So I think you got an opportunity here to look for some value in markets. It's not cheap by any means, but it's cheaper than where we were just about a month ago. I think the relative orderly nature of it, you know, it's a lot of geopolitical risk. It's a lot of headlines. It is challenging for investors to get through. But if you focus on the fundamentals and still see some good earnings growth coming here in Q1 earnings reports, look for those companies that can drive earnings growth through this challenging macro environment.
All right, because you opened the door there, I'm going to walk through it from a strategy standpoint. What parts of the market are positioned for that earnings growth, for that relative value trade? We know that over the last month, there is only one sector in the S&P that is higher, and that is energy. So where else in the market do you go, given what we know right now?
Yeah, our favorite theme is infrastructure-related equities. So that is a combination of industrials and utilities. It's actually favoring kind of the companies that are going to benefit from the One Big Beautiful Bill, CapEx investment. Also, it has aerospace and defense. It has pricing power on the utility side. There are defensive elements to that. But to us, that's kind of a shorter term outlook. I'd say 3 months, 6-month outlook. I would look over the next couple months for the tech sector, though, and quality stocks in general to pick up and add to. You get some more downside or volatility here. There's other parts of the market to look to, but for now, infrastructure-related equities, get a dividend yield, reduce some volatility, and the earnings growth looks good for both those sectors in particular.
All right, one more point, Matt, before we let you go. Everything that's happening in the equity markets aside, are you worried about what's happening with some of the downturns that we're seeing in certain parts of the high yield market and private credit?
Yeah, it's giving us a yellow light. So it's not a red light yet. We're just over 3% on high yield spreads. I'd say 3 to 4 is yellow, 4% plus is a red light. You are seeing relative bond market volatility as well as equity market volatility. That is difficult. But in terms of defaults, we're still pretty low here, around 4%. You're seeing, energy sector is a big part of the high yield market. And so is basic materials. And materials have actually done pretty well with the commodity rally. So high yield's holding in okay. Initial jobless claims are still low. Those are canaries in the coal mine for us. I'd say high yield's giving us the yellow light, but initial jobless claims still being low, giving us the green light. Economy looks okay for now.
All right, constructive. Matt Miskin with Manulife, John Hancock Investments. Thank you very much. We'll see you soon, sir.
Thank you.
All right, stocks are surging on, again, those unconfirmed reports that the president of Iran is open to possibly ending the war. So let's turn now to how that could play out. Joining me now is Jonathan Panikoff, director of the Scowcroft Middle East Security Initiative. Looks at a lot of these situations here to analyze what's going on here. Jonathan, if you know what we know so far in these unconfirmed reports that we are seeing on social media attributed to a state-allied, I guess, news agency, how exactly would you then play this out with regard to what the possible outcome is for the next week or two?
Yeah, I would do so with a lot of caution and a bit of skepticism. Look, the fact that this is coming from President Pezeshkian is the first indication that, yes, there could be something more fulsome here, but we've got to be really, really careful about it. You'll remember, it was a couple of weeks ago that President Pezeshkian came out and said that he apologized to Gulf allies for Iranians striking them, and then right after, there were more Iranian strikes on him. The reality is, it's the Iranian Revolutionary Guards who have control of the government right now, not the president. And so I think we want to act a little cautiously. That said, look, Pakistan clearly wants to mediate. They met with China today. There's a release that they had together, 5 points to ending the war. The Chinese are going to be critical to get the Iranians on side. So I think clearly there's some movement toward a diplomatic solution here, but I think we're quite far away from it still.
The administration has been touting some of the key military, I guess, victories, if you want to call them that, over the course of the past 24 hours, specifically with regard to targeting some of the ballistic missile stockpiles that have now been bombed, at least one of the larger ones near Isfahan. Yeah. Is this going to be a situation where only victory can be proclaimed if Iran agrees to all the points in that 15-point plan that the administration has laid out? Or is this, again, a negotiation where some middle ground happens?
Look, you've got three real possibilities to end this war, and right now none of them are particularly good for the U.S. President Trump can decide to double down, which I don't think is going to end the war, and put military U.S. forces into the country. He can try, frankly, to get a negotiated settlement, which is where you see the market rising on that information today, as we just talked about. Or, frankly, he can unilaterally withdraw. There was a piece in the Wall Street Journal overnight that said that he was considering that. In any of those cases, there's going to be huge discrepancies in terms of what outcome is and what victory is. If we don't have the actual highly enriched uranium recovered, that's going to be a cause for real concern, the 440 kilograms. If you don't have the Strait of Hormuz reopened, that's going to be a cause for concern. All things that could be negotiated over, but again, I think there's still going to be quite a long ways to go here, and to figure out the pathway to resolving all of them before, frankly, the president might decide, no, we have to push forward, put troops on the ground to try to take care of some of these issues that way.
Jonathan, there have been a lot of reports, a lot of statements coming out from some of the leaders, high-profile government officials, even in some of these Gulf Coast countries around Iran, that have said basically that they want more of a true regime change or true victory by the United States and its Middle East allies in order for them to feel comfortable with any kind of an Iran solution. How exactly are those countries, like the UAE, like Bahrain, like Kuwait and others, going to at least try to influence what kind of an outcome we could see?
Yeah, I think that's absolutely right. Saudi Arabia as well, perhaps the biggest one here. Look, for those particular countries, the challenge is that if you leave a situation in which Iran has unilateral leverage or even meaningful leverage over the Strait of Hormuz, it means that they fundamentally have to engage and make a deal with Iran separately, and that's a very, very concerning proposition to them long term. The same is true if you leave ballistic missiles or Iran has the ability to reconstitute its ballistic missile program. They're worried that they're going to be back under threat. And so they want the U.S. and Israel behind the scenes to push forward, to go through as much of their target list as possible. That's probably going to take another, frankly, couple of weeks to get through it all, in order to at least buy as much time before Iran can meaningfully reconstitute either its proxy network, its ballistic missile capabilities, and really threaten them in the same way. The one X factor here is we've seen that even without those resources, Iran's drone network is just unbelievably sophisticated and capable. And they have thousands upon thousands of drones that are built cheaply, and all of them are going to be a fundamental threat to the Gulf long term. So there's a little bit of a juxtaposition here between broader calls for diplomacy, while the Gulf states are scared that diplomacy won't actually protect them sufficiently going forward.
Defense Secretary Pete Hegseth, others in the administration have said this is so far right now negotiating with bombs. This is what we're doing right now. In what way does the U.S. have an off-ramp without putting boots on the ground in Iran? Or are the objectives that the U.S. seeks to achieve only attainable with boots on the ground in Iran? It's a massive debate right now.
I think the answer is, what are the actual objectives that the U.S. is fundamentally seeking? If it is just about destroying the Iranian Navy, diminishing the ballistic missile capabilities, diminishing Iran as a near to medium term threat, then sure, most of that has been done. The problem is strategically, Iran's threat projections are actually now much bigger than they were when before the war started, and their leverage is actually greater even as they've been militarily diminished. That, frankly, inverse relationship is continuing to play out because the longer that they can threaten the Strait, if they begin through the Houthis to be able to threaten the Bab el-Mandeb in a meaningful way, it's going to be really, really difficult. And to add to this, look, the guards just came out today and also said that certain U.S. companies, 18 of them, Apple, Google, Meta, all of them also will be considered legitimate targets going forward because they're supporting the U.S. war effort. I think a negotiated settlement, even one that is not what the U.S. would want, is probably going to be the best off-ramp, but it's not actually clear that U.S. minimums and Iranian minimums are close enough to each other that you could reach one anytime soon.
All right, it looks like, again, these unconfirmed reports are leading to a whole bunch of scenario analysis changing with regard to assumptions there. Jonathan Panikoff of the Atlantic Council, thank you very much. We'll see you again soon, sir.
Thank you.
All right. Well, meanwhile, Kansas City Fed President Jeff Schmidt is speaking about the economy right now, and I'm sure there's a whole confluence of factors at play. Steve Leisman has the headlines here. Steve.
Yeah, Dom, sorry to rain on this bullish parade going on right now, but Kansas City Fed President Jeff Smith out with some hawkish commentary, saying the Fed must, quote, follow through with policy actions that have anchored inflation expectations. He doesn't say the Fed should hike, but certainly he's not talking about rate cuts there and maybe hinting at hikes. He says the Fed cannot look through oil price increases with inflation already too high for too long. He said he was concerned about inflation even before the current energy price shock arrived. Now is not the time, he says, to assume that inflation from higher oil prices will be transitory. He says it's up to the Fed and what the Fed does as to whether a price shock ends up being transitory or not. He goes on to say that the Middle East developments will add to inflationary pressures. And importantly here, he adds, including concern about core inflation with higher oil prices seeping down into things like transportation and other areas. Inflation progress, he says, appears to have stalled. And he's more concerned, he says, about the inflation than he is economic weakness from the oil shock, because he says there are tailwinds out there that are going to help the economy, that are going to offset the oil price shock. Among them, large tax refunds, he says, could soften the blow to consumers from higher gasoline prices. The economy and the consumer, he said, have been resilient. Consumer spending have been resilient. So, Dom, I'm looking here at the probabilities. Still, the market is really 70-80% through January of 2027 for no change in the funds rate. And I would also point out that even with this announcement that you've been talking about, oil prices remain over $100, so still something for the Fed to think about there.
All right, so medium to longer term, we've talked about, you just brought up the possibilities for a possible Fed rate action towards the back half of this year. If you look at the way things are sorting out with regard to what's happening with Iran vis-a-vis our job market perhaps slowing down a bit, perhaps inflation being high on the energy side of things, but maybe not as much on others. How difficult is the job for the Fed now, given what we've seen coming out of the oil price market and everything else with regard to inflation?
Well, it's very difficult. And I think the reason, Dom, is that it's very difficult for the Fed to act preemptively towards anything because it doesn't know which way things are going to break. You had Powell yesterday make an interesting comment about the idea that oil price shocks can be temporary, but when you change policy, there's a long lag to when it affects the economy. So you don't want to be, for example, hiking rates in that context. At the same time, if this oil price increase drags on and it remains high, pardon me, and you get to a situation where you have brewing inflationary pressures, the Fed could potentially be behind the curve when it comes to trying to stave off inflation. And look, let's put Jeff Schmidt in context. He's a known hawk. He comes from a long-running tradition of hawks at the Kansas City Fed Bank, including Tom Honig and I'm sorry, I'm just blanking on Esther George. Esther George, those two were also hawks out there. And so he's expected to come to this point of view, but I think he's not probably alone in his concern about inflation being too high for too long and the need, Dom, for the Fed to at least not address it by talking about rate cuts.
All right, where is the scale tipping? Towards the jobs market or towards inflation? Steve Leisman with the latest there from Kansas City. Thank you very much on that. Oil, as Steve points out, is moving lower in the last hour. Pippa Stevens is here with more on those price moves and just how much traders are putting at least stake into these comments coming from Iran state media allegedly.
Hey, Dom. So WTI is sitting at about $100.64 right now, with Brent crude at 103, each down about 2 to 3%. So clearly not a very large move here. And I think it's also notable that early in the war, tweets or reports like this would have moved oil in a much larger fashion. The fact that WTI is only down some 2% indicates that the oil market is taking this, this report with some caution here. We don't have many details at all, and we don't really know what the parameters are. Of course, one of the ideas floated by Iran is operating a toll booth, so to speak, through the Strait of Hormuz. They already are charging ships some $2 million, but there is a lot of angst in the market about the sustainability of that long term. The Strait of Hormuz is, of course, in international waters, and so that would be illegal. And so there are a lot of questions here about what Iran is looking for. But I think it's important to remember that while WTI is down 2%, it's still at $100, as Steve was just talking about, and up about $35 since the war began. So that is a very large move. Brent is on track for its biggest monthly gain going back to the contract's inception. WTI also up about 50% on the month. So, prices are coming down today, but clearly there's no, jubilation in the oil market that this is indication that oil will be flowing through the Strait of Hormuz anytime soon.
Pippa, over the last couple of decades, there have been a number of geopolitical risks coming out of the Middle East that have driven up oil prices, and then we've seen them come down rather precipitously in the weeks that, after things have been resolved. Is there anything that you're hearing about from your energy sources, from your oil and gas sources, with regard to whether or not there is a structural up move in the entire oil and gas market, given this particular action with Iran, as opposed to other actions that we've seen out of the Middle East over the past 20 to 30 years?
So everyone in the industry says basically that this is different. This is fundamentally different because while the threat of Iran closing the Strait of Hormuz had always been there, it had never actually come to fruition. And so people in the energy industry say that this is different and this resets the floor for prices looking forward. That means that there will be a geopolitical risk premium priced in looking forward, and that this does bring up the floor. There are still so many unknowns at this point, but for so long, the closure of the Strait of Hormuz had always been a tail risk that people didn't think would actually happen, and now that it has, that does reset the narrative, and it also makes you wonder if there will be a reshifting of energy flows throughout the world, with people saying that they can't be so reliant on one region, one country, especially with natural gas and Ras Laffan coming offline. Countries are going to look to diversify. So even if this doesn't lead to long-term gains, it will certainly lead to people rethinking the security of their energy supply, Dom.
It may appear as though U.S. oil and gas, U.S.-based oil and gas is a relatively attractive proposition, I guess, in these types of times. Pippa Stevens, thank you very much for that. Let's dive further into these market moves with Victoria Green, G Squared Private Wealth CIO. She's also a CNBC contributor. Maybe a scene setter question right now. From a trader's perspective like yours, how do you treat the headlines that we're seeing coming out of Iran right now? Again, we have not confirmed them. They are still unconfirmed reports, but they have moved the markets notably.
Yeah, we actually talked about this recently. It's very rare market sell-off more than 5 weeks in a row. So we released a note Monday saying we were looking for a bounce this week, and this is what we're getting. Any good news is going to cause a bounce like this. We also have this not corroborated, but at the same time, you have the Wall Street Journal coming out saying, hey, Trump's looking for this off-ramp. He's willing to step away without the Strait of Hormuz open. And so you kind of have those two reports combined together saying, are both sides really looking for a deal here? Now, it's unconfirmed. We're going to move by headlines. Any bad headline tomorrow or tonight is definitely going to take markets back down, because this is completely geopolitically moved right now. Fundamentals don't matter. Technicals don't matter. It's what's the news flow. And right now, between the two reports from the Wall Street Journal and Trump looking for an off-ramp, and this one now, it gives hope to the markets that, hey, look, we had a normal war-driven sell-off. We went down about 10%. We've gone down about 5 weeks in a row now. Are we catching a bottom? Now, if you look at some parts of it, have we capitulated? Did we have a washout day? No. So there are going to be people looking for the washout day before they want to hop in. But we look at this very, very good news.
Okay, so if we are looking at this as good news, to your point and to your view, if you look at the way that the markets have been reacting given some of these headlines, is it safe to say, or not, that when traders or investors are putting these types of price movements in play, given headlines like this, that there is a bias towards being long this market, hoping for some kind of a resolution? And would that ultimately put some kind of at least soft floor on just how much the markets could actually fall if things hypothetically get worse in Iran?
Sure. Absolutely. I think you've had a consistent amount of dip buyers come into this. You've seen some potential background stuff on what are hedge funds doing and institutions. Would there be net buyers of the U.S. market if we had some sort of knee-jerk down on reports of this being false? Absolutely. Dip buyers have been very consistent. The long-term uptrend is still intact. And as you guys talked about earlier, you have some good macro back there. You've got all the things happening with the tax refunds. Earnings are still growing. So you have this disconnect where this is a complete multiple compression. This isn't about earnings recession. This isn't about earnings going down. This is a straight up just multiple compression, stock prices moving down, making some of these cheap. We talked about Meta's cheaper than Exxon nowadays, and if you look at Meta's profit growth versus Exxon's profit growth, will some people start stepping in to buy some of these beaten up names? And you're seeing that today. You saw that today before the news flow. So because of this consistent investor sentiment towards buying the dip, as well as this administration being very economically friendly, lower regulation, lower taxation, earnings are still growing. Those are really strong background catalysts in this market.
All right, so we have this happening right now geopolitically with regard to the Middle East and Iran. We also have, not far from now, a full-blown earnings season cycle kicking off yet again. Just how important is this earnings season vis-a-vis what we're seeing right now from a macro perspective out of the Middle East? And would you then be looking for what companies are going to speak about how their costs are going to be impacted for the latter part of this year, given some of the ripple effects that we're already seeing in energy costs and other costs rising right now?
Absolutely, and it's always crucial because banks kick us off. So I'm going to be hyper-focused because Jamie Dimon is known for being a little bit of a bear. He likes to go out there and talk about all the things that are wrong. I want to hear what they're talking about. Are they setting aside more loan loss provisions? Are they worried about the private credit blow up? Are they concerned about consumer spending? Looking for that credit card data. Let's get that under the hood look that banks give us at the consumer and see what their tone and sentiment is. Are banks pulling back and getting more cautious, or are banks continuing to lend and feel good about their balance sheet? That to me is a very good underlying reader of how healthy do the people that see the day-to-day transactions, that see what consumers and businesses are doing, how healthy do they feel about it? Are we concerned that this inflation and the energy costs we always talk about, higher gasoline's a tax, right? So it takes more money out of the consumer's pocket, less money potentially for spending on restaurants, on leisure. But if you look at what's rallying today, it's airlines, it's leisure. And we think obviously consumer is going to be able to sustain this upbeat. That is what the market is pricing in right now. It'll be very, very interesting about the tone, about the earnings outlook. You know, the things that we're looking for are upbeat tone, are continued beat and raises. The things that we're worried about are people stepping back from their guidance. That to me would be a huge red flag that you need to be aware of. If all of a sudden some of these corporations start stepping back from their outlook, pulling guidance, that's the red flag that under the hood, not all is well.
So since the great financial crisis, the U.S. trade, being here in U.S. stocks, has been the clear outperformer versus all parts of the world. That narrative, Victoria, changed a little bit over the course of the last 18 months or so, with a lot of people saying, hey, it's time to maybe spread some of those bets away from America into international markets, more global in nature. But does this particular conflict and the market reaction that we've seen around the world, the economic impact that we are forecasting around the world, especially for emerging market economies, developed Asian market economies, whether or not the U.S. is, again, the relative safe trade with regard to how things operate around the world, we seem to be faring better than other parts of the world given this conflict in Iran.
Oh, God, yes. I think it's a clear play that the U.S. has continued to be the gold standard for where to invest, both on what's happening in treasuries, what's happening with the U.S. dollar, as well as what's going on with U.S. stocks. We've held up much better relative, especially versus emerging markets. Emerging markets have fallen about 10% on average here. Developed international also have struggled more than the U.S. markets. That's because they're more exposed to energy disruptions. We are not expecting major shortages here. Our cars are going to continue to run, our buses, our flights, our jet fuel, all of that. We continue to think, hey, we are well supplied here. We are more insulated here. Yeah, the cost might go up, but you're not looking at having to maybe have shortages or rationing. You are actually potentially looking at that across Europe and Asia. That obviously changes the trajectory of those economies substantially, especially the longer that oil stays over 100 and the longer these flows remain disrupted. I mean, we saw today the issue with potential jet fuel in Europe and how much they get from the Middle East and how difficult it is for the Middle East to get out refined product right now. That's less of a risk here in the United States. So you are seeing the haven trade come back here because you're saying, man, we want these quality companies. We want things that are a little bit more energy secure right now. I think it's a boost here. I also wouldn't take a pass at Latin America now. I mean, Latin America should also benefit as a large commodity producer themselves that are also insulated from the disruption in the Middle East. Could be a time a little bit for LatAm versus the Asia trade that had been going on. So I do think the rise of the U.S. is back in vogue, and I think this trade is going to continue as long as there's disruption in the Middle East.
From your perspective, how much lower could these U.S. equity markets get before bouncing, or are we kind of there? Has the price action today given you an indication that we are kind of near the bottom from a market perspective? And if so, in any potential bounce back, because there will be one longer term, does this reset the narrative for that mega cap technology, media, and telecom trade to come back to leadership? It's relinquished it over the course of the past year or so.
Yeah, I do. I'm a little worried today's maybe a dead cat bounce. I'm not sure it's going to hold because it's so news driven, and until the news is confirmed and we really get the things open, there's this risk that it falls apart. So right now, I think this is a relief rally, but we talked about we hadn't seen capitulation yet. Typically, you see that washout day before you hit a bottom. So I'm a little bit concerned the bottom's not 100% in, but I also don't think we're that far off, right? I think you maybe the 6,300 maybe would be the limits. I think you're not here at a full washout. You're going to have your normal correction. That's very typical. It's a volatile midterm midterm election year already. So you had all of these forces already in the background. So right now, normal correction, but we haven't seen that wash out. So a little bit, I'm not throwing whole hog at this. I'm excited we get some relief. It's going to make all of these quarterly numbers look better, but I'm a little concerned news flow, if it turns negative, we'll be right back to where we started.
All right, Victoria Green, G Squared Private Wealth, thank you very much. We appreciate it.
Thanks, Dom.
All right, so we've been showing you all of the boards here for what's happening with the equity markets. The narrative is pretty clear. The markets are up in a strong way. Let's turn now to the bond market and the reaction we are seeing over there. Both treasuries and the dollar are poised to close out a pretty strong month. Rick Santelli out in Chicago with more on the state of play in fixed income and rates. Rick.
Yeah, you know, yesterday the big news was that Chairman Powell kind of talked down interest rates a bit, but really, I think Chairman Powell is just paying attention to interest rates, because it was on Thursday, Dom, that the 2-year stopped paying attention to every single upside move in oil. That chart says it all. And in my opinion, I think markets are pretty smart when it comes to what's going on in the Middle East, because I understand unconfirmed stories, but in the oil market specifically, there's smart money from the region that has maybe more fingers and more pies as to what's going on than many of the news sites in the U.S. or around the globe. And I think that chart tells me that the worst may be behind us. Now, this is just my opinion, but I think we've seen the high in interest rates, and I think we've seen the low in equities. And I don't have any inside knowledge here other than monitoring markets. And I've always thought, for the same reason we're putting so much stock in betting and probabilities and all of these websites, for the same reason. There's a certain intelligence when money goes into the marketplace, especially regional marketplaces like the Middle East. So we go from 105 to under 100 briefly in oil. That's an unusual trade, and I put some credence in that. And as far as interest rates go, when we get a close under 375 in 2s and under 430 in 10s, in those instances, that would confirm to me from a technical perspective that the high yields most likely are behind us, and that session may be today.
All right, Rick, how exactly, I mean, you mentioned the term structure there. If you look out kind of across the curve, just how much can traders out there who are in this rates market discern what the economic impact is on a medium to longer term basis as we approach the back half of this year? In other words, I guess, how much do we have to worry about the effects of the war, the effects on energy prices, and the knock-on effects from there into how economic growth shapes up and the inflation picture shapes up for the second half of the year?
Well, I'll go in reverse. The inflation scenario has been the last mile, and it's been with us for months and months and months longer than the conflict. As far as the conflict, I don't care about what central bankers say. I would be willing to bet the largest cheeseburger in history that no central banker is going to be raising rates into the type of action we're seeing out of the Middle East and its effects on oil market on this current timeline. And as far as what I would suspect is the long-run game, it's now become a relative value trade, Dom. The rest of the world is not going to rebound as quickly as us economically. The rest of the world is not going to be in as good an energy shape as us. So to me, the question isn't what I think the economy is going to look like. It's where the money's going to go. It's about the money, and the money is going to come here.
All right. The America First trade may be back again there. Rick, thank you very much for that. Let's dig into some of these moves even further with the impact on the longer term kind of effects on the economy and what this war could have with regard to how that economy shapes up. Peter Bookvar, Chief Investment Officer of One Point BFG Wealth Partners, joins us now. Peter, you heard Rick's report just now. Do you feel as though the long run, or I shouldn't say the long run, the medium to longer run trajectory of the American economy will be that adversely affected by what's happening with Iran right now?
I don't think so, but I think that there's certain adjustments we're going to have to make. I don't think crude oil is going back to $65. I don't think gasoline prices are going back to $3. I think maybe 85 is the new 65 when it comes to crude, and gasoline prices will fall, but as I said, not going back to 3. There's definitely going to be a long time between with some normalization on supply chains, but I think we'll manage it. So I think the market is going to go back to thinking about the things that it was managing before the war. What's the sustainability of the AI tech trade? What's going on with private credit? And also, it's important to understand that the inflation statistics, at least at the wholesale level, the import level, were very hot in February, even before the war started in March. So, and Rick is spot on, the Fed is not raising interest rates. I just think that the stickiness of inflation coming into this bout of even higher energy prices is going to keep them on hold. And while Kevin Warsh is going to want to cut rates because he's going to want to focus on the labor market, I'm not so sure that the long end of the yield curve is going to be so tolerant of any cuts on the short end of the curve.
If that rate dynamic is going to be in play for at least what we're going to see in the next maybe week, 2-3 weeks, how exactly then does it play out towards the back half of the year? Do we start to see a more normalized movement with regard to the rate picture right now? And would that indicate that the American economy is due to bounce back, as Rick points out, quicker on a relative basis than pretty much every other developed economy out there in the world?
Well, of course, we hope we get some sort of normalized yield curve. But a lot is going to depend on, again, that dynamic and how persistent inflation, while well off the highs, but still sticky. And I want to make the point that just because inflation doesn't show up at the consumer level and sort of gets stuck at the producer level via having to eat margins, doesn't mean inflation's disappeared. So you can get further deceleration in CPI and not in PPI, but that still is an inflation issue for a lot of different companies. Europe and Asia, it's going to take time for them to recover because, again, they're higher exposure to imported energy, but they will, and the world will get back to hopefully somewhat where it was pre-war. But again, I think that commodity prices are going to stay elevated, notwithstanding this pullback upon cessation of this war and the reopening of the Strait. And I do think that inflation is still going to be a persistent issue through the rest of the year, which is going to impact the entire yield curve.
We haven't talked a lot, Peter, about the kind of effects that previous geopolitical oil shocks have had in certain parts of the market. And I'm not asking you to be a trader, or an investor here. I'm asking you to kind of frame this in a broader economic context. We used to talk about spikes in oil prices leading to, I guess, maybe more attention being paid to things like alternative energy, to solar, to wind, to electric vehicles and everything else. We're not seeing as much of that play out this time around. What exactly does that say about market structure to you, that we could have a big geopolitical risk, the biggest oil shock some countries say that they've ever seen out of the Middle East, and maybe a more muted response, relatively speaking, to those other parts of the market that have historically reacted more forcefully to this kind of a move?
Honestly, I think it's a lot of physics. I think we've learned that solar and wind is not the answer to all of our energy needs because they're intermittent. They're not consistent. You need natural gas, you need nuclear, and you still need oil, crude oil. So maybe not to the same extent after this experience, but instead of going full on EVs, maybe people go to hybrids because that's a much more efficient sort of energy source in terms of a vehicle. So I think it's a lot of that. We tried all wind and solar, or at least some parts of the world did, and again, it's not the most efficient, and it is certainly not the most reliable.
All right. Peter Bookvar, thank you very much. We appreciate the perspective. Actually, we're going to stay here right now for just one moment, if you could. We are going to try to figure out, from your perspective, whether or not the market moves that we are seeing right now maybe are justified, given the economic outlook that you currently have, and whether or not we could see more of a bounce because of it if the economic picture does recover quicker, Peter, if that's going to be a big deal.
Yeah, I do think we can have a further bounce. Just from a sentiment standpoint, I look at the CNN Fear Greed Index, and yesterday it got to 10 in a range from 0 to 100. I think at the depths of COVID, maybe it got to 3 or 4. So from a sentiment perspective, we were ripe for a rally, and all you needed was the reopening of the Strait, the end of the war, to further that. That said, I'm not as enthusiastic after that rally because I've been of the belief that this AI tech trade, in terms of its dominance, has been waning. And I do think that that's going to reassert itself after this relief rally.
All right. Peter Bookvar, thank you very much for the perspective. We'll see you again soon.
Thanks, Tom.
All right, so even if the war does end in, hypothetically, the next few days, how long would it take for this energy market to back to normal operations? And if so, does it mean higher for longer, as Peter just alluded to, when it comes to oil prices? Is there a structural change higher in that pricing dynamic? With us now to give her view is Amrita Sen, founder and director of market intelligence over at Energy Aspects, one of our oil experts we turn to. So Amrita, is there a structural shift in oil markets? Can we expect to see just generally higher prices than we've seen over the past decade in normal times?
Absolutely, yes. And the reasons, again, Peter was saying, his views, and I actually very much agree with that, because look, what we are talking about is a structural shift. Firstly, I know we've sold off very sharply right now, but let's be very clear. Nothing's actually changed. The Iranians have always said they're willing to, quote unquote, end the conflict if conditions are met. That's the key word over there, the conditions. And also the president who's communicating is hardly the one making the decisions right now, right? So it's a market. The macro investors want to sell this. They kind of fear, the president might be tacoing. But in reality, and the question you're asking is, this is a structural shift. It's going to take months for production to come back. But even after that, you're going to get restocking demand because Asia is feeling outright shortages. All the strategic petroleum reserves that are being given out now will get bought back. But finally, every company I'm speaking to in Houston and in the US while I've been here, they are now reconsidering whether they want to invest in the Middle East. And if they are to invest in the Middle East, they need a higher rate of return. So that in itself just increases that break even by $10 to $15. So in our view, after we've kind of settled down, and that's a while away from now, bare minimum crude needs to be $70 or $80. I think it's probably going to end up being even higher than that if we realize that there's potential damages that's occurred to upstream when the restarts happen.
Of course, when you say $70 to $80, I immediately think, is she talking about West Texas Intermediate? Is she talking about Brent? And that leads me to the next point. If you look at the way that the global oil dynamic has now shifted because of the Iran war, how much more attractive is it for U.S. oil and gas and its companies versus other oil and gas companies around the world and other oil-producing regions, country-wise, sovereign-wise? Does this then make U.S. oil and gas that much more of a kind of, I wouldn't say, last line of defense, but is it the most reliable oil and gas source around the world? We're already the biggest producer of it.
Absolutely. I think the U.S. benefits significantly. Americas as a whole benefits significantly. You can see that already. Asian buyers of crude oil are flocking to the U.S. Japan in particular, it's absolutely soaring. On our calculations, U.S. exports of crude oil to Asia are around 1 million barrels per day usually. In April alone, it is going to be more than 2.1 million barrels per day. On average, the Asian markets are basically now doubling the volume they get from the US. And the same goes for LNG as well, because of what's going on in Qatar. So US is absolutely, the producers here are benefiting, the midstream companies are benefiting, and you are also going to see more investment come to the US as a consequence of this, because some companies will potentially want to de-risk from what is going on in the region.
There's investment when it comes to exploration and production, and then there's expensing and investment when it comes to the distribution of that oil and gas. Just what in your mind needs to happen here in the U.S.? What kind of money needs to be spent and where in order for the U.S. to, again, capitalize on that kind of energy dominance play? We've seen it with Venezuela, now with Iran, now here we are, given the conflict and oil prices where they're at. Is there an incentive to build out infrastructure? And if so, what kind of infrastructure is needed in order for the U.S. to capitalize on this particular move in oil prices longer term?
It really is midstream infrastructure. So look, there is enough capacity to export at a theoretical level. I don't think that's the issue. But if you think about it, but not all the pipelines connect to the right docks. Vessels, to be honest, is shipping more than anything else where that investment needs to be made. Vessel availability is going to be one of the biggest constraints in keeping crude oil exports out of the U.S. above 5 billion barrels per day. We are expecting a record print next month. I forget, we're still in March. Over 5 million barrels per day of exports out out of the US, but sustaining that is not going to be possible without ample amounts of vessels, but also over time, we will need better connectivity into those ports. Those projects are happening already, but we will need more of that.
All right. Amrita Sen, a longer conversation for sure from Energy Aspects. Thank you very much. We'll see you soon. Let's get you caught up now on where we stand with the markets right now. You can see the major averages are in rally mode following an unconfirmed report that Iran was open to ending the war with certain guarantees in place. Right now, you can see the Dow's up about 2% to about 46,162. It's a 940-point gain. The S&P is up about 150 points, a 2.5% gain to 6495. And the tech-heavier NASDAQ is 21,480. That's up 685 points, or a near 3.5% gain. The VIX is falling as this equity rally takes hold. Currently, the CBOE Volatility Index is at 2629, which is down 4 points from what we saw yesterday's close. The big moves in the gold market are happening as well, with gold now up more than 2%. You can see there 3% to $4,664. And then silver is up more than 5% at this point as well. You can see some of those silver trades playing out. The Mag 7 is finding some life today after a very rough month and quarter as well. All the names are being led higher by Meta Platforms, Alphabet, and NVIDIA. Coming into today, NVIDIA had lost about $500 billion in market cap so far this year, but we're making up for a bit of it right now. Bitcoin is also trying to move up as well on the day so far, if we could show you that price. Now, you can see there, the Stocks Europe 600 is up 0.5%. It closed there anyway. Bitcoin, by the way, has now posted 6 straight months worth of losses, so we'll keep an eye on those trades as well. Bitcoin, again, 67,500, up nearly 2%. Let's now bring in Tim Seymour for more on this, CIO of Seymour Asset Management. He's also a CNBC contributor. You've, at this point now, Tim, heard all of the conversations that we've had so far. I wonder, let's start with your big take here. Is this something that you feel comfortable about, this rally, or are you treating it a little bit more cautiously?
I'll leave politics for other networks. I think places where the response of the market to oversold conditions, to valuation construct that makes some sense going into earnings season is absolutely real. I mean, if you think about an S&P with 335 of EPS estimate out there that hasn't been adjusted, if it doesn't get adjusted, and that's a big if, we're at 19 times. We traded from 22 times forward and down to 19. The low from Liberation Day was around 18 times. So there's an opportunity to look at the value construct. The conversation we've been having on fast money is the flexibility on CapEx that exists within the Mag 7. They could reel this in at any time, and I think that would also change the defensive nature of a lot of these companies. We were oversold. It's hard to believe that the politics that have created headlines that have done nothing to the VIX. I will say the VIX's move today is authoritative. We've seen moves in the market that have not been confirmed by the VIX. We've been making higher highs. Let's see where we go. Oil prices are obviously what we're all following.
Okay, so if oil prices are what we are following, what exactly then is your strategy, your playbook, so to speak, with regard to how you get back into this market or put new capital to work? What exactly are you looking for, and what parts of the market seem the most attractive given the sell-off that we've seen so far?
Well, I'm not worried about missing a rally. And I can tell you that for the money that I manage, this is an opportunity to be picking your spots and finding great companies. There are names to own in here. For example, I would be buying Nike. But I think that we've already kind of played that movie out. That's a bottom-up story. I think I look at the integrated oils. I actually still love energy here, even if oil pulls back. I think utilities have been a place to be both very defensive and have ridden through some of the data center euphoria, and you get back to an XLU or you want to pick your names that I think really look fantastic, and healthcare's underperformed. And I think healthcare's underperformed with some contagion from software and things that I think are still overshooting it. So the market's had a lot of reasons to sell off. Look at the cyclicality of at least how banks respond on a day when, if you have not put a growth headwind into the market that it's not priced for, those names that are responding, I think you can be a long-term investor here and take advantage of this. But I'm not waiting for the dinner bell to be rung and say it's time to get back in there.
All right, Tim, we had asked earlier in the show Victoria Green over at G Squared Private Wealth about this kind of America versus the international trade. It's kind of mean reverted over the course of the past 12 to 18 months or so. Do you feel as though those international markets are someplace that you want to be, given some of the underperformance that we've seen since the Iran war broke out versus the U.S. market? Is it probably better to be in the U.S. market than it is other parts of the world?
Well, you teed that one up for me, Dom, because I run an international ETF, IDEVO, and I do think a down month, the first down month in 8, is an opportunity for international markets, assuming we don't run into the kind of a growth scare. We had a bad inflation print in the EU today, but at its whole, the story that's been underpinning international markets is that there is deficit spending. There really is a deregulation theme that's better in Europe than it is in the United States, frankly. I think the secular trade over, to other parts of the world is something that it's not a trade. This is a 5 to 10 year reallocation, because I still don't think, having said what I said about Mag 7, I think a lot of the oxygen in the room was choked out over the last 5 years. It leaves a lot more opportunity for international markets. So yes, I believe international markets look very interesting in a world where we get back down to normalized energy prices. That trade will absolutely pick up, in my view. But I can't tell you what the politics are going to be around oil right now. I can tell you that fundamental stock picking and valuations and free cash flow generation, which is what we look for at IDEVO, supports international markets here.
All right. Victoria Green prefers the U.S. markets. Tim Seymour prefers the international markets. We've got the full gamut covered. Thank you very much, Tim. We'll see you soon. Our rolling market coverage continues now. Let's bring in Katie Stockton for a look at the Objective Chart Foundation side of things. Founder and managing partner over at Fairlead Strategies. She is also a CNBC contributor. Katie is, well, I guess now at this point, just the simple question, how much of this is technical? Are there any levels that you're watching? We were oversold. Are we still that way now? How exactly does a technician view this?
Well, the market, of course, is oversold, but it's a function of the negative momentum behind it. So we don't feel like we have that so-called dinner bell rung yet, per Tim. I think, it's not a technical move in terms of, a bounce off of a very clear support level or something to that end, but it is the last day of the first quarter. So there can be some, volatility around that, and that could be contributing to what we're seeing, which is very much headline driven. We are not exactly believing this rally. We feel that it's just a relief rally, and it does mark a gap that the NASDAQ 100 index had on the downside being filled, and that often does happen. So we don't see it as that meaningful in terms of the direction of the market for the next few weeks, which we still think the bias is lower there just from a momentum perspective.
Katie, next few weeks, you've kind of put a timeline on it. Are there certain levels that you are watching in certain parts of the market, certain indices? You mentioned the NASDAQ 100. Is there a target you have for the S&P 500 about where you think you would be feeling like it's okay to start getting into the market again?
It's usually not just about support, but support for the major indices is generally, or at least as of yesterday, maybe 3-4% below current levels. For the S&P 500, we're watching a level or zone just shy of 61.75 as support, but it's more of a setup that we want to see in the indicators. The indicators have yet to turn meaningfully. We just have at this point one signal on the weekly S&P 500 chart that supports 4 weeks of stabilization, and perhaps that's what we're seeing, but we're working under the assumption that that stabilization will still not necessarily be the final corrective low, and that's simply because the loss of long-term momentum is very real. In fact, the S&P 500 and many of its larger cap sectors, technology, communication services, and consumer discretionary, those proxies are all poised for monthly MACD sell signals as of today.
Okay. All right, Katie Stockton, thank you very much for that. We appreciate it. We'll see you again soon. Now, we're getting 2 more reports on the status of talks between the U.S. and Iran. Al Jazeera reporting moments ago that Iran's foreign minister said what is happening now is not negotiations, but an exchange of messages directly through our friends in the region. And a short time later, Al Jazeera reported that a White House official said President Trump is confident an agreement will be reached soon, but that President Trump has been clear about the consequences of reaching an agreement. So keep an eye on all those headlines. That's the incremental development there. Markets are still up north of 2% and about 3% for the NASDAQ composite overall. So that's the current state of the markets. Oil prices have pulled back but are now off of those lows. Keep it right here. That does it for us. Power Lunch is picking up the coverage coming up after this quick break.
All right, welcome everybody. We have got breaking news for you. Stocks, they are soaring on unconfirmed, that is key, unconfirmed reports that Iran may be ready to end the war, albeit with conditions. Welcome to Power Lunch, everybody. I am Brian Sullivan. Kelly is off today. Stocks, they're ripping higher across the board. The NASDAQ, it is up more than 3%. Oil and the fuels also reacting, although not as much as you might think. WTI and Brent both down. We'll get more on that trade in a moment. We have got you fully covered on everything you need to know as all this news develops. CNBC's Megan Casella in D.C., Pippa Stevens here on the commodity trade, and Schwab's chief investment strategist, Liz Ann Saunders. Perfect day to have her here right on set. Welcome, everybody. It is a huge day. Let's get right to it and begin with an unconfirmed report that the Iranian president says they may be ready to end the war. But there is almost as much we don't know as we do know. Let's find out what we do know right now, because it is moving markets, with Megan Casella in D.C. Megan.
Brian, that's exactly right. Major market reaction, as you said, in response to this unconfirmed report. And this all stems from a phone call held earlier today between Iran's president and the president of the European Council. So Iran's Press TV, which is state-affiliated media, they're reporting that Iran's president reiterated during that phone call today that Iran seeks no war, but is prepared to end it with guarantees against further attacks. So they're appearing there to lay out some conditions by which Iran would be willing to make a deal. But to be clear here, Iran has made this sort of declaration already. There was the 5-point plan that we were reporting on last week, where conditions included a complete halt to aggression and assassinations, reparations, as well as assurances that war is not going to be reimposed. Now, the White House did not respond to my request for comment on this latest report in the last hour, but as of this morning, the White House's position remains the same. They're continuing to pursue diplomatic negotiations, which they say are ongoing, but they're also preserving their military options and pressuring NATO allies to get involved in order to reopen the Strait of Hormuz. So on the question of what sort of talks are ongoing, just in the last few minutes now, Al Jazeera TV is reporting, according to Reuters, that the Iranian foreign minister says he's been receiving direct messages from Steve Witkoff, that's the U.S. special envoy. Now, Iran says those do not constitute negotiations, but it does confirm that there is contact between the two sides. Al Jazeera also reporting that the Iranian foreign minister says Iran is ready for any ground confrontation. So, Brian, further throwing cold water there that we're really in any sort of a different situation than we were a few hours ago.
Well, the markets are buying into whatever the unconfirmed rumor may be. I will ask this, Megan, not to put you on the spot, but there were reports out just a couple of hours ago also that the Iranian Republican Guard potentially would be threatening American technology companies with something. We're not exactly sure what that is, and I want to be very careful in the way that I word anything. That doesn't sound, again, if true, like a de-escalation. Is it fair to say that there are some conflicting messages that are happening right now?
Absolutely. There is a lot of confusion out there, a lot of conflicting messages. And yes, the market is excited about this one report that Iran might be willing to end the war with conditions. But we knew about most of these conditions, or all of these conditions, I should say, at least a week ago, if not more. So there's not really a difference in circumstance. There is that report that they're threatening U.S. companies with some headquarters in the region as well. That was earlier today. They put a deadline on it of sometime tomorrow. And just to Al Jazeera saying they're ready for any sort of ground confrontation as well. So they continue to be really hard-pressed.
All right, Megan Casella working it as well, and I'm sure we'll have more as the day goes on. Megan, thank you very much. Now to the moves in the energy markets, because oil, Pippa Stevens, oil is down. But oil is not down $10 a barrel, so it's moving, but maybe not to the extent of the stock market. What do we know?
That's right, Brian. So WTI is down about 1% right now and off the worst levels of the session. And I think that just indicates what you and Megan were just talking about, which is the fact that there is a lot of confusion about what this latest unconfirmed report means, and also the fact that a lot of those parameters we were already aware of. And so right now, clearly, energy traders are saying this is not really anything new. And I just got off the phone with Tom Closa, and he said that, it won't amount to much and that it is a down day in an up market. And that is the key there. It is still an up market. Even with WTI here down 1% at 102, we're still about $37 above where we were prior to the war. And there's also the fact, and Brian, you've been talking about this a lot, that in the past month, throughout the month of March, there was still a cushion in terms of the oil that was being delivered that had already been loaded onto VLCCs ahead of the war. That is now basically running out. And so that takes a big cushion out of the market. And so even if the war were to end, miraculously, say today, and the Strait were to open again, it will still take a long time for all of those ships to get in position, to reorient, for the production to come back online, for refineries to get back up and running. And so clearly the oil market here is saying that this is not going to, be a meaningful end or a meaningful return to the pre-war environment anytime soon.
And that's, I think, a critical point that you're making, Pippa, right? Which is that there's going to be a lag. Let's just say, and we all hope, let's say the war ends tomorrow. Two sides come together, officially say this. I'm making it up, but we're kind of being optimistic. It will take weeks or months, perhaps, in some regions to rebuild production, to rebuild supplies. And in the case of natural gas like Qatar, that could be multiple years. Maybe is that a reason why the energy markets aren't moving at the same speed that the equity markets are moving today?
Yeah, it seems to be the market taking this with a note of caution here. Of course, there are a lot of traders that have been burned, notably after Russia's invasion of Ukraine when prices shot up and then Russian oil was still on the market. But this time is fundamentally different because we actually have lost supply. And to your point, think about Ras Laffan. We heard that 17% of their production could be offline for as much as 5 years. And in all told, they supply about 20% of global LNG. Or you look at Iraq and Kuwait, some of their mature oil fields might never be able to return to pre-war levels thanks to damage in the reservoir with the water pressure. And so there are just a lot of structural shifts that have taken place here. And I think longer term, it's also going to make, countries wary of over-reliance on any one nation. The Middle East, particularly Qatar for LNG, was always seen as a reliable supplier, but this now is changing that narrative and perhaps leads to a higher geopolitical risk premium priced in going forward.
Yeah, and why oil is down, but not down as much as one might think. Pippa Stevens, thank you very much. All right, now, folks, let's get back to the markets and your money. Perfect day to have your guest on, Liz Ann Saunders, Chief Investment Strategist at Charles Schwab on set. Liz Ann, don't worry, I'm not going to ask you to go into the political side of this.
Thank you, because I wouldn't answer anyway.
We don't know.
We don't know.
Right, we don't know. And tonight, everything could change. Again, it's not even clear who may be in charge of Iran. So let's just put that aside. There is no doubt that today is a good day. What does, if anything, today's market move maybe tell you about positioning or sentiment in the market?
So, sentiment has been a tricky one in this recent part of the cycle because, I've been in this business for 40 years. I learned from the best that there was in sentiment, which is the late, great Marty Zweig. And I remember 40 years ago when I was learning about investor sentiment, the two buckets that mattered was institutional sentiment and individual investor sentiment. Kind of smart money, dumb money, to use it generically, and I find that too degrading a term. Now, we still can think of that separation, but we also have to think of behavioral measures of sentiment and attitudinal measures of sentiment.
What does that mean?
Well, an attitudinal measure would be like American Association of Individual Investors. It's just a survey. Just asking investors,
how do you feel?
Are you bullish? Are you bearish? Then there's behavioral measures, like what are they actually doing with their money? AIII actually tracks the equity exposure of their members. And sometimes in a tough market environment, they'll say, I'm very bearish, yet it doesn't manifest itself in what they've done. So you've got to listen to what they're saying, but also watch what they're doing. But now, even within individual investors, you've got the retail trader versus the longer-term individual investor. So it's a real jumbled sentiment picture right now. But I think what happened on a day like today is the lead-in was a very, very oversold market. You had less than 20% of the S&P 500 trading above a 50-day moving average. Sometimes that in and of itself means your sort of launch point.
Like a spring. The market was kind of a spring almost in, right. Is it fair to say max pessimism or a lot of pessimism?
A lot of pessimism.
We know hedge funds have been net sellers. We saw that.
A lot of oversold technical conditions. So it's more than just sentiment, it's technical conditions. And the positioning can really shift in rapid fire fashion. All we have to do is think about what happened last April, between April 2nd and April 9th. It's hard to judge an environment that's so driven by headlines and social media posts. But what we can do is get a sense of what is the positioning right now? Are we positioned such that if you get a positive catalyst, do you have greater short-term upside by virtue of positioning having gotten washed out and having, moved to
sounds like
defensive?
You just described today.
Right. That's exactly what I'm talking about. Now, how long lived that's going to be is obviously still a function of the headlines and in turn, the positioning. And, the bottom line is ending this war, whatever that looks like, is good news. But to Pippa's point, that doesn't mean production gets back online quickly. And the ripple effects in terms of the economic impact are still very much ahead of us, because this is not just about oil and the Strait of Hormuz. This is what has been
a supply chain shock.
Yeah, and it's not. It's LNG, it's oil, it's refined products, it's helium, which goes into semiconductor chips, and so I think the economic impacts of this, that story is not fully told yet.
If we go back to, and you can't find a period that mirrors what happened now, except for maybe the Suez crisis of the 70s. But let's go back to Russia's invasion of Ukraine in 2022. The NASDAQ in November of 2021 went from whatever point it was at down. It lost 35% from November of 2021 to September of 2022. Right. We forget that. It was a pretty grim 9-10 month just slow drawdown in part, and you had Russia, Ukraine, and high energy prices in the middle of that. The NASDAQ started to fall last year. Now we have this supply shock. Is there any parallel, correlation, whatever, between 4 years ago and today? Because that was a rough patch for investors. We forget.
It was a rough patch. The difference, though, is that there were route options that were available in terms of, some of the distribution of LNG that had been coming from Russia to Europe. The United States was able to quickly shift some export volume there. Very different when we talk about the choke point of the Strait of Hormuz.
Okay.
So I think that's an important difference. Another important difference is 2022 was a massive inflation problem for reasons not just related to
COVID and lockdowns,
right.
the pandemic,
and
et cetera.
So we were also in a very different monetary policy backdrop.
Okay.
So I think to me, what this is reminiscent of, as from somebody who's done this a long time, is 1990. Not just because of the military conflict, the move up in oil prices, but what was also going on in the late 80s, which was the LBO boom and the credit concerns that we've been dealing with that kind of went to the back page of the newspaper in light of the war. So to me, this reminds me a little bit of 19.
Because I made this graphic just for you, Lizanne, from 35% drawdown November 2021 to September 2022, and then the market doubled. And I look at a lot of the stuff that you and your great team does, and you're talking about how with the market decline, and it's not been a huge decline heading into today, but we are down, 14th worst start to a year for the S&P 500. But in that decline, big tech valuations effectively got to the same level, roughly, as the overall market.
Right.
So where do we launch from today in terms of how the market, war aside, let's put the war aside. I know it's hard to do, but let's do it. Where do we stand with fundamentals and valuations in this market, earnings, everything?
I'll answer that in a second, but I also want to talk about something I think it's important. That's why I'm talking about it. We have to think of not just at the index level, what the NASDAQ is doing, what the S&P is doing, what the maximum drawdown has been, where we are year to date, but what the underlying constituents are doing. So here's the math associated with that, and I'll start with the NASDAQ. NASDAQ did move into correction territory. I think it's 11% maximum drawdown, or maybe 13% maximum drawdown at the index level. The average member within the NASDAQ, if you average up all of their individual maximum drawdowns, it's negative 33%.
Wow. Like Microsoft is 35%
it's
from its
just
high.
happened through a process of rotation, not all at once.
And because we showed the averages, which are, by their name, they're averaged out.
They're also cap weighted.
So it's actually been worse?
The S&P hasn't had a 10% drawdown. The maximum drawdown for the S&P is shy of that, about 9%. The average member within the S&P 500 has had an 18% drawdown. Again, it's just happened through a process of rotation. Now, I think most investors would choose sort of a rotational correction where you either ease valuation excess or sentiment excess, as opposed to the NASDAQ dropping in one fell swoop by 33%. So it's not a bad way through a process of churn and rotation to correct some of these excesses. But the fuller story of what the market is doing is being told under the surface of the indexes.
It's fascinating. So, which is also why we have you on the show, because it's just fascinating stuff. So, and again, if I'm wrong, we're just freestyling here. I love it. All that in then, and when you look at earnings expectations, which of course we know, folks, they could change, but everything you know right now about earnings and valuations, does the market look overvalued, fairly valued, undervalued? Or is that a stupid question?
No, yes, depending on
Were we in Minnesota?
No,
You know, they say no, yeah.
The answer is yes, and I know it was a multiple choice question, but it depends on the segment of the market. The good news is that this corrective phase has been driven by valuation compression, not by a deterioration in earnings estimates. Now, that's yet.
Why, though?
I think analysts, first of all, we have upward revisions to overall S&P, mostly concentrated in two sectors. The energy sector, for very obvious reasons.
Which, by the way, doesn't really matter.
But
I hate
also
to say it doesn't really matter that much. It's 4.5% of the overall market.
Right. Well, but
it's my baby, but it doesn't move the market.
But the tech sector has had huge upward revisions. One thing that a lot of people don't realize is the breadth has not been great. Two stocks, NVIDIA and Micron, represent a good chunk of the increased estimates for the tech sector, but very concentrated in just a couple of stocks. What I think has also happened is, as it relates to the war impact and the feeder of energy costs and what that impact has on the labor market, what that's going to do to profit margins, I think analysts have not done a lot of monkeying around with the numbers yet. But we're now on the cusp of earnings season. And I think you'll start to see a little bit more movement on the part of analysts making adjustments, particularly to companies that have as a big feeder cost.
So I'll wrap it up with one final question. So it is the last day of the quarter. So that means earnings are upon us again.
And there's another thing about that. Remember that mutual funds do their rebalancing the final week of every quarter. So some of this that you see, some of these big swings that happen
including
on a
today,
day-to-day basis,
maybe to the upside,
could be a function of that rebalancing timing.
There's always so much going on. So let's just, when earnings cross in about 2 to 3 weeks, we're going to start to get a lot of numbers very quickly. If those numbers are pretty much in line with expectations, not even raised, not cut, not raised, just kind of where you and your team think they're going to come in. Does that mean this market is
I think the market's pretty reasonably valued now.
Okay.
Assuming we don't see a serious deterioration to forward estimates.
And if we don't get the deterioration, though, that would be not a good sign, but not a bad sign. What if we get earnings upward revisions? Is that a market rip your face off rally kind of a situation?
Do keep in mind that valuation tells you nothing about what the market's going to do. It is a terrible market timing tool. If you look at starting valuations on a forward PE basis over any period of time and look at what subsequent one-year performance is for the S&P, there's no correlation between the two. If you look out, say, a 10-year window and you look at starting valuations, then you have that upward slope where, you know, the higher the starting PE, the worse the market is, and vice versa. But on a one-year basis, you do a scattergram of that, there is no correlation.
Well, we're going to start to get those numbers in a couple of weeks. And to your point, if there's not a deterioration, we'll see what this market does. Today is one day, but today is also the best day for the NASDAQ since all the way back last May. But we'll see what tomorrow brings.
Well, you know what also matters, too, as it relates to valuation is what's the monetary policy backdrop? What's the inflation backdrop? Because earnings are more valuable when interest rates are moving down. They're less valuable when interest rates are moving up.
Well, maybe if oil falls, inflation expectations fall, and we get back to that lower. We'll see. That'll be for the next time that you're on because we're out of time.
Okay.
Liz Ann Saunders, always a pleasure to have you on, Chief Investment Strategist at Charles Schwab. Bonds are also reacting. The 10-year yield briefly dipping below 4.3. It's back above it now. But Rick Santelli, to Liz Ann's point, you know, listen, stocks are ripping, but oil's down a little, and the bond market's not moving that much.
Right, and it didn't move that much to the upside. The high yield close for a 2-year was under 4%. It was like 3.99. For a 10-year, couldn't even get above 4.5%. Its high close was around 4.43. And if you look at what the pre-conflict lows were for a 10-year, it was down at 3.94 on the Friday before the conflict, the 27th of Feb. So we're under 40 basis points. So to your point, I think we should expand that to both sides of the market, meaning that we're not seeing a lot of upside on the treasuries when it looked dire, and we're not seeing a huge downside as it looks more optimistic that things are coming to an end, even the dollar index. The dollar index was a counterintuitive trade. It was siding with things like commodities, higher oil prices, dollar-denominated commodities boosting it up. So the fact that it's down about 0.5% today also is pretty good news. I'm much more optimistic than you are, Brian. I think that the lows in stocks are in. I think the highs in interest rates are in. And I think if we wait any longer, all the good trades are going to be gone. Now, that's just my opinion. And there's a lot of risk involved in being early. But those are the people who make the money. And to me, it's about money. This isn't about brownie points. It isn't about how the world's going to look supply-wise. I keep it simple. We are the best country in terms of our own energy needs. We're an exporter of energy. And for all practical purposes, whether people like Iran conflict or not, it certainly is going in our direction.
We want to be optimistic. Rick Santelli, I'm right there with you. We all want optimism. We want people to certainly to make money.
It doesn't sound like it. It doesn't sound like it,
How
honestly.
so? Why
doesn't.
not? Why not?
I mean, to me, it seems like most of what you're talking about is looking at everything half empty. I think, just like Liberation Day, All those who looked at it half empty gave up a lot of money in terms of the marketplace. I think this is the time that people should be buying whatever it is they wish they could have bought. You might have already missed some of the cheapest prices.
Well, listen, it's a fair criticism. My wife doesn't call me worst case scenario Sullivan for no reason. So it's a message taken. Rick Santelli, always appreciate it. Love the optimism. By the way, Rick, thank you very much. All right, folks, the markets, they are optimistic right now. Again, it's an unconfirmed report, but we do know, according to Al Jazeera, the two sides at least are talking. And if you're talking, you're hopefully not fighting. The NASDAQ is up 3.4%. We're going to get Jeff Kilberg's take, what he is seeing, what he is doing, if he's buying, if he's selling. We want to hear from you. Are you optimistic? What do you think? We're back right after this. All right, welcome, folks. If you're just joining us, the markets, they are rocketing higher. The NASDAQ is on pace for its best day since May of last year on reports, confirmed reports of a conversation that Iran may be willing to end the war with conditions. That's based on a conversation that Iran had with an EU official. So the confirmation is that the conversation occurred. It's not confirmed exactly what they talked about, only that we know what the EU person said. If you follow all that, you're better than I am. But let's bring in KKM Financial's Jeff Kilberg. Because Jeff Kilberg, we're not going to confirm anything except we're confirming that the markets are buying into something. The market reaction is the NASDAQ up 3.3%. Your take.
The VIX is down 15%, and you're seeing buyers emerge. And this is really interesting as we are the last day of the quarter, month end. There's two inputs here, Sully. I actually think we had a capitulation yesterday, but it wasn't in plain view. It wasn't a conventional capitulation. We saw S&P 500 options yesterday, a historic high, one of the bigger spikes in put volume. We saw 13 million options contract traded. 60% of them were puts. Therefore, the positioning going into today was kind of offsides. That in conjunction with being oversold conditions, earnings season around the quarter, here we are, and I think you're going to see follow through once crude oil goes under $95. That's the confirmation.
Why is 95 important for crude oil?
93 to 95 is where we were sitting last week, and all of a sudden we broke up to 107, and that's when yesterday felt horrible for all the bulls out there. You can feel it in the pit of your stomach how bad it was day after day of the market moving lower. Here, of a sudden, now with crude oil still at 102, that's the last piece of the puzzle for confirmation that this war, this Iranian conflict, is coming to an end.
Yeah, and we got some data, did we not, Jeff, that we saw a lot of selling from hedge funds. You heard Liz Ann Saunders, top of the show, talk about sort of institutional sentiment. It sounds like maybe the sentiment of this market underneath the hood was even worse than we thought. So if that's the case, is today then a one-day spring? Like the market sprung higher? Or if there is an end to the war, is this the beginning of something more meaningful?
I think there was a lot of torque in the market, to your point, and the Liz Ann's, and sometimes sentiment comes in different ways. But I look at the options market, and in between the tea leaves, we saw people loading up on puts. And day after day, they were profiting on those puts. So being off sides with all that open interest means, yes, this is a coiled spring. And I think if we do see continued positivity out of our government, I'm not trusting what our adversaries out of the terroristic Iranian regime is saying. We just can't trust that. So it's been 47 years. So I'm going to trust what we're hearing out of our government. We're pretty close to obtaining all four of the objectives which have been laid out from day one. So therefore, I think this is the first leg up. And yes, we have the ability to gap up another 3 or 5% if we do see follow through, and more importantly, if we see crude oil come back down. And lastly, Sully, this crude oil, I know it's been a duration play, but this crude oil component, it could be deflationary. We could see, just like in COVID, they're rerouting supply chains. In a couple of months, even a year, you could see energy costs even lower, which would be a welcome input.
Well, we'll see if these higher prices, which are going to relate to higher earnings, we know that, if that translates into more production in Texas and the United States, because companies like Chevron, Exxon, Conoco, and others, they use that extra free cash flow to drill more holes and pull out more oil. They won't at 65. Maybe they will at 80, 85. We'll see. Jeff Kilberg, always appreciate your time. Thank you very much. All right. So your next guest has actually been on Iran's Karga Island. MCC will join us with her insight into the Iran situation. What should we believe right now? The markets believe something. They're ripping higher. We're back right after this. All right, welcome back to Power Lunch, everybody. Big day for the markets. You can see the Nasdaq is up just about 3.5%. The S&P up 2.5%. The Russell 2000 up about 3% as well. The markets are ripping higher across the board. For equities, oil is down, but just down a little bit. It all follows a report from Iran about the European Union, or at least an official from the EU, effectively stating that they spoke to somebody in Iran who says that Iran might be willing to end the war with certain conditions. But again, there is a lot we don't know. Let's bring in Michelle Carusa-Cabrera, who has been to Iran. Michelle, thanks for joining us on short notice. Listen, we're not even sure who's running the country.
Right.
So we want to be very careful with all these headlines. But do you, the market's buying it. Do you?
Yeah, so there are two headlines, right? That the president of Iran has said something to the effect of that they're willing to have discussions, and also that the foreign minister says that there are discussions. They don't want to call them negotiations. Those are two reports. Those, I'm guessing, are probably true. The question is, are they meaningful? Well, you have to realize, and what has historically always happened with Iran, and by the way, with Cuba and previously Venezuela, is historically moments like this have been about buying time. Can they buy time? Can they extend things out? Can they get a ceasefire going so that way they can have more time? Now, the president and his team have to be very careful about that. They have shown, actually, I think already with the Iranians, that they understand that the Iranians try to buy time. That was Operation Midnight Hammer when they bombed the nuclear facilities. That's when they had grown very frustrated. They thought the Iranians were buying time, trying to, and they went in and arrested Nicolas Maduro because they thought he was trying to buy time. So they are cognizant of that. So I think the headlines, likely you could bet on them and they're true, but you don't know if they're meaningful.
Yeah, and earlier in the show, Rick Santelli kind of accused me of not being optimistic enough. I want to be optimistic, but here's my issue. And you know this, Michelle. This came from the president, theoretically, the president's faction inside of Iran. It did not, he doesn't run the country. He's the president, but let's be clear. The supreme leader, the Ayatollah, is the one who really calls the shots. We don't know the condition of Junior Khomeini or whatever you want to call him. But because this came from the president, does that make you a little more wary than if it came from the, quote, supreme leader? And I hate that term.
Yeah. So I think that's, you hit the nail on the head. We haven't seen the new supreme leader. There are reports that he is in a coma. So the president may be the de facto leader. The other very important group within Iran is the Iranian Revolutionary Guard. And they this morning were making very contrary statements to this point. The one other point I would make is that there was a military objective when the U.S. went into this. Stop Iran's ability to project power. That's military talk for it. We got to destroy their missiles. We got to destroy the Navy so that way they cannot project nuclear weapons. And I don't think they're going to stop until they achieve that objective. Bottom line.
Michelle Carusa-Cabrera, who has actually been to Iran. Michelle, we're glad you joined us, especially on short notice. Thank you very much.
See you later.
All right, so now more to the energy markets, joined by our friend Bob McNally, president and founder of Rapidan Energy. And Bob, we know, listen, this is all developing real time. It could change overnight, could change certainly tomorrow. You heard my conversation with Michelle. The markets, the equity markets are buying into this. They're up 3.5% on the NASDAQ. The energy markets are not. Oil's down 1%, still above 100, still above $101. What's your take?
Brian, great to be with you. Yeah, so this is a nightmare. The energy market is experiencing a nightmare it never thought possible, and it wants to believe the nightmare is over. I think what really got things going was President Trump, reportedly Wall Street Journal yesterday, saying, look, I'm ready to walk. I've had it. Let Europe go and take care of the oil. Sort of the quote-unquote taco option. I think that's really what paired the gains last night in Brent and got us going down. Look, we think it's going to end most likely with a ceasefire. Both sides decide we're at the apex of the cost-benefit curve. Are we at the cusp of that? We don't think so.
There is a report in Axios, and I don't want to put you on the spot, Bob, because it just came out, so maybe you saw it, maybe you didn't. I'll give you the gist. Axios reporting that Pakistan and China, I don't know what their role is in this, but Pakistan and China effectively have a deal to put forth a potential ceasefire that would involve what they would say is the reopening of the Strait of Hormuz. Forget about the meat of the article. Answer this. What is China's role in all of this? Because they have been shockingly quiet, even though they are the biggest consumer of the majority of those refined products and unrefined products coming through that strait?
I think China's role is less than advertised. They want to be like everybody else, the one that steps in and oversees and introduces the solution. They want to project power, et cetera. But you know what? I don't think they have much sway over Iran. I think that's been overstated. They've got 1.2 billion barrels in reserve. They're not as bad a shape as the Philippines or even India and so forth. So China wants to be the one to save the day. I don't think Iranians are listening to them much. Their kit didn't work too well in Iran or Venezuela. So I think China is pretty much a sideshow right now.
All right, so Pippa and I were talking about this at the top of the show. Let's be optimistic. Let's assume there is an end to the war soon, okay?
Yep.
The two sides agree. Everybody agrees. The conditions are agreed upon. Traffic resumes full freight through the Strait of Hormuz and the Bab el-Mandeb Strait. How long will it take to get oil flows, we'll get to natural gas in a second, oil flows back to pre-war levels?
3 to 4 months to get the fields, the facilities, and the boats moving again. That's what I'm told. I think the head of the Kuwait Petroleum Corporation said 3 to 4 months. I understand other large producers also 3 months. However, Brian, Rumelia, a workhorse field in Iraq, that thing may never come back to where it was. We may have some permanent loss of supply from some of those big, old, tired fields. But for the ones that can work, 3 to 4 months, assuming no damage above ground.
Is that why we're seeing oil down 1%, which is nothing? Oil's higher now than it was a couple days ago.
So I think every instance of verbal intervention loses power. And last night, the president, according to the Wall Street Journal, and he came out in Truth Social and said, I'm walking, I've had it. And so I think that's worth about 1% off. I don't think the market really believes it. But I think that's the reason we're getting that. It's just the waning potency of happy news to get this nightmare over with after 30 days.
Yeah, and again, you're definitely a Mideast expert. I know you've been there many times. In fact, just recently. So you heard my comment to Michelle that we're getting these comments third hand from an EU official who reportedly spoke with somebody in the president of Iran's office. Do you buy that chain? Do we know, Bob, who's really running or who's speaking for the Iranian nation? Assuming, and I mean this respectfully to the people there because it's not their fault, is there an Iranian nation right now?
You know, there is a core leadership. Ghalibaf is a leader much more so than the president. The president's more of a figurehead. But there is, they did plan for this. My colleague, Scott Modell, ex-CIA field officer, Iran expert, he's gotten all over this. And they planned 4 or 5 rungs deep. Is it super coherent? No. But there are leaders. They're operating. They're keeping quiet. And there is a leadership. I think we kind of know who we need to talk to. It's not the president. It's others. And I think that isn't the problem. It's getting to the apex of that cost-benefit curve for both. President Trump's there. Iran may be getting close.
Bob McNally, Rapidan Energy. Bob, always appreciate your super valuable time. Thank you very much.
Thank
All right,
you.
folks, just a quick reminder, go back to the markets. They are at record highs. The NASDAQ is up 3.5%. And coming up after the break, we are going to speak with a company that might produce your power. They are right at the center of energy and energy infrastructure, and that stock has more than doubled in the last 3 years. Drew Marsh, the CEO of Entergy, will join us next. All right, welcome back. The stock market and the energy market reacting to a wave of reports coming out of Iran, or at least associated with Iran. Stocks there ripping higher. The XLE is down. WTI crude oil down a little bit to about $101 a barrel. Natural gas up a little bit, but still below $3 on the margin. And that's pretty amazing considering that the world's largest natural gas facility, which is located in Qatar, is offline. Let's kind of tie it all together, bring it back to the United States and to you. Joining us in a CNBC exclusive is the CEO of Entergy. That is Drew Marsh. They're one of the biggest power producers in the United States, based down there in the Southeast. Drew, thanks for coming on. Listen, again, I'm not going to ask you to get into the war details. It's one day. We don't know where this is going to go. But what does the fact that natural gas in America is under $3 and the biggest natural gas facility in the world is offline, what does that tell you about American energy?
Well, it shows, well, first of all, thank you for having me on, Brian. It's great to see you again. It shows the strength of the United States natural gas infrastructure and natural gas supply. We have a very large reservoir of gas in our country, and we're exporting it all over the world. And that's helping keep natural gas prices low here in the U.S.
Does it matter for how you make deals? You've got two sides. You've got the residential side supplying power and electricity to millions of residential customers. You've also got the data center and the AI side and this huge Meta, Facebook data center and some others. Does the war and worries about supply, does that factor into how you approach either side of your business?
I think that from a supply perspective, there's going to be plenty of natural gas for gas generation. It's the fastest and most efficient controllable energy that's available right now to not just power data centers, but to power all kinds of industrials. We have LNG facilities, we have steel mills, petrochem facilities that are growing in our service territory. So the natural gas is going to be available for all of that, regardless of what happens in Iran. But if Iran got to be resolved, then there'd be an opportunity for others to decide to make investments. And I think even that removing that uncertainty is going to help. I think that the fact that there was the conflict in Iran will probably cause people to look all over the world for investments. And when they look for investments, they're going to look back at the Gulf Coast, where we are fortunate to be, because there's all the elements that you really need to grow a business on the Gulf Coast exists there. Access to global markets, access to energy infrastructure, welcoming communities that are focused on economic development. All that exists in our service territory. And so we're going to continue to see investment. But it could help that Iran got resolved.
Well, we hope it has. Drew, and pre-war, the focus was all on AI, and it will be for years to come. You're making a data center deal with Meta, which, if I tried to explain the size and scale to our audience, I'm not sure I could do it justice. It's effectively going to double your rate bait, your rate bait with one customer. Do you worry about that concentration risk, that it's almost too much Meta given the scale of this project?
Well, it is a significant project, and it's significant for Louisiana. We're fortunate to say that we also have other data centers in our service territory, AWS, Google. We have some of the smaller developers of data centers that are entering our service territory. But our industrial base is very large, and even though we are seeing these very large projects, we still have a significant base that is well over half of our sales today, and that is going to still be around. That's your more traditional industrial customers, your refineries, your petrochems, LNGs, steel that I mentioned earlier. So even though these are very large customers, in the big scheme of things, we aren't going to be completely taking over our sales. It is a significant investment, but we are also watching, the continued growth and the need for compute well into the future, and we expect that that is going to be a very safe investment for a long time to come.
Yeah, I mean, as a guy prone to sometimes TV hyperbole, Drew, I don't think I could put this fully in the size and scale that would do it justice, but we appreciate you coming on. Drew Marsh, CEO of Entergy. That stock has doubled in 3 years. Drew, thank you very much.
Thank you, Brian.
All right, take care. All right, let's step out of world of money and finance for a second. Get a CNBC News update with Julia Borsten.
Thanks, Brian. The Supreme Court ruled this morning against a Colorado ban on controversial conversion therapies for LGBTQ children. In today's ruling, the court sided with a Christian counselor who argued against the state's ban on First Amendment grounds. Justices Elena Kagan and Sonia Sotomayor sided with the majority, noting that the ruling meant a state could also not ban gender-affirming care. Staff scheduling at LaGuardia Airport may have violated the operating procedures on the night of the deadly tarmac crash. According to a document seen by Reuters, LaGuardia's air traffic controllers are supposed to handle either air or ground traffic. But Reuters says the controller may have been handling both. And Indonesia announced today that it will be rationing fuel supplies as the Iran war continues to push prices higher. The government is limiting fuel sales to 50 liters per day and implementing a work-from-home policy for civil workers outside of healthcare and security. More Power Lunch is coming up after the break.
All right, stocks, they are right at session highs. The Dow Jones Industrial Average is up 1,000 points. The Nasdaq's up 3.6%. Brent crude down about 2%. Tyler Rosenlicht is energy portfolio manager at Cohen & Steers, head of natural resource strategy. We had ostensibly asked you to come on to give us some stock picks. We'll probably get one, Tyler. You picked a hell of a day to come on, by the way. The
market's usually how it goes, right?
Well, that's how it goes. Live television, maybe some good news around the Iran war. We'll see. As an energy stock person, how do you read the energy market, some of the headlines? How do you approach this right now?
Yeah, so we're definitely believers. A phrase that I learned last week from Paul Sankey at Sankey Research is when you shut down energy, it's an event. Turning it on is a process. So we're definitely believers.
Sounds like
that
something Sankey would say.
Exactly
Very
right.
Sankey-ish.
But I think that there's going to be a reverberation in terms of getting energy flows moving again, getting gas moving and so forth. We do think we came into this with excess supplies. They've been drawn down. And this is all noise. It's really going to take a while for us to work out of this. I actually think that's a good thing for energy stocks, even if oil prices are down a few percent, because we understand how important they are for the economy, for economic growth.
And this is going to be, I guess, to some, an ugly part of the story. There was an article about it last week about all the excess cash flow these companies are going to make. And I look back at earnings from 2021 to 2022 when Russia invaded Ukraine and oil surged. It does flow to the bottom line. We're going to get a huge pop in earnings from these companies, are we not?
We are, but for us, I think spending your time on next year's earnings is actually less important than thinking about the terminal value expansion you get from, we were in an end of the oil era a decade ago. Up until about 2022, we thought we didn't need energy anymore. And one of our core theses is actually energy is going to be around for a really long time. So yeah, maybe next year's earnings are going to be up 100% or 200%, but it's really about who has duration of cash flow, who's going to be around and producing oil 20 years, 30 years from now. And I think that's really going to differentiate the winners from the losers.
Are you resetting your baselines for the price of oil and other things? We were at 60, 65 ahead of the war. Do we have to reset that to 80 over the next 2 years?
I think you definitely do. I mean, we did come into the year a little more bullish than most, saying Brent 70 or 75. You think you have to raise that at least $10? I mean, part of it is we've realized how fragile the oil supply system is, right? If you can shut down a strait and that can constrain global energy movement, that's a big problem. And so as you move to other producers, marginal cost has to go higher. We do think in the long run, oil price needs to go up, and also oil is going to be around for quite a long time. And that's a good thing for energy investors.
2021 to 2022, Exxon, Conoco, and Chevron had huge earnings pops. I just did the math last night because I'm boring. It was up over 200%. ConocoPhillips, a buy here?
We like Conoco. We like all the oil producers that we think have long inventories. Who's been investing countercyclically? Who has these assets that were underappreciated 5 years ago that are suddenly going to be appreciated again? So that's a great example of a company that we think, as the oil era comes back, they're going to be really rewarded.
Yeah, and we'll see if they reward America by putting more drilling rigs in line and taking more oil out of the ground. We'll see. Tyler Rosenlicht of Cohen & Steers. Really appreciate your time, Tyler. Thank you very much.
My pleasure.
All right, folks, before we wrap up this hour and send it to closing bell, I want to give you a full rundown of how things are moving again on reports that Iran has potentially signaled it may be willing to end the war if certain conditions are met. So there's a lot of ifs, ands, or buts. But either way, the market is buying into it. The S&P 500 and the NASDAQ are right now on pace for their best days since May of last year. The NASDAQ up 3.6%. As energy stocks not move today, but they have been moving. Oil, as we just talked about, not moving much. Brent crude down 2.5%, and crude oil, WTI here, down 0.5%. So not a big move. In fact, oil still higher than it was. The VIX, though, it is moving down. The volatility or fear gauge is down 15%. This could all change tonight, but right now, market's ripping up. 1 hour to go. Lot to do. We're done. We'll see you tomorrow. Closing bell picks it up right now.
Welcome to Closing Bell. I'm Scott Wapner, live from Post 9 here at the New York Stock Exchange. This make or break hour begins with this surge in stocks on hopes the war with Iran is closer to an end. We'll follow this action right into the close today. We'll show you the scorecard here with 60 to go in regulation. We are green and well so across the board. The majors were already higher. They did get a major boost in the noon hour on that report that Iran's president said they were open to ending the war. Unconfirmed, but nonetheless, it moved the market. We'll get the latest from Washington in just a moment, but there is your intraday picture of the majors. It shows the story pretty well. Oil moved a little bit lower, not much, but it was enough to make people feel better about what's been happening there, too. Yields have been down, and all of that has contributed to the better feeling in the markets today as this final stretch begins. Tech, a big story as well. NVIDIA taking back a key level. There it is, above $170 a share. It's a 5% gain. Many of the other mega caps are rising in concert, too. We'll have more on that coming up. First, though, we begin in Washington and CNBC's Eamon Javers, who has the very latest on this war. Eamon?
Yeah, Scott, as you say, markets have been moving on reports of a phone call held earlier today between Iran's president and the president of the European Council. Iran's state-affiliated Press TV is reporting that Iran's president said that the country seeks no war, but is prepared to end it with guarantees against further attacks. So that does convey a sense that Iran is continuing to offer up some conditions that could be built into any deal to end the war. But that's not necessarily new, and it's just one part of the set of demands that Iran has been making publicly already. Now, President Trump has said that negotiations are ongoing, and if Iran doesn't cut a deal that he likes by April 6th, he will bomb civilian infrastructure such as power plants. The president took to social media this morning to hurl some criticism at American allies who he argues have been insufficiently supportive of the United States. He wrote that France has been very unhelpful and warned that the USA will remember. And he wrote, I have a suggestion for you. Number one, buy from the U.S. We have plenty. And number two, build up some delayed courage, go to the Strait and just take it. You'll have to learn to start fighting for yourself. The USA won't be there for you anymore, just like you weren't there for us. But Scott, what many countries appear to be doing is cutting side deals to pay Iran for safe passage of their ships. That's creating a significant new revenue stream for the Islamic Republic that didn't exist before the war. Of course, what the president wants them to do is launch their own military capacity. It looks like buying their way out of the problem might be the more appealing solution to a lot of American allies.
You did as well, Eamon, also have this report later this afternoon that both China and Pakistan were collectively trying to be intermediaries here, too, and presenting Iran with a deal for a ceasefire. There are more parties involved here as well who would like to see an end to these hostilities.
Yeah, and you can imagine the panic in Asia right now as the last shipments of pre-war oil reach Asia's economies, and they look at this enormous air gap in supply of oil that's going to be indefinite at this point. The idea that China is moving into pole position here and taking a leadership role in trying to settle this is fascinating. This is an Axios report that China and Pakistan have made this overture. And you do think that with Pakistan being involved and Pakistan serving as the main mediator between the United States and Iran, there might be some sort of tacit U.S. blessing to this effort as well. We'll see if the White House will comment on it. But a fascinating proposal that reads to me, Scott, if you look at the points in that proposal as Axios has reported them, just as a straight-up ceasefire with safe passage in the Strait of Hormuz. And that seems to be something the president would be willing to settle for at this point.
Well, I think the markets would be quite happy if that, in fact, was the case. Eamon, thank you very much. That's Eamon Javers from Washington with the latest there. Speaking of the Strait and speaking of oil, Pippa Stevens is with us now, who's been following this, trying to get the Strait of Hormuz back open. Just isn't an immediate thing, as you were telling us at noon. Pippa, give us more information.
Definitely not immediate. And we did see WTI settle off the worst levels of the session, settled at 101.38. The low had been 99.62 with the high at 106.86. And right now we're right around the 102 level. But this is by no means going to resolve itself anytime soon. As Eamon was just saying, the last shipments of oil that was loaded prior to the war has now reached the final destination. And so that cushion is about to be removed from the market. And we continue to see this disconnect between the physical and the paper markets. We have seen prices soaring in the physical markets, especially for those Dubai and Omani blends with barrels in the Middle East very, very tight now. And that's not completely being reflected in the financial markets right now. Although Goldman was out with an interesting note saying that there were some investors buying strike options as high as $450 per barrel. So, of course, there are so many, there's a very large and very wide range of outcomes that could be possible here in terms of oil pricing looking forward. But also, we can't discount the fact that the Bab el-Mandab Strait south of the Red Sea is also now potentially at risk after the Houthis entered the war over the weekend targeting Israel. And if that were to also experience a slowdown in shipping, that could be a double whammy for the market. And then just finally, Scott, I would point out here the narrowing spread between WTI and Brent right now about $2.40 as WTI becomes more attractive. It is, of course, not the key type of oil that refiners are looking for. They tend to like the more of the medium sour barrels. But if they can't get those, they will take WTI. And so as WTI exports become more valuable to the global market, we could see that spread continue to tighten.
All right. That's great insight as always, Pippa. Thank you, Pippa Stevens. Now let's bring in our panel. Solis's Dan Greenhouse, Requisite's Bryn Talkington, and Capital Area's Malcolm Etheridge. Both Bryn and Malcolm are CNBC contributors, one and all. It is great to have everybody. I guess the big question, Dan, I'll begin with you since you're sitting here next to me, is if there's a resolution reasonably quickly, what do you do as an investor? You just go back to playing what you were playing before, the idea that, hey, earnings are going to be pretty good, and you still have this stimulus coming out of Washington, and all's well again?
I think the temptation will be to do something else. I don't know if that's correct. It might seem to many to be too simplistic to say, well, we're just going to return to the world as was. And admittedly, in a lot of respects, we will not. Oil is not going back to $60 anytime soon. And the exact mechanism by which this is solved remains to be seen. But from an investment standpoint, we've talked ad nauseum, as everybody has noted, that earnings expectations have held in quite well. They've gone up in many cases. The valuations in a lot of those big names that have driven a lot of inflows into the market have gotten more attractive. Some are trading at sub-market multiples, which is insane when you consider the growth profiles. So I think that's probably not a bad place to start. But I do want to quickly note before we move on that the headline is that Iran wants to settle this. And I don't think anyone should be surprised they're getting bombed left and right. I'm sure they'd be perfectly happy to have this settled. But it's the condition. And listen, we talked last week. If and when there was something resembling a settlement, the markets would fly for all the technical and fundamental reasons that we've been talking about. But their conditions for settling this, so to speak, involve taking over the strait, which is going to provide them a revenue stream, as Pippa noted, a promise never to attack them ever again, and a right to enrichment. A number of things that the U.S. is not really going to go for. So I get why the market's up so strongly today, but I would just caution investors, a lot of those conditions are probably not something that the U.S. is going to agree to.
Bryn, are you still cautious? Want to see more information before you make a larger investment decision here?
You know, I like to rely on technicals when the fundamentals are foggy because obviously we have this war, this excursion. So, you know, I've been talking a lot about the 200-day. There's a lot of good data, Scott, that if we can get back above the 200-day within the first month, then it's got a 100% hit ratio that a year later, stocks are positive with an average return of around 19%. So we're only about 2% below the 200-day. But so, you know, March 19th, we went below it, Scott. So I'm looking at April 19th, which is a long time away. But I do think that's really important to technically get back above that so we can build off of there. So that's the key item that I'm watching before I put on, let's say, like a bigger exposure, because it does have that really high hit rate a year out.
What about you, Malcolm?
Yeah, I think Dan's making a great point that we might need to curb our enthusiasm just a little bit. Nothing is set in stone, and this can all be undone with one tweet. But I also think today is a really good exposure of what the playbook probably looks like once we do get the all clear. So financials have done pretty well. The XLF participated today. Tech has done really well today looking at the NASDAQ, and those were the two sectors that lagged coming into this year. And so maybe that is the place that investors are looking at opportunities where things have been sold off quite a bit, and we can make some sort of intimation that maybe that's where dollars are going to flow the heaviest as soon as there is an opportunity to start buying back up this dip.
Dan, this was always the danger, wasn't it? That what was always thought to be, I suppose, and hoped to be a short-lived conflict, the danger was getting too negative as it seemed to be dragging on with no real credible information to go off of, but always knowing that in the background, this hopefully wasn't going to be a long-term ordeal.
Yeah, but listen, I never really thought it was, it depends on your definition of long term. I think a lot of people of our age look at Afghanistan and look at Iraq and harken back to Vietnam and think that this is going to be multi-year.
No, but I think at the beginning, the administration's stance was whether it was, believable or not in the sense of you never know what's going to happen once war begins. Of course. Was 4 or 5 weeks was kind of thrown out there. Estimate.
Yeah, I think most people I speak to seem to believe that the administration thought this was going to be a weekend thing a la Venezuela, and obviously that's not been the case. I don't know if that's true or not, obviously, but yeah, there was a risk of getting too negative. But at the same time, a fully loaded Kuwaiti oil tanker was hit with a drone last night.
Yeah, and the market's still open positive today.
Yes, I guess. Right? I'm not making a market comment. I'm just saying hostilities have not ceased, and we talk about getting more negative. Getting back to my point about the conditions that the Iranians are going to demand, so to speak, for cessation of hostilities. If the U.S. doesn't agree to them, the risk becomes, well, we're going to start targeting the regional infrastructure to a greater degree. I don't know whether the U.S. is actually going to go bomb civilian infrastructure in Iran, but Iran could bomb other refineries throughout the region, could make this a little more painful from a global standpoint. And so yeah, I get it, the risk is getting too negative, but the negative risks were also quite real.
It just, Bryn, I mean, it doesn't really behoove either side to draw this out. Obviously, from a military standpoint, there's no competitive conversation to be had regarding the Iranians versus the United States. And from our perspective, an environment in which oil prices are going to remain elevated over an extended period of time, and thus gas prices, which went over $4 a gallon today on average for the first time in a while, we're going to remain elevated over a period of time, where the stock market was going to get hit to a degree that I don't think anybody, certainly not in Washington at 1600 Pennsylvania Avenue, would like to see. This thing was always deemed to be, let's not let it drag on too much. It's just as the market's in the fog of war, it doesn't necessarily know how to assess all of that.
Listen, when you have the U.S. and China, which is what, 2/3 of global GDP, it's like the only real countries from an economic powerhouse that matter. I think that China-Pakistan is incredibly important. China buys 89% of Iranian exports. And so I think that them coming and negotiating with Pakistan, we'll say alongside the U.S., this feels like this is going to end, by the way. And I think that is what's happening today, is that China is a game changer. And so we are going to defeat this one way or another. But to me, that was the best news today, because China needs that oil and they need the Strait of Hormuz open. And they're not going to be wanting to pay the Iranians a toll booth. By the way, that's absurd.
Sure.
Going forward. So I think that's a really big deal today with China entering this.
If you say that this feels like it's going to end, that was the comment you just made. Mm-hmm. I mean, that sounds like somebody who may be looking to put some opportunity to work. No, if you believe that, are you going to wait until you see signed a ceasefire, or are you going to act accordingly based on the assumption that you're making today?
Yeah, well, I mean, we're already invested, right? First of all, we didn't sell anything. That's the key thing. I mean, listen, I think Google here up 4, almost 5%. Google, CBRE, Capital One. These stocks are off 20% from their highs, or 20% year to date. So, I mean, to me, those are 3 great places that I would happy to put the money to work today, and then add more. But I do want to say, I want to get above that 200-day moving average. Nothing good happens if we stay there more than a month. So I'm really just balancing today's news of China, which we don't know the details, with the reality that we need to get back above that 200-day. There's so much history what happens if we get back above it versus stay below it more than a month.
I understand that the technical confirmation, I guess you need to see, and that's completely understood. Speaking of stocks that are bouncing a lot, what a move for NVIDIA today. After that company announced a new investment with Marvell, Christina Partsinevelos is here with that. You told us the other day that you were so closely watching the $170 level. Well, it took a deal with Marvell. It took comments on this network from Jensen Huang, and then a better overall environment to move the stock now well above that level.
Yes, I think the better environment is really a big driver, especially because ETF trading right now is just a huge portion. So many people are buying ETFs. NVIDIA's in over 600 of them, so that's also helping drive shares up 5%. But the news today specifically, NVIDIA putting $2 billion into Marvell technology. This deal really centers on NVIDIA's platform that lets custom chips plug into its infrastructure. And so Marvell designs those custom AI chips for other major tech companies like Amazon. They actually compete with NVIDIA's GPUs, but this partnership kind of flips that dynamic, giving NVIDIA a shot at a much bigger market and then making Marvell a strategic partner for NVIDIA. This investment, though, Scott, is one of many. Just this month alone, look at your screen. You can see NVIDIA has committed $2 billion each to Nebius, Lumentum, Coherent. Before that, $2 billion into Synopsys, $1 billion into Nokia, stakes in xAI, OpenAI, Intel. I couldn't even fit them all on the screen because I only had 5 blocks there. The CEO often reminds investors, though, it's not a chip company anymore, but rather an AI infrastructure firm. Here he is exclusively on CNBC this morning.
The market misses several things about NVIDIA. I think they, of course, because we are such a large company and we have such a large position of AI computing and all the AI infrastructure, you know, a lot of people might think that all of our growth is all priced in. However, what is very clear is several things happened this last several months, in fact, maybe the last 6 months. We gained share. The number of customers outside of the clouds, the top 5 cloud service providers, has now grown to 40% of our company's business. Most people think that most of our business is in the cloud, but in fact, one of the fastest growing segments is outside of the enterprise, the industrial.
And the man sitting next to him is Matt Murphy, the CEO of Marvell. The argument, though, is that the market is just focused on big hyperscalers, but NVIDIA's ecosystem is just spreading even far beyond them into enterprise, you heard, industrial, and now deeper into the supply chain through investments like today's Marvell's deal. Scott.
Christina, great reporting. Thank you. Christina Partsinevelos. Malcolm, I'll come to you. You still hold the stock. I thought what we heard from Jensen Huang on this network exclusively this morning was as clear and understandable explanation that you could ever give from a CEO to an investor base on why the market's been getting this wrong.
Yeah, and listen, I completely understand the standpoint of any investor who says this stock has probably run its course here. It's probably time for me to be taking some profits or exiting the name, because how much better can the story get? They've shown blowout earnings time after time again, and I just don't know how much better you can get than 80% gross profit margin, so I'm going to exit stage left. But I also think that's leaving some opportunity on the table when you consider this company is now an innovation company, is the way they refer to themselves, to Christina's point, not just a chip company. Yes, maybe they're going to give up something on the GPU front when it comes to inference chips, but Jensen's already working on finding his next parade and getting out in front of it, so much so that this company's been investing a lot of its own free cash flow into finding where that opportunity is. So they're trying to grow their next customer in the next industry that's going to take hold, rather than sitting and resting on their laurels where they've got the Mag 7, they've got the hyperscalers as their massive customers today.
Bryn, you own it too. What do you make of what Jensen had to say, and specifically this stock move today?
I mean, it's well warranted. The stock, by the way, it's up 60% over the last year. So it's not like it's been dead money. I mean, Microsoft is the one that's been the dead money. The stock's just resting here. The stock is now on a forward PE cheaper than Exxon and is going to grow earnings 75% this year. It's resting. I feel like this stock eventually will get over 200, which to me, I keep selling calls there because it can't get above that. But I think you will continue to get this stock move like it had last year. It's just resting right now, and then ultimately it'll break out and leave investors behind like it's consistently done. So I wouldn't give up on this name even remotely with this earnings growth that we still had ahead of us and the low PE relative to, once again, an Exxon.
Dan, how much does this market need tech to be back?
Well, I don't think it needs tech to be back, but I think it's certainly going to be welcome. I mean, to Bryn and Malcolm's point, these companies still have terrific growth rates. Obviously, they've been challenged for 6 months, as we've discussed ad nauseum. But the AI story threw a wrench in the work for a lot of names, and No matter how many times these companies say, at least in the short term, we're not seeing any issue, there's a little bit of an overhang. So in light of that, we were, prior to this whole thing, doing quite well without a lot of tech participating.
No, but this is a different environment. So I'll just say the reason I ask how much does the market need tech now. So if you're telling me that, okay, well, oil prices may remain elevated for an extended period of time, even if this ends and the strait reopens, as Pippa was telling us, it just doesn't, the flow just doesn't get back to normal overnight. So for the foreseeable future, industrial companies and so many others are going to have their input costs elevated because the cost of fuel and transporting goods from here to there is, and maybe even manufacturing them in some instances is going to go up. So I can't really bank on the broadening trade right now until that environment changes. So I need now tech to perform better. It didn't have to before because the other trade was working so well. Now it may be impaired for a little bit.
Sure, I'll say a few things. First, I would argue oil will be higher because besides the complications in the Strait, you also the geopolitical risk premium was basically zero before.
Okay.
And while it might go to zero in the long term, when Marco Rubio is president of Iran, in the short term, there's going to be some premium there.
Okay, so I'm going to worry about growth a little bit then.
Yeah, but also the second point I was going to make, well, the first point I was going to make is Exxon was just $100 a share. It's now $175 a share. So you've had a huge run up in these names. So the money, we've seen this in ETF flow and the EPFR data. Money has gone into the sector all year long and is at some point probably going to rotate out. But the more important point is to your question about input costs, the much bigger issue, not that oil and energy doesn't matter because it matters for plastics and transportation, but labor costs are still the biggest issue for the vast majority of companies, and wages are still, at least for now, relatively contained. And so you do have an offset there to compensate for the higher input costs.
I guess my point is this. If you had a decision to make, would you feel more comfortable if you believe that oil prices are going to remain elevated and there's going to be still a bit of maybe chaotic aftermath within the Middle East, whether we're there or not? Would you feel more comfortable today putting your dollar into a mega cap tech company or an industrial or a more cyclical company that's more tied to the global economy? Because I think I know what the answer would be, and I'm hard-pressed to figure out how you could answer it differently.
Well, without commenting on what Solus may or may not do, my gut says probably the industrial or the Mag 7. Because, again,
now you want it both ways.
Well,
he wants his cake and he wants to eat it too, ladies and gentlemen. Finish your answer, then I got to go.
No, now we're going to have to save it for the next time.
Go ahead.
The names have been beaten up so badly, and their growth profiles are still relatively unchanged. Their valuations are super attractive. Again, this is not what I do, so take what I'm saying with a grain of salt, but that just looks pretty compelling to me from an investment standpoint.
Okay, so we'll leave it there. Guys, thank you. Bryn, Malcolm, Dan, we'll see you soon. We're just getting started here. Up next, much more on today's big rally, including that jump in shares of Apple. Star Apple analyst Eric Woodring, he's standing by. He joins us next. Apple shares are lower to start the year. They haven't been, though, as weak as some of the other mega caps. For more on why and what lies ahead for the stock, we're joined now by Morgan Stanley's head of U.S. tech hardware research, Eric Woodring. Welcome back. It's nice to see you.
Thank you for having me on, Scott.
Just want to start with something that Warren Buffett told Becky Quick, of our own Becky Quick, of course, on CNBC this morning. He lamented that he sold Apple a little too soon and that he would buy more of it, maybe not in this market, but if it went down, he would buy more. And it just makes me think that this name, as I wrote in the intro to bringing you in, it's been resilient in its own way.
Yeah.
Yes, it's down, but it's not down off of its high by that much relative to some of these other big names. Why do you think that is?
Sure. I think there's two factors there primarily. One, the cash cow for Apple is obviously the iPhone, and the iPhone is doing tremendously well. We obviously know from the December quarter how well it did back then, 20% plus growth. We have it growing 20% plus again in the March quarter. And again, we published our broad smartphone survey last Monday. Apple upgrade rates are at all-time highs. They're the only company gaining share in the smartphone market in our survey, at least. Foldables interest is extremely high. So said differently, the core of the business is still doing very well and better than it has over the last few years. And then I think the other side of it is, as the market has thematically debated the investments or lack thereof in AI, Apple is taking the capital light, asset light approach of investing $13–14 billion in CapEx and licensing technology from Google, as opposed to some of the other large mega caps that are clearly investing a ton and making big bets that have to show an ROI. That threshold for ROI for Apple is just much lower right now.
Can we go as far as to say now, Eric, that what was a headwind for Apple, that being AI, is now a tailwind for this company, or is that still too early?
I think it's probably still too early to make that claim. We have to get to the developer conference June 8th to understand exactly what Apple's approach will be. Obviously, we've seen reports of maybe Apple's strategy coming together more so than it has been over the last 2 years. I'm still a big believer in that we need to learn specifics of what Apple will provide us users that will be different than others as a means of getting into the AI race. And then also, the same question I asked management on last earnings call, what is the ROI and what is the time to payback? These are questions that are still important. How are you going to monetize AI that we still need to learn about? So we're taking, Apple is taking steps forward. I think we have a better idea of strategy. I still think we need to learn more at the developer conference before we put them into that bucket.
They did have another headwind, and that's been the rising cost of memory. We saw it in the huge run-up in some respects of stocks like Micron, et cetera. So where does that leave them now as these elevated memory prices, despite a pullback in some of those marquee names, memory prices themselves are still elevated, and it's got to be some level of a hit to margins.
We would agree with that. If you just look at the June quarter right now, we're forecasting a 45% blended company gross margin. Consensus is at 47.7%. So I would agree with you, Scott, that now this might be a cyclical dynamic here related to memory, but it is still a challenge that they have to face, and my broader universe has to face. I have been cautious on my broader universe because of this exact theme. Prices are going, input costs are going up. That creates risk around margins and around demand degradation. Now, for Apple, listen, there are some offsets. Obviously, we are well above consensus for the June quarter revenue as well. So we're maybe getting to the same earnings as consensus, but in a very different way. But Apple has more levers than peers, right? They have high-end iPhones where demand would be more inelastic, where maybe they can take some price. Over 40% of gross profit dollars comes from high-margin services that continues to kind of chug along. And Apple is a supply chain maestro, for lack of a technical term. They'll find ways to push back on other areas of the bill of materials to try to maintain margins. But we think that Apple is, in this type of environment, really going to try and maximize gross profit dollars, not gross margins, and that is through pricing, that is through supply chain actions.
This company's going to mark its 50th anniversary tomorrow. What do you think Tim Cook's greatest contribution to those 50 will be?
Tim has done a fantastic job of taking Steve Jobs' legacy and broadening it, right? I think Tim does. Tim gets the shorter end of the stick, so to say, because investors compare him to Steve Jobs. He's just a very different CEO. He's been able to take the iPhone and the platform that Apple has had and build it from a technology hardware company into a technology platform, and probably the most powerful consumer technology platform on the face of the earth, at least as we stand today. And I don't think that he gets enough credit for that. He's obviously made some new incremental bets on things like spatial computing. We'll see where AI goes. I think he still wants to see those bets play out before he hands the baton off. But again, biggest change is this is no longer a hardware company under Tim Cook. This is a technology platform. Look at how the multiple has gone under his tenure. Stock trades at mid to high 20 times PE pretty consistently. That is a sign of the shift in the business model that again, I don't think Tim gets enough credit for.
Right. I mean, it's kind of doubled, right? Ex cash. I mean, the multiple has done what it's done.
When I started covering Apple a little over 10 years ago, if the stock reached 15 times PE, that was kind of the, oh my gosh, sell Apple. Now we get up into the 30s, and while there might be debate around what the right valuation is, you can't deny that the efforts that he has undergone have led to that multiple expansion.
We'll talk to you soon, Eric. Thanks, as
Awesome.
always. I appreciate
Thanks,
your time. Eric Woodring of Morgan Stanley. Still ahead, Netflix rallying today. The company wants an even bigger play in the NFL. We'll give you those details coming up. As we head to break, another check of the majors. We're close to the highs on the Dow, trying to get to an 1,100-point gain now. S&P's taken back 6,500. We're up near 3% there. And look at the NASDAQ. It's the leader today, and by a lot, 3.75%. We're back right after this. All right, welcome back. Netflix reportedly seeking to add more NFL games to its lineup. The company's made no secret of its interest in expanding its sports offerings. Our Julia Borston joins us now with more. Tell us more details, please.
Well, the NFL's mini package of games that is currently taking to the marketplace is attracting a lot of interest from many companies, including Netflix, according to a source close to the situation. Now, no comment from Netflix, but this does confirm the Wall Street Journal's report that Netflix is looking to expand from its current package of 2 Christmas Day games, which ends this year, to a package which could include a new Thanksgiving Eve game along with an international game, likely in the first week of the season. Now, this comes as the NFL has reclaimed the right to sell these games as part of its deal with ESPN, and as Netflix hasn't increased its investment in sports events, including its first MLB game just last week. Now, there are other potential buyers for these games, including Google's YouTube, which has the rights to NFL Sunday Ticket package, and last season streamed an international game, along with Amazon, which has the rights to stream Thursday night NFL games. Now, the NFL's broader rights deals will be up for renegotiation after the 2029-2030 season, but the NFL can actually renegotiate its deal with CBS sooner because CBS's parent Paramount sold to Skydance. Scott?
Do you think in any way that this decision, if you want to call it that, or the wanting to have more NFL activity is related to not getting the Warner Brothers deal? Would that have still been something that would have been sought after by Netflix?
Well, I actually think that Netflix laid the groundwork for wanting more NFL games years ago when it struck his 3-year deal to get those NFL Christmas Day games. And what we're seeing here is really just an expansion from that. It's not a totally different strategy. It's Netflix trying to figure out which games are just not another weekly game, but really could be seen more as events, because that's what Netflix's sports strategy is about. They're not as interested in the broad rights deals as they are in the more eventized games or sports rights. If you look at what they did for Christmas Day, having a halftime show, really trying to pump it up into a must-see event, that's the kind of sporting rights that they're looking for going forward. So I would say the Paramount deal may have changed that, but for now they're sticking with the same strategy we've heard for a while. Excuse me, the Warner Brothers deal might have changed that.
I got you. Julia, thank you, as always. Julia Borston. Up next, the biggest movers as we head into this big close. Christina, what do you have?
Big close. Travel stocks catching a bid today as hopes grow for an end to the war in Iran. We'll tell you which names are moving and, of course, why right after this.
About 10 from the bell. Back to Christina now for the stock she's watching. What's at the top of your list?
We got to start with all of these airlines, mostly higher in optimism grows for an end to the war in Iran. Oil moving lower should help bring jet fuel costs down. And that has definitely been hitting airline stocks for quite some time, especially since the conflict began, with thousands of flights being canceled. United, Alaska, Southwest, American, all still down, though, since late February. But you can see the biggest surge coming from United, up over 8%. Cruise names also in that bucket, higher on the same hope. They've been pressured by higher fuel costs and, of course, the Middle East disruptions. Royal Caribbean, Carnival, Norwegian, and Viking. You can just see Carnival is 8% higher. And then last but not least, fertilizer names moving in the opposite direction. Disruption in the Strait of Hormuz has tightened supply and really pushed prices higher. If the war eases, that pressure could come back down. And so that is why some of these guys that were climbing higher down. 9% for CVR Partners.
All right, thank you, Christina Partsinevelos. We are still very much in the green as we head towards the closing bells, pretty much at the highs of the session. Mike Santoli is standing by to help us break down the final moments. Plus, we get you set up for Nike. They do report in overtime, and we do it in the market zone, which is next. We're now in the closing bell market zone. Mike Santoli and Kara Murphy from Kestra Investments here to break down these crucial moments of the trading day. Plus, Gabrielle Fonrouge watching Nike's report out in overtime. Michael, go.
Yeah, I mean, obviously you have to respect how emphatic this move is, even with it. And, you know, it's a quarter end. You do have a little bit of kind of like retirement money showing up, and just the barest excuse of potentially we have passed the peak uncertainty and oil disruption. If that's true, the market is not willing to wait around for that. So definitely an element of FOMO here. You can quibble with some aspects of this rally today, including it's not really all that all-encompassing and broad. It's certainly broad enough, but it's not one of those stampedes higher of actual buying. It seems like a lot of hedges coming off and a lot of investors and traders saying, let me not lean too negatively after this long slide. So we haven't cleared any of the important upside hurdles. Yes, V-bottoms do happen, as you and I have talked about once in a while, but I don't think that should be your default assumption. Oil is down, but also, again, not as aggressively as you might expect given the strength of this equity move. So I think you respect it, but you still say the market has plenty to prove.
Oh, the magic words that I think you said and how we've been speaking about this is the market doesn't wait around. I've said to you and I've asked you the idea of, you know, words are short at this point. We need clarity and we need something more concrete, but we're still willing to give certain headlines the benefit of the doubt rather than wait around.
We are. I mean, obviously, when the conditions are right, I mean, we had a lot of failed rallies in the last 3 days. We're not even in the S&P up to Thursday morning's high, okay? So you definitely did wring out a lot of that kind of hope and that sense of upside risk that had been animating this market for most of the month of March. And so I guess the scene was set for people to say, hey, let me not wait around just in case things actually look more constructive from here. We have some version of a declaration of, you know, the end of hostilities, and maybe we can move a little bit higher in this now much wider range that we've been in for 6 months.
Yeah, almost a 4% gain now on the NASDAQ. How are you going to tackle this at the top of the hour with Mel?
Yeah, I mean, every piece of it. We do have somebody on the derivative side who's going to say, you know, how people are positioning for this move right here, as well as Binky Chadha from Deutsche Bank. And, of course, we're going to break down the Nike numbers.
All right, we'll look forward to that. We'll see you then, top of the hour, overtime with Mike and Mel. Gabby, tell us more about Nike getting a little drowned out because of this incredible market move today, but it's still really important.
Yeah, it's still a huge report tonight. So Nike's expected to report earnings per share of 28 cents on revenue of $11.24 billion. The key thing to watch tonight will be how much progress CEO Elliott Hill has made on his turnaround plan. By now, investors are aware the company's turnaround won't be linear, but they still want more clarity on how long it's going to take. Last quarter, Nike saw gains in North America, but that good news was overshadowed by steep declines in China. So tonight, investors are going to want clearer timelines on both of those regions. Can it sustain the growth it's seen in North America? And how long will it take to turn things around in China? Profitability will also be in focus. Nike has already been crushed by tariffs and efforts to liquidate stale inventory. And now production costs could get higher because of that war in the Middle East. Scott?
All right, Gabby, we'll see what happens. Appreciate you. Thank you.
Thank you.
Gabrielle Fonruz. Karis, good to have you here. How are you?
Yeah, thanks for having me.
So looking at your notes, you put this conflict in the category of noise with AI disruption, tariffs, private credit. This feels like it's been a lot more than just your run-of-the-mill noise. It's like breaks your eardrum. It's a little loud, right?
For sure. And this is not to downplay that this is a very important event for the people who are directly impacted, for people who are filling their gas tanks every day. But when we think about the market, typically, and we've done some work looking back to like 1940, when we have a large geopolitical event like this, markets tend to look through it. More than 2/3 of the time, 12 months after an event like this, markets are actually up. What that means is that these conflicts tend to be fairly well contained. They tend to be short-lived, and then the market then gets back to fundamentals.
Okay, so let's look through it. Let's have that exercise. I look through it, and I want to do what?
So I think about where is earnings going to be coming from? And there, as we look out to 2026, expectations are that U.S. companies are going to grow earnings by like 15%. That compares to 9% on a long-term historical average. That's phenomenal earnings power.
Well, if you believe that you're going to be able to meet those expectations, and you still must believe that.
Yes, and this assumes that the conflict is relatively short-lived, meaning over the next couple of months, and oil begins to recede, not necessarily back to its pre-conflict level, but to a more sustainable level.
I mean, shouldn't I believe then that the mega caps are the ones who are going to deliver the most robust earnings growth? So just go right back to that trade as now they maybe are showing signs of life again?
So I think looking at the valuations degradation that we've had there, I think those are probably going to be the first ones to start to rebound because they have the most identifiable earnings power. But I also think what we've seen is outside of the Mag 7, call it mid caps, small caps, we're starting to see a re-acceleration of earnings growth among those, and you have much lower valuations, so they get a chance to start to catch up in the second half of the year.
It's funny that the Russell 2000, I was just looking because I've been so fixated on the larger averages like I think most people have. The Russell's still positive year to date.
100%.
That's kind of surprising given not only just what's been happening in the growth scare, if you want to call it that, but the backup in rates. So is that a sign that there's some durability to this trade?
I think so, and I think this market shift started to happen a while ago. If you look at the Mag 7 overall, they actually peaked at the end of October. And among, S&P 500, Russell 2000, EM, EFA, they're actually the worst performing asset class year to date. So again, it doesn't mean that the conflict doesn't hurt. High oil prices do hurt, but if this comes to an end, there's a lot of opportunity out there.
All right, well, we'll see if it comes to an end and when. Kara, thanks for being here. It's Kara Murphy joining us. Bell's going to ring in a moment, and we've got a better than 1,100-point gain now on the Dow. It's about 2.5%. The NASDAQ, obviously, is the biggest winner of the day, a near 4% rise. NVIDIA's back above what some saw as a real key level of $170 on these hopes of an end sooner rather than later to the war in Iran. We'll see what headlines develop overnight. I'll join you tomorrow, and I look forward to that. Have a great evening into Overtime with Mike and Melissa.
The bell's bringing an end to the trading day at the NYSE. Dimensional Fund Advisors ringing the bell, and at the NASDAQ, Royal Gold. Welcome to Closing Bell Overtime, live from Studio B at the NASDAQ market site. I'm Melissa Lee along with Mike Santoli. Stocks soaring today on reports Iran is open to ending the war, closing near the highs. The Dow and the S&P 500 up more than 2%. The NASDAQ up nearly 4%. Its biggest one-day gain since May.
Our markets team is all over today's action. Christina Partsinevelos on stocks. Brian Sullivan on the somewhat muted move in the price of oil. Rick Santelli is watching bonds. But let's begin with the very latest on a possible end to the Iran war. Eamon Javers joins us from Washington with what we've heard and what we know. Eamon?
Yeah, a possible end might be going a little too far, Mike, but we do have this report from Axios, which is reporting that China and Pakistan are floating a new proposal to end the war in Iran. Essentially, it would be a ceasefire in exchange for safe passage in the Strait of Hormuz. Now, Axios is citing a conversation with the